companies. I wonder how this race is going to go, your ability to kind of get out there and exploit the lead that you have had in these products while other companies are also rushing to do so. How is that shaping up right now?
I actually think that it's a positive that there will be competition because I think the main challenge in unlocking the overall obesity opportunity is one of unfolding the market, really making it well understood that obesity is a serious chronic disease that takes medical intervention to prevent a number of comorbidities. And it's a journey we have been on our own for quite some time. Now we welcome competition from Lilly. We respect them a lot. We've been competing in the diabetes space for 100 years, and I think a race that's based on educating physicians, making a disease understood, and then a race on what is the power of innovation you bring to the market. I think it's a very healthy and very competitive situation, and one that's honestly good for society, because it is about helping people living with obesity and making them stay active in the workforce and prevent diseases that follow obesity.
It's interesting, though, because we've seen such a huge run-up in the uses for these drugs in the United States that just this week, North Carolina said its state health plan would no longer pay for these drugs for weight loss, reserving it for diabetes treatment alone. The state treasurer came on last call on CNBC to talk a little bit about it. I want to play that, and then, Lars, get your reaction on the other side.
We've never questioned the efficacy of this drug. What we're questioning is the price. This drug can potentially cost up to $1,500 in North Carolina. In the home country of Novo Nordisk in Denmark, it costs about $280. What we've asked Novo Nordisk to do is to sell to those that teach, protect, and otherwise serve in North Carolina this drug for the same price as people in Denmark pay.
And the treasurer says that Novo Nordisk has refused to negotiate and, in fact, suspended rebates when the board tried to negotiate it. Why can't the price be the same?
Well, the price listed mentioned here in the clip was actually above our list price. I don't know where the price comes from, but we give rebates in the US, and we're also willing to give rebates in North Carolina. But of course, we need to discuss under which conditions those rebates are paid. So I think it's a grossly oversimplified story. So we believe that the value of treating obesity way outguns the value of the medicine, so to say. And the clip mentioned the efficacy of the product. That's one of weight loss, but increasingly we're also adding additional benefits. We will this year get our CV protection from the SELECT study on the label, which is something that's another value driver. So we believe in the value of medicines, but we're also willing to negotiate the rebate levels that brings down the cost significantly.
The treasurer says that his plan members account for 2% of the prescriptions filled in the United States. If other states start following suit, could that be meaningful to your bottom line here?
Today we see that there's actually more seeking coverage than that are states and other plans leading. And I think the clip here is perhaps not perfectly resembling what the type of business we conduct is, because we are giving significant rebates in the US, and we're also willing to pay that in North Carolina. So it's not relevant to pay for the list price. But of course, we have to negotiate what those rebates are, and there are specific conditions around the case in North Carolina that I cannot get into here that leads to this situation. But we're willing to negotiate what the rebate should be to bring down the price significantly compared to the list price, also in North Carolina.
Yeah, I mean, demand outstripping supply, but heavy costs and people trying to weigh that against the efficacy. That's going to be continuing for some time. Lars, we're going to have to go. Thanks so much.
Thank you.
Coming up, a major music label threatening to pull its artist content from TikTok. Universal Music Group accusing the social media service of bullying. We'll show you how TikTok responded. Plus, a new warning from billionaire Barry Sternlicht about the market for commercial office space. Squawk Box will be right back.
WBC.
Universal Music Group, the music label that represents stars like Taylor Swift and Drake, will cease licensing its music to TikTok. It accuses the social media platform of bullying and intimidation in its contract negotiations. The previous music licensing agreement between UMG and TikTok's parent company, ByteDance, expired yesterday. UMG took its argument public, saying in an open letter, it's pushing for appropriate compensation for artists, protection from artificial intelligence, and online safety for TikTok's users. UMG said TikTok tried to bully the label by selectively removing the music of some of its developing artists. TikTok responded, accusing the label of putting greed above the interests of their artists and songwriters, called UMG's characterization of the negotiations a false narrative. Well, you know, like there's this back and forth about what's fair to get paid, when is your music getting used, and this is why you see on social media a lot of times it'll take down your content if you try to put your own soundtrack to it.
Well, and also, you know, 5 years ago, I would say Universal and the music side had the upper hand, but you look at the songs that TikTok can just make or break. Me a song from 10 years ago, 20 years ago, that suddenly blows up as a #1 because it's on TikTok videos. And so they are a hit maker now, and so, you know, that's changed the power dynamics between these companies.
It's, I mean, it is interesting in the sense that TikTok having the power, but also what are we fighting over in terms of dollar value? You know what I mean? It doesn't seem as if it's going to be make or break financially for TikTok to be able to share that much ad revenue. So it's kind of interesting because, you know, it tends to be just a trickle for most artists.
It would be problematic, though. It's true for the emerging young artists not to have their music on TikTok where it's most widely shared. And if that's the place where there's some hang up, and if TikTok's taking that, you know, you can see why that would be problematic. Ask Rick Astley the power of social media.
True.
Yeah.
When the 10-year-old twins start to Rickroll their mom, for those who don't know Rickrolling, right?
I didn't grow up on it.
Okay.
Yeah.
You've all been
He hasn't recorded in decades, right? He's just kind of...
How amazing is that to come back and have that kind of reemergence? But thanks, social media.
Yeah.
Meanwhile, billionaire Barry Sternlicht out with a warning on office real estate. He said it's an asset class that never recovered from the pandemic. Speaking at a conference in Miami Beach, Sternlicht said offices were once a $3 trillion asset class that's probably worth $1.8 trillion now. He said there's $1.2 trillion in losses spread somewhere. No one knows exactly where it is. Well, I would guess most of it's in the regional banks. I know some of it's in family offices. I know some of it's in these investment funds that the asset managers and big companies have started with commercial real estate. So I think we kind of know roughly where they are. Also worth noting here, Barry Sternlicht has a distressed real estate fund. He was raising money for a new fund late last year. He said he's been chomping at the bit for distressed opportunities in real estate. So I'm not saying he's talking his book, but he certainly is ready and positioned with a lot of capital to exploit whatever we see. And he's had the same message for a couple of years.
$1.2 trillion is a lot of money and sounds like a lot of money, but when it's splintered around, and by the way, if you don't know where it is, it probably means it's not a big problem in any one place. In fact, Goldman Sachs, when they reported their earnings just this latest quarter, they basically said they wrote down their commercial office portfolio by like 50%, and so it's kind of done on some level.
And the crises that happen are never the ones that we foresaw, right? And so this has been the most widely telegraphed crisis for the past 3 years. And because it was so widely telegraphed and everybody's been bracing for it, and they understand it's really just a small subsector of offices, and even within offices, it's a small subsector of cities. It's New York, it's San Francisco, Los Angeles. So I think we've got our arms wrapped around the problem. At this point, there could be some surprises and some small blow-ups, but I don't think it's going to be the crisis that everyone was talking about.
Meanwhile, office REIT stocks have actually taken a turn higher, so maybe the market feels like we've cleared that risk for a while. All right, Walmart announcing a 3-for-1 stock split. The retailer shares are near an all-time high. The additional shares will be payable after the market closes on February 23rd to shareholders of record as of the previous day. It'll begin trading on a post-split basis on February 26th.
You know, it's interesting because though it doesn't make a difference to how much you actually own. Walmart says this is for the employees, that they have, 400,000 associates who participate in the stock purchase plan. And so it provides more opportunity for them because of the payroll deductions to buy in.
To buy in, and perhaps if you want to sell, you can sell in smaller increments or more precise increments. And I mean, historically it says it really doesn't matter, but there's a vague signaling effect that's positive. If the management team were really nervous about the stock value, you wouldn't do a stock split and say the nominal price is going to be lower.
Although Walmart is going to now trade how heavily it influences the...
Yeah, the split doesn't change the weighting in the index, which in fact Walmart punches way below its weight in the indexes because the family still owns almost half.
Right.
And so only the publicly owned shares are counted in the S&P 500.
And they have to keep selling shares just to maintain that, be under the ceiling of half, so.
Yeah, they're
billions of dollars in cash that they have to keep producing the stock. Coming up, all eyes will be on the Fed decision day. We'll tell you what to expect in Fed Chair Powell's news conference. And as we head to break, we'll look at yesterday's S&P winners and losers.
Good morning. Welcome back to Squawk Box, live from the NASDAQ market site in Times Square. We want to check the futures right now. You can see the S&P 500 in the red. The Dow looks like it's set to open in the green, and the NASDAQ, oof, looking rough and ready too.
Often in Investors waiting to hear from Fed Chair Jay Powell this afternoon at the conclusion of the central bank's two-day policy meeting. Our next guest says she expects the Fed to remove its tightening bias but remain cautious. Let's bring in Megan Graber. She's the global co-head of debt capital markets at Barclays. Megan, thanks so much for joining us. So I think the idea of a March rate cut is off the table now. What should we be looking for from today's press conference?
Yeah, I mean, I think rates unchanged is all but a foregone conclusion at this stage, as you suggest. I think really it's the signaling around the path forward that will be the more closely watched piece of the equation this afternoon. And I think what we're likely to see is a much more hawkish bias to the rhetoric at today's press conference in particular. I mean, certainly more than we're seeing priced into the market with a 45% probability still reflecting, in my view, far too much confidence for a March Fed cut. There's a decent amount of data that I think suggests the Fed should approach today's meeting with, and the onset of cuts, frankly, with a healthy dose of skepticism. I mean, we've got financial conditions that have eased for 3 months running. We're continuing to see strong employment figures. We've got JOLTS data this week. I mean, there's a growing number of job openings. And then you've got CPI, which is just consistently running more than a point higher than PCE. So between those three things, I think the most likely scenario is that the Fed looks to buy their time here and to ultimately preserve some optionality before concluding that conditions are supportive of a more sustained return to target.
It's interesting, you mentioned the potential for a hawkish bias. I mean, we certainly saw a very dovish Powell in the last press conference and his comments. That's what gave us that end-of-year rally last year. What makes you think that they're going to not pivot again necessarily, but perhaps show a more hawkish stance at this meeting today?
Yeah, I think we saw some of this backing away of an expectation that cuts are imminent from much of the pre-blackout speech. So I think at a minimum, we should expect to see Powell echo some of what Waller's pre-blackout comments suggested and to temper any expectation of a faster or a sharp cutting cycle, which is certainly what the market is pricing in.
Megan, you mentioned all the things that make it seem as if maybe the Fed doesn't have to be in any hurry, right, with financial conditions easing and economic growth holding up pretty well. The other side of that, and a lot of people are trying to kind of send around the 6-month average core PCE charts, that show, hey, we're pretty close to target, and here we are with a 5.25 plus Fed funds rate. The Fed has already said they'll be cutting before at the inflation target. So I wonder if people are just triangulating, where rates are, what the trajectory is on inflation, and if inflation is doing what it's doing and it's cooperating, we don't have to worry about the secondary things like financial conditions.
You're exactly right. I do think they're going to leave the door open to evaluating March. In fact, our economists at Barclays are calling for March as a potential first cut. But I think it's not a surefire thing, and certainly they want incremental data to support the fact that we're not actually going to re-accelerate. I mean, that's really the risk here. I don't think they want to get over their skis and be premature or overly aggressive out of the gates here. They can be patient. I think that's in every other meeting cut as they initiate some of these moves. So I think they'll open the door to March, but I think PCE in and of itself, while certainly suggested that they've met that 2% target, there are enough other counterbalancing forces, CPI being one, that would suggest that there's still some contagion risk to that. So we need to keep an eye on it, and I think they will be patient in the way they proceed going forward.
And looking at the rest of the year, the market is hoping for, at least perhaps 7,500 basis points in cuts. What do you think we'll get? I mean, the consensus is that rate cuts will start in June or July. What do you think we'll end up the year at when it comes to Fed funds?
I do think we probably see 3 or 4 cuts this year, so that consensus is in line with our thinking. And I do think it could be as early as March, dependent upon the data. So, and I think we see incremental cuts another 4 next year as well. So we've got 2 years of a more prolonged path back towards normalization, in line with the market and frankly in line with how many investors are positioned. So Fed funds aren't always a great indicator of the path forward. Talking to buy-side players, hedge funds, asset managers, and insurance companies, I don't think anybody's anticipating this to be an aggressive move by the Fed, certainly not in the first half of this year.
All right, Megan, we appreciate it. Thanks so much.
Thank you.
Coming up, a closer look at some of the stocks dragging down the NASDAQ this morning. That is next. Plus, we'll tell you what you need to know about Nikki Haley's fundraiser in New York City last night, hosted by billionaires. And a reminder to get the best of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app and listen anytime. We'll be right back. Shares of Mondelez are falling. The snack company reported higher than expected earnings. Revenue was in line, but growth and volume in both Asia and North America came in lower than expected. Mondelez said price hikes helped improve its profit margin last year, but is now seeing softer demand as cash-strapped consumers cut back spending. We'll note that Mondelez was a massive outperformer against almost all other global food stocks coming into this report. So a little bit of profit-taking relative to what the rest of the group has been doing.
Shares of Swedish retailer H&M tumbling after the company reported weaker than expected sales and the surprise departure of its CEO. The company said Daniel Erver will take over. He's currently the head of the H&M brand and has been at the company for more than 18 years. You can see the stocks falling there. Look at that, down almost 10% in the early trade.
Nikki Haley pulling in a reported $1.5 million from her fundraiser yesterday here in New York. The hosts included billionaires Cliff Asness, Ken Langone, Stan Druckenmiller, all known to the show here. She has at least 10 more events with mega donors over the next month, including one in Miami with the aforementioned Barry Sternlicht and another right next to Donald Trump there in Palm Beach. California venture capital investor Tim Draper, he's going to gather the tech crowd in her honor. She has raised more than $5 million since her loss in New Hampshire. In an interview with CNBC yesterday, Citadel's Ken Griffin said he supported Haley.
I have supported Nikki Haley. I think she is a tremendous candidate. And I've been pretty consistent. I wish on both sides we would have a candidate of a younger generation. Now, big picture, Trump's running on a record of success. His 4 years were really good policies for America.
Donald Trump has ramped up his efforts to bring in wealthy donors. He'll be hosting a dinner at Mar-a-Lago tomorrow night after Trump's comments that Haley donors would, quote, be permanently barred. Haley printed T-shirts with her name and barred permanently on the T-shirts. She's already sold more than 15,000 of them. We should mention that after that Griffin comment, his spokesperson announced that Griffin had given her campaign $5 million. Unclear whether that was before New Hampshire and afterward, but that was a huge gift from Ken Griffin.
Traditionally, and you and I have covered politics for a long time, you would see the amount of money going into campaigns matter. That if you were out raising your opponent, you got a significant advantage. I'm not sure that that's the case anymore. If you look at how much money Nikki Haley was able to bring into the campaign and then failed to win Iowa, failed to win New Hampshire where she had her best shot, and we'll see what happens in North Carolina, but I'm not sure that fundraising in this case matters as much as passion and narrative and hangover.
Well, Donald Trump has changed a lot of things about politics, and the whole donor dynamic is absolutely one of them. Obviously, we remember Hillary Clinton vastly outraised Trump in that election, and I don't know that, to your point, that money is going to change the dynamics of this race. I think most people know Biden, they know Trump, they have strong opinions. I don't know that more advertising is going to change their minds. What's different about this is that normally you would see, after Haley's performance in Iowa and New Hampshire, you would see donors stop giving her money.
Money would roll to the front line.
But it's like the millionaires are burning $100 bills at the altar of Nikki Haley simply out of either anger at Donald Trump. Perhaps they think something will happen that will sort of suddenly make her a possible candidate. But right now, it makes no sense. She's staying in the race because she has the money. They're giving her money because she's staying in the race. So that creates a cycle where, why is she running? Because she's got donors who continue to want to fund her.
The other interesting thing is that in the campaign contributions to Trump over the last few years, I mean, you've got now his political PACs helping to fund his legal defense. And so you have to believe that anyone who's donating to Trump now not only believes in the power of using their donation to help him get reelected, but in the power of their donation to help keep him out of legal hot water.
And his strength as a candidate when it comes to finances is that millions of small donors who give him a lot of money. That's another advantage that he has. Whereas relying on these mega donors, I mean, there are only so many fundraisers you can do in the Hamptons, New York, and Palm Beach. And once those guys max out, I mean, they can give to the super PACs. But that's an enduring financial source for him that's a big advantage, I think, over Biden as well.
Do you think that that's potentially an Achilles heel, though, raising money from billionaires and being seen in New York City?
Absolutely. As both parties become more populist, you don't want to be seen, and Trump has made a lot of this. Particularly, look, all the establishment and the elite loves her, and he loves to say that, and it's true.
Coming up, New York City's controller joins us next on a new push to get banks to disclose their funding of clean energy versus fossil fuels. Squawk Box will be right back.
www.educator.org/TV.
Three of New York City's pension funds are pushing for some of the largest U.S. banks to disclose their financing ratios of clean energy to fossil fuel. Joining us now, New York City Controller Brad Lander. Brad, it's good to be with you this morning. Thank you for being here.
Good morning. Thanks so much.
Can you explain to me how asking Bank of America, Citigroup, Goldman Sachs, Morgan Stanley, JP Morgan Chase, and Royal Bank of Canada to disclose their ratios of clean energy to fossil fuel financing, how does that help the investments that New York City makes for its pensions?
So look, New York City's investments are long-term. First-year teacher, we're going to pay their retirement decades out from now, almost toward the end of the century. So climate risk is financial risk. We've got to make the energy transition from fossil fuels to clean and renewable energy, or we're going to burn it up in our portfolio as temperatures and seas rise. Banks know this, but they aren't being transparent and rapid enough in that energy transition, and that's why disclosing their ratios of financing renewable energy versus financing fossil fuels and making the transition, quickly enough to matter is what matters to New York City retirees decades out.
There's an analysis by Bloomberg New Energy Finance that shows that the energy sector investment needs to reach 4-to-1 by 2030. And in 2022, it looked like the banks were getting an average ratio of 6-to-1. If you get the banks to come out and disclose that ratio, will that influence the way you make investments? Can you foresee the pensions actually changing their investment strategy based on those ratios?
Yeah, let's be clear. Right now, it's 0.6-to-1. That means they're financing about twice as much in fossil fuels as they are in clean energy. And we've got to get them financing 4 times as much renewables. That's what Bloomberg New Energy Fund, Mark Carney, former governor of the Bank of England, the International Energy Agency says is necessary to keep warming below 1.5 or at least 2 degrees. And so, yes, we want all these banks to disclose these clean energy ratios, and we are going to be taking it into account as we pay attention in the coming years to where we invest. We have done some selective divestments, for example, of fossil fuel reserve owners, but mostly what we want to do is engagement to persuade the banks, the utilities, the auto companies that represent most of our portfolio overall and who need to decarbonize in the real world on a reasonable timeline with good data. And really that's all this is basic disclosure of what your plan is for your energy transition, just like Bloomberg New Energy, just like Mark Carney, just like the International Energy Agency says is necessary for us to prevent warming at a level which not only will have catastrophic global impacts, but catastrophic impacts on our portfolio.
Although Bank of England rate setter said in November that carbon taxes, public investments, and subsidies, they're all inflationary. I know that we're concerned about inflation. I know that the people who contribute to pensions in New York City are concerned about inflation. What's your response to that?
Well, the nice thing about getting people to invest more in renewable energy and increase its supply is that over time that energy is cheaper. That's why its price has come down so rapidly. If banks will continue to scale up their investments in solar, in wind, in renewables, we'll see the price of energy come down over time, and that's why we really want to see them scale investment up.
Brad Lander, have a great day in New York City. Thank you.
Thanks so much. Great to talk to you.
All right, coming up, the countdown. Today's Fed decision will tell you what to expect straight ahead. Plus, NASDAQ says the report will bring you the numbers and a first on CNBC interview with CEO Adina Friedman. Swap boss. You like that.
NBC.
Good morning. NASDAQ futures sliding after Google parent company Alphabet and Microsoft results. A rundown of what to watch in today's trading session is straight ahead. Dow component Boeing set to report in the hour, the shadow of the 737 MAX grounding. The numbers and the market reaction are straight ahead. Plus, the rise in tech layoffs have future workers rethinking their career. We'll discuss the impact of AI and where investments are being made as the second hour of Squawk Box begins right now.
Good morning and welcome back to Squawk Box here on CNBC, live from the NASDAQ market site in Times Square. I'm Mike Santoli, along with Contessa Brewer and Robert Frank. Here are the equity index futures this morning. Mentioned the NASDAQ under pressure, still indicated down a little more than 1% after some of the slightly disappointing earnings, Microsoft, Alphabet, AMD. Although rotation into non-tech, Dow is indicated higher, as are the small cap Russell 2000 futures.
Two major tech earnings after the bell last night weighing on the NASDAQ this morning. Shares of both Alphabet and Microsoft are lower this morning. The tech giants managed to beat Wall Street expectations, but ad sales at Google came in a little light. Microsoft's revenue forecast for its current quarter wasn't strong enough for analysts.
And the Federal Reserve is due to announce its latest interest rate decision on today and is widely expected to keep rates unchanged as it's done at its previous three meetings. It comes as recent economic data, including the Personal Consumption Expenditures Price Index, it's the Fed's favored inflation gauge, suggests pressures from higher prices are easing now. Investors are hoping the central bank will provide some hints about the path ahead for monetary policy and interest rates in the guidance issued alongside the rate decision and Fed Chairman Jerome Powell's post-meeting news conference. That decision will be announced at 2 o'clock Eastern Time today. CNBC will, of course, have full coverage. Checking on the treasuries right now, you can see the 10-year heading lower at 4.028%, and the 2-year 4.322 is the yield on that. So, there's so much expectation here that we're going to get more of the same from the Fed today, that the attention is likely to all be focused on the nuance in the language.
It'll be like one word that everyone, last time it was the word any, they're always to that.
Well, they're going to probably change the statement, so we're going to have to do a little bit of, you always have to do some chronology, what happened in the room with the committee. But I do think a hold here, we keep March in play. We'll see how the market absorbs that. Our next guest, meantime, says that half her market call for 2024 for some upside has already been achieved with the S&P 500 hitting new highs in recent days. Joining us now is Savita Subramanian, head of U.S. Equity and Quantitative Strategy at BofA Securities. Savita, great to see you.
Great to see you.
So has the market behaved as you expected in terms of what's working, what's not working, how we are digesting, the economic resilience, the Fed outlook?
I think what's been happening over the last couple of days is sort of what we were expecting, which is these big tech companies are great companies, but they're priced for perfection. They're beating a little bit, but not enough to really get everybody enthusiastic, because we are already at a point where these stocks are heavily owned by the buy side. They're relatively expensive versus the rest of the market. So I think from here, the idea is, can the S&P 500 still move higher without this Magnificent Seven leading it? And I think the answer is emphatically yes. In fact, we ran the numbers, and even if the Magnificent Seven just flatlined for the rest of the year, but the rest of the market essentially grew into their long-term average earnings multiple, that would put the S&P 500 at 5,100 by the end of the year, which is a little higher than our target. So, our view is that it's pretty easy to get a little bit higher than this without the Magnificent Seven or big cap tech leading. But that's the question we get. Nobody asks, what do you think the S&P 500 is going to do? They ask, what do you think the Magnificent Seven is going to do this year? And that's where the laser focus of investors are.
And the Magnificent Seven, roughly 30% market cap of the S&P. So the rest, the 70% you're saying, if it essentially gets to where it might typically get. I guess the question is, do we have the conditions under which the rest of the market market can take advantage of the fact that the economy is doing okay, earnings have inflected higher.
Exactly.
There's been mixed results, I guess, in the current reporting season in terms of winners versus losers and what the guidance looks like.
Yeah, absolutely. And I mean, this earnings season is pretty good. I mean, it's not amazing, but we're still tracking a beat. I think what's interesting, though, is if you think about the Fed and what they're likely to do over the next few quarters. So our view is that the Fed starts to gradually cut interest rates, maybe not as much as what the market was anticipating earlier this year. But think about where the retiree assets sit. They're basically in cash, which is yielding 5%. They're making a nice spread between cash and their mortgage, their refi mortgages, which are around 3%. If cash yields start to drop, I think there is a wall of money that could move into equity income. That's not the Magnificent Seven. I mean, maybe it's a few of these guys, but it's mostly utilities, it's real estate, it's other areas of the S&P 500 that haven't really caught a bid. And I think that's where the action is. So we actually have this this new theme called the Magnificent 85. And this is, so bear with me, I know it's not as sexy as the 7, but it's basically...
There's not a movie called...
And there's no movie.
Not yet.
Not yet, exactly. It's coming. But these are 85 companies. There are currently 85 companies in the S&P 500 that offer cash or dividend yields that eclipse cash yields over the next 3 years, assuming we're at peak Fed funds rates. So we're in an environment where there are a lot of income opportunities sitting in the S&P 500 because dividend yielders have gotten so beaten down. And I think that's where the money moves. I think that's the new theme for the next few years.
And more specifically, you think that there could be opportunities in banks too.
I do, yes. I think this could be the year for banks, finally. And I mean, I guess when I look at banks, they've really been under pressure by a number of factors. One is this regulatory burden. Two, they've been, we've been in a growth cycle and there's not a real strong growth angle for banks. But I think if you look at where we are now, the yield curve is finally doing something, it's finally in that mode which has historically been good for banks. Banks are very, very underweight relative to the rest of the market. And if you look at the S&P 500 bank sector, it is pretty high quality. These are regulated companies that are potentially, more capitalized and healthier, have lower earnings volatility than the S&P 500. So this is a new bank sector. This is not 2007. This is what I would consider kind of a higher quality source of cash return. This could be the coiled spring this year because I think when you look at the financial services sector, it's been sold systematically every year since, probably around 2017 or 18. So I feel like there's a potential for re-rating on quality, cash return, a lot of these angles that haven't really been that popular for a while.
And going back to the 85 and the broadening of the market, which people have been expecting since late last year.
Yeah. That happened for a nanosecond.
Yeah, it did, and then it kind of reverted.
Yes.
And I guess a lot of that base case depends on stronger earnings. But if you look at projections for GDP growth this year, if you look at all the layoffs that we've seen, UPS yesterday, getting to be pretty significant numbers, do you think we'll get earnings growth? I don't know what the street is expecting, but certainly in the double digits. It's hard to square that with what we're seeing for the macroeconomic conditions and the fact that the labor market is just slowing. I mean, maybe not as much as some people had worried about, but certainly slowing.
Yes, so things are slowing, but I think they're not collapsing. And that's,
you'll think they'll reach those double-digit earnings targets?
I mean, so our earnings forecast is a little lower than bottom-up consensus. We're looking for about 5-6% earnings growth this year. But the point is that earnings bottomed mid last year. We're on a stronger trajectory. And as long as we don't see the consumer roll over and kind of really stop spending, and I think jobs are critical here because U.S. consumers have insatiable appetites and they really only stop spending when they lose their source of income. So that is what we're watching. And so far, you're right, layoffs have been, amping up in conversations and on calls, but we're not at a point where the labor markets are showing real signs of fraying. I think we're in a structurally tight labor market environment. We've got tight immigration, we've got this great resignation during COVID. I mean, there's not enough people in the U.S. to fill a lot of the jobs. So the layoffs have been most acute in Silicon Valley and Wall Street, but the rest of America seems like it's doing okay. There are some layoff announcements, but not enough to make us worry at this point.
And I know it's sort of semantics as to whether we're still in a late cycle environment, is it mid-cycle? It would seem to me for most of those companies that have some gearing to the economy, for them to get a multiple, for them to really be a recipient of this rotation, you'd have to have confidence spread that we kind of averted imminent recession risk.
Right. And I don't think there's a reason to question that. I mean, if you look at consumer trends, they're slowing, but they're not rolling over. If you look at the S&P 500 and earnings growth, it's much more tied to goods than services. And I think what's hitting the economy is we're seeing a normalization in services demands, because we've all gone to Europe and we've all done our travel since COVID, and I think that's where you're seeing the slowdown, which hits the economy more than it hits the S&P 500. So that's why I feel pretty optimistic about S&P earnings. I still think we're in an environment where we're all talking about everything that could go wrong, which is bullish.
Yeah, I agree with that. Sophia, great to see you. Thank you.
Great to see you. Thanks.
Coming up, NASDAQ CEO Adina Friedman talks about the IPO landscape, the rally in tech stocks, and the exchange's quarterly results. And later, Boeing set to report results in the shadow of the 737 MAX 9 grounding. The numbers and the market reaction straight ahead. We'll be right back.
Some big deal news this morning. The Wall Street Journal reports that Cigna is selling its Medicare business to Healthcare Service Corp for $3.3 billion. Deal talks were first reported earlier this month. The deal would mark a major expansion for HCSC, which is the parent company of Blue Cross Blue Shield, plans in 5 states, including Illinois and Texas.
All right, NASDAQ quarterly results out this morning. Adjusted earnings of 72 cents a share. That was a penny better than estimates. Net revenues grew 23% over the prior year to $1.12 billion, which includes a $148 million net benefit from acquisitions and divestitures, including the recently completed acquisition of Adenza. For more on the tech rally and more on the NASDAQ business, let's bring in the NASDAQ CEO and chair, Adina Friedman. Dina, good to see you.
Yeah, it's great to see you. It's great to have you here.
Coming down, yes, great to be here with you. Talk a little bit about the business. So in the fourth quarter, sure, equity markets rallied, but not a lot of IPO activity. Somewhat muted on the capital market side. That's obviously a component of your business, not the majority. Give me the profile of NASDAQ and what was driving its business leading in 2023.
Sure, yeah, we're really proud of the continued results we've been able to deliver to primarily our clients and our shareholders. We had a 7% overall organic growth and 9% growth in our solutions businesses, which continues to show really strong diversification and strength across the franchise. Key contributors this quarter were our index business and continued really strength in our anti-financial crime business with 25% growth there. And then I think that overall we had 11% organic EPS growth. Now, 2023 was a big transformational year for us. We reorganized around our divisions and we completed the acquisition of Adenza. So going into 2024, we now have another growth pillar to really drive us forward as we help our banks solve more and more of the challenges that they face in the financial system.
Right. So this is serving financial services firms, risk management type software and tools. What's the unifying vision of is it a customer base that you feel like you have a real franchise with? Is it just in general participating in this flow of financial related software and network services?
Well, actually, we basically take the foundation of us as a market operator, and we have 3 key themes that really underpin being a market. You provide liquidity, you provide transparency, and you provide integrity. And as we've grown and expanded in NASDAQ, we've really focused on those 3 key pillars. So with liquidity, we provide great liquidity in our markets, and then we provide market technology to 130 other markets. And now with Adenza, the Calypso tool provides risk management technology that enables banks to put more liquidity into the system. So then with transparency, we have our corporates and investors. We provide ESG tools, our index products, data and analytics that really help them navigate the capital markets. And then in the integrity suite, we have our anti-financial crime suite, and then this RegTech suite with AxiomSL, which really helps them manage their regulatory reporting and all of the managing criminals out of the system. So it is, to us, really thematically aligned with us as a market operator, but being a deeper partner to our clients across our technology suite.
Mike mentioned IPOs, and we're seeing a fairly stable rate outlook at this point. I talked to M&A bankers who say the pipeline actually looks really good, not just for M&A, but also for IPOs. As a wealth reporter, I like to see liquidity events, and we just didn't have many last year or the year before. What does that pipeline look to you? And is it surprising that we're not really seeing much activity yet? It's obviously still January, but what does the sort of second, third quarter look like?
Well, I would say we're off to a slightly better start this year than last year even. But we are seeing a lot more interest in coming public this year. We have 85 companies on file to list on NASDAQ, assuming that the markets are receptive. And as you know, investors need to have a pretty good understanding of what the future looks like in order for them to underwrite risk. And I would agree with you, a more normalized inflationary environment, and so therefore the cost of doing business is more known. And now that the cost of capital is going to go up and there's potential it comes down, that gives them more confidence too. So our view is that the markets will be hopefully a lot more receptive, assuming the economy stays robust in the process. I think that we'll see a much more inviting IPO environment.
Are there any big names out there that you can mention that we might look out for in the next 6 to 9 months?
Well, we don't actually specifically talk about names, but I would say we have this new IPO Pulse index that we created that tries to provide you a leading indicator as to what the IPO environment is likely to look like. And it is indicating over the next 6 months that we should be able to see a real pickup in IPOs. And that's consistent with the conversations we've been having with companies as well.
So exciting. You mentioned financial crime several times. I have the NASDAQ's 2024 Global Financial Crime Report. It's really stunning that you've been able to quantify $3 trillion in illicit funds making its way through the financial system. how does that, what kind of a headwind does that create for global business?
Yeah, it's actually, it is kind of stunning, isn't it? So the second part of that is that there's also $500 billion that's lost in fraud. So when we work with the banks, this is a huge problem. It's a problem for law enforcement, it's a problem for banks. And frankly, no single bank can solve it on their own, and law enforcement can't solve it on their own. So the need for collective action is very significant, and that's sort of a big part of the report. But also the ability to use technology and data. So, a bank can only look within their own transactions, but criminals don't bank in one bank.
Right.
So one of the great things about our Verifin solution is that we take data across 2,500 banks and create a consortium data lake that we then use AI tools, and we look at very specific criminal behaviors. Someone who's perpetrating elderly fraud is different than someone who's a human trafficker. They behave differently. So our algorithms allow us to look at specific criminal behaviors, be more effective in rooting out criminals in the system. But it is such a big problem. It will be a continuing drive for automation and innovation.
What's your perspective then on how AI, and for that matter, crypto, complicates the task of trying to monitor illicit funds?
Well, actually, I would say that, whether it's government fiat or crypto fiat, the problem is the same. It's a matter of making sure that everyone takes their responsibilities very seriously to root out those criminals, to use the tools available to them, to partner with law enforcement where necessary, to make sure that they understand how important it is to be vigilant constantly on trying to root out criminal behavior. But our solutions actually work across crypto fiat and government fiat, but at the same time, I think that it's not really how it's done, it's really kind of making sure that you're just focused and constantly vigilant on rooting it out.
You mentioned that last year was transformative for NASDAQ in the sense of the M&A, the Aden's deal. That came out of, it was previously owned by private equity. I'm wondering about your assessment of the deal environment in general in the areas you focus on, because if I look at the public share prices of the index providers like the MSCIs and S&P Globals, FICO, Fair Isaac is one of the craziest stock charts we have. It's going to the moon. So this idea of kind of this repeatable revenue stream from financial-related data is in demand. Does that mean that things are too expensive to acquire, or how do you think about filling out the portfolio?
Well, I mean, first of all, we really do, despite the fact we've been doing some acquisitions, we've spent a lot of time on organic growth. But one of the great things about our business is it is so data-driven. And that means that in the world of automation, in the world of digitization, that data is in high demand. And when you think about the ability to execute orders in the markets or navigate the capital markets more successfully, it is all about the data. So those who have what I call gold source data, proprietary data sets, are ones that, especially in the world of AI, I think are going to benefit a lot, and I think that investors understand that. So within NASDAQ, we have our market data, we have the anti-financial crime suite of data that really is quite unique because it's across so many banks. And then we have proprietary data for asset managers that really is a really unique data set, as well as for investor relations. So we are saying, okay, how do we take that automation and apply it to these data sets in unique ways to make all of our clients do their job more efficiently? And efficiency is return. Like if you can deliver an ROI on that, your clients are going to have constant demand for your products. And I think that's across the entire sector. Is information businesses are just, we also have a really strong cash flow that comes off that very consistent cash flow. So investors, it's a good investment.
I always point to those stocks when people say everyone's obsessed with tech or the Magnificent Seven, which of course are NASDAQ companies for the most part, because it really is more the underlying business dynamics that people love, which is the data utility type.
It is, the data utility, and then thinking about applying digitization to that. So then partnering with those technology companies to really unlock the potential of that data.
Dana, great to see you.
Yeah, it's great to see you too. Thank you. Thank you.
All right, coming up, companies in the tech sector have been on a layoff spree as they shift their investment strategies to focus more on AI. So we'll move by Amazon, Google, and others reduce future demand in the space. We'll discuss that. Take a look at the futures. Right now, you see the NASDAQ 100 futures still down about 1% in the pre-market. S&P 500 off by a bit less than 0.5%. Dow indicated higher by about 55 points.
Time now for today's Aflac Trivia question. Microsoft's first headquarters was located in what city? The answer when Squawk Box returns. And now the answer to today's Aflac trivia question. Microsoft's first headquarters was located in what city? The answer? Albuquerque, New Mexico. In 1979, the company moved to Bellevue, Washington, before relocating to its Redmond corporate campus in 1986.
Coming up, Boeing quarterly results and other stocks on the move in the pre-market. As we head to break, here's a look at the pre-market winners and losers in the S&P. Take a look at Paramount. That's up 17%. That's on the report that Byron Allen has made a $14 billion discussion. I don't know if it's a formal offer. I don't know exactly where the financing is going to come from, but obviously a lot of discussions around a possible bid there. That, of course, follows that report that Skydance may also be interested. And so a lot of action around that stock. Squawk Box. Be right back.
twitch.tv/TV.
a.m. in New York City, and Boeing quarterly results are just hitting the wires. Let's get to Phil LeBeau, who's looking at the numbers. Hi, Phil.
Hi, Contessa. This is a beat on the top and the bottom line for Boeing in the fourth quarter, with the company reporting a smaller than expected loss of 47 cents a share. The street was expecting a loss of 78 cents a share. Revenue coming in better than expected at $22.02 billion. And then the numbers within the numbers in the fourth quarter, operating margin positive 0.4% compared to negative 3.2% in the fourth quarter of 22. Free cash flow, $2.95 billion. That is a little below where they were in the fourth quarter of 2022. But more importantly, they do hit the guidance for 2023 free cash flow of between $3 and $5 billion, coming in at $4.43 billion. They also, in the fourth quarter, are taking a charge in the defense group of $139 million. Now for what's really driving the stock today, Boeing's guidance. The company is postponing its 2024 guidance in light of what's happening with the 737 MAX, as the company is wrestling with the safety culture issues that are front and center, which is now capping MAX production at 737 MAX production at 38 per month. Remember, the FAA has said it needs to get the FAA approval before it can increase production. 787 production has hit 5 per month. Boeing is not changing, nor is it reaffirming its guidance for 2025-2026. Remember, that guidance was to have MAX production hit 50 per month in the 25-26 timeframe with $10 billion in annual free cash flow. And again, the company not mentioning it at all in this earnings release. So they're not pulling it, but they're not reaffirming it. No doubt this will come up on the conference call with analysts a little bit later on this morning. In a note to the employees here at Boeing, CEO Dave Calhoun said, well, we often use this time of year to share our or update our financial and operational objectives. Now is not the time for that. We will be talking with Dave Calhoun, a CNBC exclusive you do not want to miss, coming up at 9 a.m. on Squawk on the Street. Guys, we're going to be talking about the fact that they are not mentioning this long-term guidance, even though they have pulled their guidance for 2024. And again, in the fourth quarter, Boeing doing better than expected with a loss of 47 cents a share. The street expecting 78 cents a share loss. Guys, back to you.
We've watched the shares, as you've been talking, which were negative in response to this, now turning positive, up by almost 0.5%. On the call, what are analysts likely to focus on here, Phil?
The guidance. And if you're not pulling your guidance, you're not reaffirming it, does that mean that Dave Calhoun and his team believe, look, it's only a relatively short time before we believe that we can show to the FAA that we have put the safety protocols in place so that we can increase monthly production of the 737 MAX? That's it. That's the primary question that Dave Calhoun and his team will be facing in terms of what analysts want to hear about.
All right, Phil LeBeau, there you have Boeing up now 1% in the morning. We'll continue to monitor that throughout Squawk Box. Let's get to Dom Chu with a look at this morning's pre-market movers. Good morning, Dom.
And good morning, contestants. So we know that Alphabet and Microsoft earnings reports are shaping a lot of that pre-market narrative alongside Boeing this morning. But outside of those reports, we've got other big-name earnings movers and a notable analyst call out as well. So we'll start with Advanced Micro Devices. Those shares down now roughly 4.75%. That's off the pre-market lows, by the way. Just around 700,000 plus shares of trading volume so far. The computer chip maker reporting profits that were in line with expectations on better than expected revenues, but the outlook for their current quarter revenues missed consensus estimates, and AMD says it expects revenue in its data center segment to be flat on a sequential quarter-over-quarter basis, so that's driving the downside move down nearly 5%. On the consumer front, you got shares of Starbucks, which are up roughly 3.5% or so, nearly 100,000 shares of volume. The coffee giant actually did report quarterly profits and revenues that both came in shy of estimates, a miss on both. But there was some optimism that the results weren't worse. Now, global sales growth at established restaurant locations, that so-called global comp store sales, really kind of came in below estimates because, due in part anyway, to competitors in China turning towards discounting to gain market share in its second biggest market, so Starbucks up about 3.5%. And by the way, We will get much more on that story later on this morning when Starbucks Chief Financial Officer Rachel Ruggieri joins Squawk Box at 8:30 a.m. Eastern Time. A big interview there. And we'll end with Tesla. The electric vehicle giant is right now just down about 2.5%, over 600,000 shares of volume, down partly in line sympathy with the rest of the down tech tape, and down perhaps on some of those headlines of a court rejecting CEO Elon Musk's $56 billion pay package, but also out this morning as well. Analysts at Baird have named Tesla as a fresh bearish pick, citing that pay package rejection acting as an overhang on the shares. Also, the potential impact to its current quarter delivery numbers, given the Red Sea shipping disruptions that we're currently seeing. So, Robert, Tesla shares down 2.5%, big names on the move. I'll send things back over to you guys.
Yeah, Don, you would think if Tesla doesn't have to pay Elon as much, or they're going to get back some of that money that they had as part of the pay package, you think that would help the stock. So I'm glad you mentioned those other drivers of the stock this morning, because just purely on the pay package issue, you think that would be helping the shares.
It also depends, Robert, what does it mean for Elon Musk? Does it improve his focus on Tesla or not?
I think he'll be okay. I think he'll be okay. Don, thanks so much. Up next, Capitol Hill trying to get a vote as early as today on a bipartisan bill to expand the child tax credit, provide some tax breaks for companies. We'll discuss after the break. Future head of ADP private payroll data, Squawk Box. We'll be right back.
CNBC.
House leaders have notified members that the $78 billion tax package will get a vote today. Joining us now to break down the new bill, Gene Ross covers tax policy at the Center for American Progress, and Rohit Kumar is the co-leader of PwC's Washington National Tax Services. Guys, thanks so much for joining us. Gene, I want to start with you. There's been some analysis from, I guess we could say, some conservative groups that perhaps show that this could lead to some full-time workers switching to part-time because of the child tax credit, or even some people not working altogether, there's an estimate from AEI that says maybe a net 150,000 workers could stop working because of the incentives from this child tax credit. What do you think are the potentials for that?
First, I think we should look at the upside of these improvements, which is 16 million children, more money in those households, helping parents to pay the rent, put food on their children's table. There's a large body of research on the question of what do these credits mean for work, both the child credit, long-time earned income tax credit. And the academic research firmly shows us that there is virtually no measurable impact on work. Even with the much larger expansion of the credit in 2021, that was true. So I think that's really a cover-up or a smokescreen for people who oppose expansion of this credit overall.
Yeah, it's hard to imagine, though, since the refundable portion of the tax credit is now so much larger, there's estimates that I think you can't argue with, that there's an equivalent of a 14% tax rate increase for switching from part-time to full-time work. How does that not have any impact?
Well, we're still looking on the margins at not enough money for a family to live on. We're looking, for example, at a single parent of two earning $22,000 a year as a child care worker, $675. That's not enough for somebody to decide they're going to move out of the workforce. It is enough to buy winter clothes for those two children, can buy school supplies, help make ends meet for a family.
Yeah, Raheed, it's not surprising that Congress, when they agree to spend more money. The concern that I have that really hasn't been looked at much, I think, is the pay for it here, which is, of course, the employee retention tax credit. The idea that by shutting that program down early and perhaps rooting out fraud and even prosecuting this, that we'll get somewhere between $77 and $79 billion in the next 10 years to pay for this. Are you confident that we're going to really get a pay for this through that retention credit?
Yeah, no, I am. I mean, look, this program was only estimated to cost $50 billion when it was first enacted. And then Congress loosened the eligibility requirements. This was in the midst of the pandemic. And so now the claims have rushed in at a volume that was frankly never anticipated. This might be, to my mind, the most real pay for, the most real offset that Congress has considered in a generation. If we don't make this policy change, if we don't say, look, amended returns have to be filed by actually today, then the IRS is going to pay out tens and tens and tens of billions of dollars of more of these claims. Some of them would be legitimate, some of them might not be. But the truth of the matter is this was a pandemic-era program, and if you're around today to file an amended return, you made it. Congratulations. And clearly you didn't need this money to survive, and I think that's the judgment that Congress is making.
But isn't a lot of that money, and there is clearly, there's an estimate that 95% of the payments on this program are fraudulent, which also tells us that maybe all the money is already out the door. So the idea that you're going to save an additional $79 billion in the next 10 years from this, especially because in order to get that back, you're going to have to prosecute the IRS, so you're going to have to go to court to prove fraud and to get that money back. That could take years and years and years just to get back. And this legislation was so poorly written and so broadly written for this tax credit that it's highly possible that no one actually violated the law. It was just a badly written piece of legislation.
No, this is not the issue of going back and getting claims that were already filed that might be fraudulent or the like.
But this is about saying they're saying that some of this money will be gotten back from the IRS prosecuting this and getting money that's been fraudulently taken as a tax credit.
Look, yes, a very small amount. The vast majority of the $80 billion that will be saved by making this change is by saying all amended returns have to be filed by the end of January. If we didn't make this change in law, people could continue to amend returns and file until April 15th, 2025. So they're cutting off a year and change of additional claims that we filed. It's those claims, or the fact that those claims now will no longer be considered, that the savings are generated. Some of it might come from
prosecuting fraud and things like that, but really it's shutting the program down effectively a year and a couple months earlier than it would have otherwise been shut down.
Yeah, they would shut it down, I guess, today.
That's right, yeah.
Okay, one last question on the business side of this. You make a great case for how this really helps those most in need, the low-income households and taxpayers. On the business case, what was interesting to me is you're rewarding businesses for things that they have already done. And so perhaps the stimulative element of this tax change may not be that strong. What do you think of the business givebacks on the other side of this legislation?
Yeah, I mean, look, these are the real growth drivers, the long-term economic growth drivers of the proposal. The retroactivity, especially for the treatment of research expense, look, there are thousands and thousands of small businesses that just had no idea that this change had happened. And when they rolled up to, file their 2022 taxes, got hit with a huge tax bill. Not just sort of like, this is a pain or I have to delay an R&D project. This created a liquidity event for these companies. People are dipping into their retirement savings, getting into installment plans with the IRS. And so the relief, if Congress enacts it, will sort of solve the wound for those businesses so they can go back to hiring, go back to doing R&D. I mean, these are kind of the lifeblood of the economy, and Republicans are getting not only that, but they're getting a child tax credit that lives by their 2017 standard in terms of eligibility criteria, incentive to work, and the like. So, look, every Republican that I've talked to feels pretty good about the terms of the transaction, and I think we're going to see a big bipartisan vote this evening in the House.
Yeah, and Gene, just quickly, there was an effort by Republicans to get that SALT cap lifted. Is a huge concern to those in blue states like New York, New Jersey, California, lifted from $10,000. That really, once again, fell by the wayside. Do you think that has any chance in this legislation or anything coming up, and should it?
Fortunately, it will not be part of this package. I think that should be considered separately. 2025 would overwhelmingly benefit the highest income households. I think this is a modest package. It's a compromise package. We think that the business provision should have been paid for by raising the corporate tax rate that they were initially designed to help pay for, but this is a good package and deserves a big vote.
All right, and they're actually going to vote on it maybe today and get something done, so that'll be interesting. Gene and Raheem, thanks so much for your time. We appreciate it.
Interesting, interesting adjective to use there. Interesting. Still to come, layoffs in the tech sector mounting as companies like Google and Microsoft shift their investment focus to AI. Will the move reduce future job demand in the space? That's next. And next hour, Starbucks CFO joins us to discuss the company's latest quarter. That interview in the 8:30 Eastern Time half hour. Do not miss that. Squawk Box will be right back.
Layoffs in the tech sector are mounting. PayPal is the latest company to announce job cuts, slashing around 9% of its global workforce, about 2,500 jobs in all. This follows layoff announcements from Microsoft, Amazon, Alphabet, Block, and eBay, just to name several. Joining us now with whether AI has played a role in these cuts, Alex Kantrowitz, founder of Big Technology and CNBC contributor. Alex, good to see you.
Great to see you too.
Probably some differences in terms of what's happening at these individual companies. I mean, PayPal stock's been under a lot of pressure. They're trying to kind of reorient the company. eBay, slowest growth. But then you have the very profitable, large winners of tech that seem to be doing this ongoing pruning. What seems to be driving that?
Yeah, totally right. PayPal, that struggles. Google, why are they laying off? What I read from the call yesterday, what you heard Ruth Porat talk about, is that this is a culture thing. They're trying to build faster, and they're finding levels within the companies that's just holding them back. So they need to build faster. They understand they're under threat. This AI thing is real, it's not going away, and they can't have people holding them back. And so what they've been doing over the past year is finding places within the organization that they can trim so that they can get to a pace where they're shipping faster, so taking managers out, and then engineers who are skilled for a previous generation of technology, they're also leaving to make room for people who are more skilled for artificial intelligence.
So making room for other human beings who are skilled in executing the AI strategies, not necessarily somehow their jobs are getting automated.
Oh, definitely. This isn't like a moment where you're starting to see AI replace engineers at Google. Absolutely not. It's more about who can build the new generation of AI technology for us. Let's make room for them, give them room to run within the organization, not be held back by managers who are so skilled in the old technology but are not able to handle the new.
You know, there was a lot of hype on both sides of what Elon Musk did with the former Twitter, with Action, just like eviscerating the staff and then just running the business, you know, with a fraction of the previous headcount. I don't think any other company looks at that and says, hey, great idea. But maybe there's a revelation that over the huge growth period, and it is a time of labor scarcity and, you know, around the pandemic, that these companies just kind of added and added and added and preserved more people than were necessary to do the work.
Yeah, I ask every tech CEO, do you take inspiration for what Elon does? And they'll say on the record, no, we don't. We would never want to do that. But you know, in the group chats, they're all like, wow, that was an amazing move. We love that. How can we?
We're glad he did these. Yeah, we didn't have to
do it. He cut 70 or 80%, so if we cut 40, it's not that bad. That being said, you cut a lot of people in sales, and they've been struggling to make the same revenue numbers. So I don't think any executives want to cut the way that Elon cut, but they do see that you can cut a lot of people and still keep the business running.
And the engineers that are getting laid off here, you mentioned that they're sort of more well-versed in the non-AI, old-school technologies. Are they finding places in other companies? What's the demand for those workers? And the manager is probably even tougher, right?
Yeah, absolutely. Look, if you are hiring in this environment, you spent the last 5 years in the zero interest rate world trying to poach from Google and you've been unsuccessful. Now some of those mid-level Google engineers are shaking free. This is your dream. So you just need to hold your hand up in this job environment if you're a former Google engineer and you're going to get offers. Now there are some companies that are going to be a little bit reticent because Google has been viewed by the tech world as a summer camp where you don't have to do much. And it might be a shock for those people within Google to go find new employment. But that being said, you know, this is a job seekers market, right? They can go and get that work.
Are you seeing any impact on return to office? In other words, as the job market in tech becomes tighter, you see more people getting laid off. Is there perhaps a more of an imperative from these companies to come back to the office, or is that not really part of it?
Yeah, there are loopholes, right? If your best performers are not coming back to the office, you're not going to fire them, right? So there's going to be this like two-tier thing where like the 10X engineers don't really have to come back, and then the rank and file will. There might be some tension there. Also, a lot of people are going into the office, badging in, going home, working from home. So I don't expect to see the mass cuts from return to office that a lot of people are talking about.
Real quick, because some of those laid off by Elon Musk probably gleeful over the judge's decision to deny his compensation. What do you make of that?
You know, Elon's making just way too much money, right? $50 billion is too much.
But look at the value he's created. That went from $60 billion in market cap to $650. Who's to say?
Well, it went from $1.2 trillion for a minute. Now it's back to $650.
So look, he's definitely entitled to make some money here, right? But $50 billion is just, do we not have a problem with CEO pay in this country? That being said, to go this route, to go through the court, they say, well, we didn't really understand that he knew the fact that they were going to make these benchmarks. Like, come on. Like, they've gone from 50 billion to 650 billion. No one predicts that. If they predicted that, they'd be buying more. And they're now saying, okay, so he has Tesla stock anyway, so he's fairly compensated. That's such a ridiculous argument.
So it's interesting timing that right before this ruling, he said, I deserve more shares for this AI reason, so it's not about the money.
Yeah, maybe he knew it was coming, but you're just like, you can't do that from if your court. You can't retroactively 4 years of pay, say, he didn't earn it. Of course he earned it.
What if he had sold some of those? What if he exercised those options?
That's the fascinating part.
Yeah, allowed to, not now, over years. But maybe this sparks a needed conversation about CEO compensation in this country.
All right, Alex, good to talk to you. Thanks a lot.
Thank you.
Still to come, private payroll data from ADP, the numbers and the market reaction, plus Starbucks CFO Rachel Ruggieri joins us to talk about the company's latest quarter, the state of the consumer, all the different kind of notes they now have. Squawk Box. We'll be right back.
NBC.
Good morning. Futures mixed on this final day of January. Tough tech earnings weighing on the NASDAQ and the pre-market. And speaking of earnings, Boeing is out with new results. We speak with the top analysts about the quarter and the hurdles ahead for the company. Fed in focus. The U.S. Central Bank just a few hours away from its latest rate decision. What do investors need to know? We'll get into that as this final hour of Squawk Box begins right now.
Good morning and welcome to Squawk Box here on CNBC, live from the NASDAQ market site in Times Square. I'm Mike Santoli, along with Contessa Brewer and Robert Frank. Joe, Becky, and Andrew are off today. Take a look at U.S. equity futures at this hour. Still some pressure on the NASDAQ. It's indicated down by almost 1%, but it has firmed up over the course of the morning. Earlier it was down about 1.25%, now down less than 1%. Microsoft, which had beat on earnings last night, but had a sell the news reaction, has also firmed up a bit. The Dow, you see, indicated higher as rotation happens into non-tech, small cap futures also are firm this morning. Treasury yields, take a look at on a Fed day. We are expecting no change in rates today, but the market's trying to figure out what the message is going to be about the pace of potential rate cuts down the road. 4.024 on the 10-year yield. That has come in from about 4.14 a couple days ago at the highs. And you also see the 2-year note yield connected to Fed policy, 4.31. Among today's top business stories, Boeing, the big quarterly report of the morning, the company posting a smaller than expected loss and revenue above expectations. Boeing is also postponing 2024 guidance in light of the problems surrounding the 737 MAX aircraft. In a note to employees, CEO Dave Calhoun said, now is not the time for the company to update its financial and operational objectives. Don't miss an exclusive interview with Dave Calhoun next hour on Squawk on the Street. We're also going to get deeper into this story later this hour with a Boeing analyst. In other news, a Delaware judge voiding Elon Musk's $56 billion Tesla pay package, ruling the company's board failed to prove the plan was fair or show much evidence the board members even negotiated with Musk. The judge noted the pay scheme granted to Musk in 2018 was the largest in the history of public companies. But some shareholders weren't happy, including the one who brought the lawsuit, the current lawsuit against Musk. He may appeal the decision to the Delaware Supreme Court. Like many other companies, Tesla is incorporated in Delaware. Following the ruling, Musk posted a poll on X asking his followers if Tesla should move that incorporation to Texas. And media mogul Byron Allen bidding $30 billion for all outstanding shares of CBS parent Paramount Global. The $30 billion includes outstanding debt. In a statement, Allen Media Group says it believes its bid should be taken seriously and pursued. Paramount has received interest from other investors recently. Changes in the entertainment business have forced Sherry Redstone, whose family controls Paramount, to consider offers.
Another stock to watch today, Chubb. The global insurer sees shares rising after earnings beat the street, results helped by stronger underwriting and investment incomes. The company's conference call starts at 8:30 a.m. Eastern Time, and in the pre-market we've seen shares increase. But I want to point out for this insurer, they say it was the best year ever. CEO Evan Greenberg said that it was a blockbuster. They are reporting here for the full year, core operating income up 45%, the net income up 72% year on year. Partly this
72%.
That's right. Partly it's because of much stricter underwriting discipline. They are not going out and insuring high risk customers anymore, or they're charging way more for that coverage. But also it has to do with interest rates are higher, so fixed income investments are returning more money. And you're also seeing, and I've heard a lot of people complaining about what their car insurance costs, what their home property insurance costs. Part of that is they're starting to get the rate from regulators state by state to charge what they think the risk is worth. And we've seen that from travelers reporting as well. In the fourth quarter, it helps that they didn't have those catastrophe results that some of the insurers had seen.
I mean, they really, as you say, they're like the luxury brand of insurance. I mean, I cover high net worth. If you're wealthy, that's your insurance company. I think those people tend to care less about rates and more about the security. And that's such a privileged position to be in, where it's hard to brand yourself as a luxury product when in a business that really ultimately for people just comes down to premiums.
And what we're seeing, for instance, in Florida is people choosing, if you think that you want to insure a multi-million-dollar property, you are now going to the excess and surplus lines, which brings and delivers a premium into an insurer like Chubb, or many of them are self-insuring. They're just saying, like, if a hurricane hits, if it destroys this home, I'm going to eat the cost.
Or like when But anyway, we're awaiting today's Fed's decision due this afternoon at 2 p.m. Eastern Time. Central Bank is expected to hold rates steady, but investors will be sifting through Chair Powell's comments for clues about when the first rate cut might come. Joining us to talk about the Fed, the economy, markets, insurance, banks, Bob Diamond, Atlas Merchant Capital CEO. Bob, thanks so much for joining us this morning.
Glad to be here, Robert.
So early last year, you were absolutely right. You predicted that there would not be interest rate cuts in 2023. You were right. What are you looking at for 2024?
I think there can be cuts, but I think we have to take it in the context that the economy is actually accelerating. You know, the first half of last year was about 2%. The second half of last year was 4%. I think the Fed is absolutely delighted with where the economy is, where inflation is. And I think if the Fed did cut in the first half of this year and the economy began accelerating more, and worse, if inflation picked up, that's exactly where the Fed does not want to be. So I do think we'll see more neutral language, today. I don't think it'll be hawkish, but I think the expectation of first half cut rates, I think, are ahead of where the Fed would want to be.
But just because the economy is strong doesn't mean that rates aren't restrictive. The real rate, as inflation has come down, is much larger, much higher than it should be. Isn't there room for them to cut even if the economy slows a little bit but is still strong?
I don't think so. I think if the risk for the Fed is, accelerating the growth of the economy and inflation, and I think as you talked about in insurance, not everyone wants rate cuts. So financial services, insurance, as you were just talking about, they're definitely benefiting from higher interest rates. A lot of savers are benefiting from higher interest rates. But most importantly, if you look at the average funds rate since the financial crisis in 2008, it's like 1%. If you look at the average fund rate for decades and decades and decades before that, it's more like 4%. So I don't think they're anxious to cut. I think they're prepared, if necessary, to cut. And I think they have room to cut, which is really important from a policy point of view. But I think we're looking at it probably, unless there's a big change, I think we're looking at the end of the year.
So you think 25, 50 basis points for this year?
I think for this year, 25 to 50 is probably what we'll see. I think the markets are discounting more like 125 to 150 by the end of the year. So I think the markets are just a bit ahead of themselves. I don't think that's bad news, Robert. I think it's because the economy is doing pretty well, and particularly relative to China. We have stronger growth in China relative to Europe. I think the ECB may be cutting in April. So that's a different situation. They're facing a weakening economy and somewhat high rates relative to where they've been. So I think we could see, using monetary policy and easing in April in Europe, but I don't see it in the U.S.
I mean, the Fed, for better or worse, they have their models and they have their stated framework. And their models say the neutral rate for Fed funds is under 3, well under 3 probably. They're at 5 3/8 right now. We have an economy where their PCE inflation number is breaching 3 to the downside. So in other words, if you started from 0 and say, what's the appropriate Fed funds rate for this environment we have right in front of us, they wouldn't probably say 5 3/8. So therefore, I wonder if that's why the market's kind of happy about the idea that these rate cuts would be trimming and maybe 1995 style. Hey, we're just going to tweak around the edges just so we're not overshooting on the upside.
Mike, I would keep in mind that one of the reasons we got into this situation is the Fed waited too long to raise rates. And they recognized it, and they talked about it. It wasn't transitory. So, inflation was up to 9%, and it looked like it was raging and it can go to double digits. And the Fed has played a blinder. And I think right now, they're very pleased with, and I think the rest of the world looks at the U.S. and sees this soft landing of 3 to 4% economic growth, inflation trending toward 2%. It's great. Why get ahead of it? And so I think providing supportive monetary policy right now has a larger risk of accelerating growth and accelerating inflation. And I think they want to keep their powder dry, and they're going to have supportive monetary policy when it's necessary.
And there are industries that like the rates being this high. I just mentioned Chubb. We saw it with travelers that had phenomenal return on equity when they reported earnings. So it's not bad for everybody, even because the market wants them to be lower. How long do you think we can just glide in the sweet spot?
Well, that's the big question. And I think the Fed will have neutral language. I think they're going to be very data dependent.
But to your point, in terms of the economy, there are whole sectors of the economy that benefit from higher interest rates. Financial services is probably the single best example. You're seeing it in insurance, you're seeing it in the larger banks, you're seeing it in the easing of some of the conditions around regional banks that had a bad reaction to SVB just almost a year ago. So their portfolios are doing better, and I think we're in a pretty good position.
Bob, great to have you here. Thank you so much for joining us.
Good.
Biogen is halting the development and commercialization of its controversial Alzheimer's drug, Aduhelm. The U.S. regulatory process for that drug drew intense scrutiny over whether its benefits outweighed its risks. Biogen will continue to advance Leqembi, the Alzheimer's treatment that was granted full approval last year by the FDA, and will accelerate development of other potential new treatments. Biogen said the decision to discontinue Aduhelm is not related to any safety or efficacy concerns, but because it was unable to find strategic partners or external financing for the program. The kiss of death for the drug came when Medicare decided to limit coverage of patients in clinical trials, effectively cutting off access from most Medicare beneficiaries to this expensive treatment.
Coming up, breaking jobs data. January's ADP employment report, the consensus estimate, a gain of 150,000 jobs versus last month's 164,000. We will be right back.
We're approaching January's ADP employment report. The futures right now still a little bit mixed. The Dow Jones up a bit, S&P and NASDAQ down a bit. We'll get Steve Leisman coming up in a bit. Steve.
Thank you very much, Robert. Thank you. January ADP coming in at 107,000.
That's a miss compared to the expectation of 150,000. Remember, they're just measuring private payrolls. The estimate was 150 coming in at 107. Good sector doing okay, plus 30 services doing better as usual, up 77,000. And there's the non-farm payroll estimate of 185,000. That's Friday. Remember, that includes government and the private sector as well. So it's always going to be a little bit different, but in this case, maybe quite a bit different. We'll see what happens. December ADP revised down slightly from 164 to 158. I do want to highlight here the change in their wage calculations, which jobs data is down to 5.2%, down from 5.4 in December. That's the slowest rate of wage gains since August 2021. Job changes 7.2. That's a big drop from the prior month and the smallest annual gain since May 2021. It highlights the data coming in at 8:30, the Employment Cost Index, which is something that Powell watches very closely. Looking at jobs by business size, the small business sector has been keeping pace with medium and large. There was some concern as wages went up, small business would not be able to keep pace, but they have been up 25,000, medium up 61,000, large employers greater than 500 employees up 31,000. And some of the job growth coming from expected sectors, some of it coming from unexpected sectors. There's leisure and hospitality right at the top of the list, as it's been throughout this post-pandemic recovery period, up 28,000. But trade, transportation, and utilities also doing well, up 23,000. You'll remember that UPS just announced a big layoff that would not come into this, but it is interesting to see the strength there. Also interesting to see the strength in construction, but education and health services, another perennial source of job strength, up 17,000, while the information sector down 9,000. Contessa, ADP has been hewing much more closely to the BLS private sector data over the past several months. I'll just look up here. The difference has been over a 3-month period on an absolute basis, plus or minus 34,000. So that's pretty good for kind of forecasting the BLS, at least the private sector section, and we'll see if that causes some people to think, you know what, maybe that estimate we have for the Friday number is a bit hotter than it should be. Yes,
All right, Steve, thank you very much.
I was just going to say, bond yields did react a bit on this news to rally a bit, so yields down a few basis points, Steve, implying people are reading through the Friday number.
Okay, so Steve, if you'll stay with us, we want to get more on the data and bring in Neil Richardson, ADP chief economist. So you got like a head nod there from Steve about the accuracy of the data and how it compares to the Bureau of Labor Statistics. Neil, give us a sense of what this says about the U.S. economy.
Good morning. I think what we're seeing is a solid but slowing economy. You can see that in the jobs numbers. Now, remember, January is going to be an active month in both of these indicators for the NER and the BLS number, because we both re-benchmark to the QCW to make the numbers representative. But if you see through that technical update, what you see is a labor market that is slowing, particularly in industries tied to services and white-collar jobs. So there's actually 3 different narratives going on in this labor market. There's the slowdown in manufacturing that we've seen for the last few months through 2023. There is the resilience of healthcare and education, as well as leisure and hospitality. Those sectors affected a lot by the pandemic. And then there is the slowdown in information, finance, and technology, and the hiring, where hiring was on potential during the recovery, and it seems to be easing now that we're out of the heated job growth that we saw in 2022, early part of 2023.
We saw a real resurgence in union activity and pressures for new contracts from writers and actors, from casino workers, which had an historic contract come through last year. And for UPS, and then yesterday they said, okay, well, we're going to lay off 12,000 people. Are we going to see the after effects of these historic new contracts, Neela?
Well, yes and no. For ADP data, those contracts were built on the backs of striking workers, as well as negotiations. Now, we measure employees on payroll. So even if they're striking, whether they got paid or not, they're still on payroll. So they're not going to come up immediately. And if you look at the broader industry, it depends on which one, because a lot of industries, especially for white-collar jobs, maybe even tied to the information sector, you're going to see large firms pay severance, which means there's not going to be an immediate pickup in the initial jobless claims numbers that we all watch every single week. But what I will point to is the premium. Steve mentioned the pay growth numbers for job changers and job switchers in the ADP data. That premium of switching jobs has sunk to a low of 1.9%. To give you a reference number, it was above 7% at the beginning of 2023. Now it's the lowest in several months, including before the pandemic. So the gains from switching in this market are very, very low, and it means that the market has cooled a lot since this time last year and the year before.
Well, that's a real switch, Steve, from what we saw last year when people got a boost if they left their current jobs for new jobs.
Yeah, and I think if you take a step back and test it from this data, the thing that you see is perhaps just things getting back to normal. 100,000 on the private sector, that's a pretty good number in normal times. But remember, we're coming off of 200,000, 300,000, 400,000 as this job sector was still adjusting to the post-pandemic period. So what you see when you look at the 3-month average, for example, of job growth in the ADP number, it's around 130,000 or so. What you would see, hopefully, when we get past, remember, as Neela said, the BLS data is going to be a little corrupted by returning strike workers, leaving strike workers, that kind of stuff. But the private sector number was probably was stronger because of that reason. So it's interesting to see things get back to normal. And for the market, and I think Mike is really good on this issue here, which is you see things coming down to normal, and how much concerned you are that it keeps going down. Do we come down or do we level off? So that's what we're watching now. Things getting back to normal, and whether or not they stay at normal or do they sink a little further.
Yeah. All right, Steve, thank you very much. Neela, thank you for joining us on the numbers. Appreciate that.
Thank you.
Coming up, Facebook parent Meta under fire from New Mexico's Attorney General. He charges the company with failing to protect children. We'll hear from him after a break. Squawk Box will be right back.
Welcome back to Squawk Box. New Mexico's Attorney General is suing Facebook and Instagram parent Meta for allegedly failing to protect children from sexual abuse, online solicitation, and human trafficking. Eamon Jabbers joins us now with a special guest. Eamon?
Yeah, Robert, that's right. We've got this massive social media hearing expected up here on Capitol Hill today. We are expecting to see Mark Zuckerberg of Meta, and I'm here with Raul Torres. He is the Attorney General of New Mexico. And Mr. Torres, you've been suing Meta over the past several months. You engaged in this epic lawsuit with them, alleging that basically Meta is not doing enough to protect children, in some cases actively aware of problems that they have, and not solving those problems in order to protect children. I wonder if you can tell us how your investigation is coming so far and what you're finding.
Well, we initiated this investigation after numerous public reports that Meta executives have known for years that their platforms were a breeding ground for pedophiles, for predators, and what we did was to create an undercover account, and what we found was truly shocking. It was an account that was a fictitious 13-year-old, and she was simply inundated with images and targeted solicitations, which, frankly, I found to be shocking, because when I started doing this work 20 years ago, all of this kind of graphic information were, they were in the dark corners of the web, and I was surprised at how readily available this was and how easy it was for predators to target underage people.
Some of what you've been finding is emails between Meta executives themselves talking about this inside the company, and in some cases acknowledging, it seems, that they're aware that there's a problem. One of those emails talks about using the Meta services as a way for pedophiles and other really sick people to find their targets. Can you talk to me about that email and what you're seeing?
Well, it's from a senior executive in the company warning other executives about some of the features that facilitate this kind of targeting and this kind of sexual exploitation of children. And what it really does is demonstrate a pattern of safety officials within the company who have repeatedly raised these concerns. Many of those concerns elevated to the highest levels, including Mr. Zuckerberg, and those recommendations, those warnings were ignored repeatedly. And that's
Are you saying that Mark Zuckerberg himself has ignored warnings about the safety of children on his service?
Absolutely. It is very clear to us that the warnings that have been issued throughout the company over numerous years have been elevated to the various highest levels.
So Mark Zuckerberg is going to be here on Capitol Hill today. Obviously, you're going to be at the hearing yourself. What will you say to Mark Zuckerberg if you run into him personally today?
He needs to do the right thing. I mean, bottom line, he's a parent. He's not just a business executive. He needs to start acting like it. He needs to come clean with policymakers and with the users and business partners. They have the resources, they have the technology, they have the ability. They just need to have the will, and they have to have the commitment. And what I need to remind him through this lawsuit, and I hope policymakers do the same, is that we don't just believe in building businesses in this country, we believe in building ethical businesses.
Look, the company says, we're addressing this. They announced just last week a whole slate of proposals that are going to change the way the systems operate in terms of adults contacting children, that sort of thing. And they say, look, we're in a sense a victim ourselves. We're, a service that's open to the entire population. There are bad people in the world. Bad people are going to use our service. When we see it, we stamp it out. Right? What do you say to that?
Well, I think they should have done this years ago, and they shouldn't have had to wait until they were sued by myself and other attorneys general from across the country. And by their own reckoning, nearly 100,000 children a day receive sexually explicit material or targeted for sexual harassment, and that's unacceptable.
Just a couple seconds left here. Last question for you. What's your ultimate outcome? What are you trying to achieve?
They need to change the way they do business, bottom line. They need to put the interests of their users, and particularly children, front and center, and not place their own profit ahead of the safety and interests of the people that they should be protecting. And that's the most vulnerable members of our community.
Raul Torres, Attorney General of New Mexico, thanks so much for being here on CNBC. Really appreciate it. Tessa, let me toss it back over to you in the studio.
And Vermont Senator Peter Welch told me last night, when he's there at the Judiciary Committee listening to this, he doesn't have very high hopes that he's going to hear anything different from testimony in the past. Eamon, thank you for bringing us that interview. Rick Santelli standing by with some breaking economic data. Rick, the numbers, please.
Next, Contessa, employment cost index, fourth quarter look, expected to be up 1%, comes in a bit better at only up 0.9%. In this instance, lower is better. We're talking about an inflationary metric here. And 0.9, well, 0.9 is the best, the lowest cost for employers going all the way back to the second quarter of 2021. But I will caution, pre-COVID, this number was running 0.7 consistently. So even though it is good news and it's well off 1.4%, which was first quarter of 22 high, the all-time high going back to record keeping in 96, it is at least moving in the right direction. And one other thing, last Fed meeting, December 12th, two-year note yields were 43 basis points higher than they are now, while 10-year note yields were only about 18 basis points higher. There's been a lot of moves, pretty much lower since the Fed telegraphed rate cuts for 24. Mike, back to you.
Yeah, Rick's been a busy 6 weeks since then. Thank you. Breaking news out of the Treasury, hotly anticipated by the bond market. Let's get to Nathan Casella in Washington. Good morning, Nathan.
Good morning. We've got Treasury's refunding plans for the upcoming quarter. The agency plans to auction $121 billion. Beginning next week, they'll be refunding $105 billion and raising almost $16 billion. Now, they will be gradually increasing those auction sizes for the February through June period, but officials say that this should be the last quarter that they will need to keep increasing. Treasury officials say they should be, quote, well-positioned after April to address changes to the fiscal outlook without further increases. As for the breakdown in tenors, they're going to be leaning a little bit more on the shorter-term notes. Once again, we'll see a $3 billion monthly increase for the 2-year and the 5-year, a $2 billion increase for the 3-year, and $1 billion for the 7-year each month. Now, the $121 billion overall is an increase from last quarter, but it's in line with estimates. So unlike previous quarters, this shouldn't come as a major surprise. The emphasis on the shorter end of the curve, some analysts thought we might have seen more rebalancing there, but Treasury officials, at least according to the analysts I spoke with, don't want to put too much pressure on those longer dated bonds. Now, guys, you and I both know this used to be a very obscure release, but in previous quarters it sparked a rout and then a rally. We'll see how markets react today.
All right, Nathan, thanks so much. Coming up, Starbucks, one of the key movers this morning on the back of first quarter earnings. After a break, we'll speak with the company's CFO. Stay tuned. You're watching Squawk Box on CNBC.
Starbucks missing analyst profit and revenue estimates for its fiscal first quarter. Comp store sales were lower across the board, and the company lowered its global same-store sales outlook. However, Starbucks did reiterate its full-year earnings per share growth guidance, and it said it's very confident in its China business in the long term. Shares actually higher in the pre-market despite the slightly lower than anticipated comp growth numbers. Shares up about 5% right now. Joining us now, Rachel Ruggieri, Starbucks CFO. And Rachel, appreciate you giving us some time this morning. So talk about your outlook, because even as you say you're confident, the company's confident that comp store trends will turn more positive this year, it's also more loaded toward coming quarters. In other words, the current quarter maybe not as fast to start. What gives you the confidence that things will move in that direction?
Sure. Well, thank you for having me. Good morning, everyone. You know, when I look at our business and we look at our outlook, it's really based on the strength that we saw in our first quarter. So our first quarter was incredibly strong globally, and that was driven by the strength that we saw across our most loyal customers around the globe. And specifically to our U.S. business drove revenue of 9%, and that was driven by record growth amongst our most loyal members who came more frequently and they spent more money. And that was driven a lot by our holiday, which was successful. We continue to see growth in cold, and that drove the highest ticket we've seen in our over 50-year history. So all of that gives us a lot of confidence. We see some near-term, and I'd say transitory headwinds, which is reflective in our guidance. But importantly, we're seeing that our triple shot strategy is unlocking efficiencies, and so it's allowing us to have the confidence in reaffirming our 15 to 20% earnings growth, where we'll see growth coming from both revenue as well as the efficiencies we're unlocking through our triple shot strategy. So that's what gives us the confidence on our full guidance for the year.
You mentioned that you saw good results among your most loyal customers, maybe a little more softness on more casual visitors to shops. Is that a read-through to general consumer trends? What's your interpretation of that?
You know, we look at it as broadly, you know, our brand remains strong across the globe. And in the quarter, we had our most loyal customers remain loyal. We did see some softness in terms of our more occasional customers, but we have robust plans in place, and we feel confident we'll be able to navigate this dynamic environment. So when you look at all of that, the performance we have, as well as the opportunities around our ability to continue to innovate, new product offerings, which we spoke about yesterday. We have a lot of good innovation in the pipeline that resonates with our customers, as evidenced in Q1, where we saw a record high ticket in the U.S. So our innovation drives a lot of our success, as well as our ability to continue to increase our digital capability, bringing more customers into our rewards program, and then continuing to open stores and provide channels of convenience. All of that helps to serve our overall business, and gives us a lot of confidence that despite there are some near-term headwinds, we see an ability to be able to continue to deliver well over the long term.
Rachel, we've seen some companies coming out with lackluster results in China, and others coming out and overperforming. When you look at China, how are you able to hold on to that premium choice that Starbucks reports to be in China for takeaway coffee?
Well, it really comes from in the market over 25, we've been in the market for over 25 years, and we've built a very durable business. We have a strong brand. We continue to be the #1 choice for our customers from away from home coffee. And what that does is that gives us a leading advantage in the premium market where we're choosing to play. And we have distinct and competitive advantages. We have 7,000 stores that are highly profitable, and they're in prime locations. And we have innovation, coffee-forward innovation that's resonating with customers. It's driving trial, it's driving consumption, and we're seeing it resonate with even a younger customer. And we're amplifying our innovation as well as our messages on social media. And so that's driving strength in our business. And we continue to believe that where we lead today is through the experience that our partners create for our customers. That's our differentiator, and it has worked well for us over the 25 years, and we continue to believe that we are best positioned to be able to lead in that space.
You mentioned strength in the latest quarter on average ticket size embedded in your comp sales. How much of that is pricing? How much of that is the mix? And can it continue at this point if you are, in general, companies seeing a little bit more hesitance among consumers in terms of paying up?
The record ticket this quarter was driven by a combination of annualization of pricing moves that were taken last year, as well as a little bit of new pricing, but also driven in it is increased beverage and food attached. So that speaks to the strength we've been able to drive through our holiday promotion, through our offerings. It resonates with customers. Cold, as an example, was 59% of our sales this quarter. Typically in Q1, cold is closer to 55%, and we specifically innovated in cold around our iced chai tea lattes, pumpkin, gingerbread chai tea lattes. We continue to do incredibly well with our customers on our ice shaken espresso, so very coffee forward, but in an iced format. So as we innovate in those new areas and offerings, we believe will continue to drive ticket through attach. As well as food. Food in the quarter actually had record revenue in bakery and breakfast. And so we see a lot of opportunity with all-day breakfast, with all-day snacking, and leveraging our digital program to be able to incent our customers to come more frequently, but also to attach in certain day parts. And so there's a lot of opportunity ahead as we think about how to continue to drive our overall ticket.
And in terms of overall store growth, I mean, am I right that anticipated about 2,000 net new stores this year from 38,500 or thereabouts right now? Where is Starbucks in its ultimate trip to its destiny in terms of the overall footprint?
Yeah, so what we've cited as our goal is to hit 55,000 stores, and we're well on track for that. Despite everything in the quarter, we had a strong quarter, but certainly there were some headwinds, and specifically in our international market. But despite that, we opened 10% of our net new store growth came in our international market. Our international market has 20,600 stores. When you exclude China, which has about 7,000 stores, you're looking at nearly 14,000 stores that are outside of U.S. and China, and we're continuing to grow. And then broadly, we still have a lot of opportunity in the U.S. And so when we look at our U.S. business coupled with our opportunities globally, we feel very confident about our opportunity to continue to open new stores, which really drives new occasions, but it also brings in new customers.
Rachel, appreciate the update. Thanks so much.
Thank you.
Coming up, we go inside Boeing's fourth quarter results and speak with the top analyst. Shares of the aerospace giant moving higher after earnings up almost 2% in the pre-market. A reminder as we head to break, you can get the best of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app, and you can listen anytime. We'll be right back.
SquawkBox.com.
Welcome back to Squawk Box. The futures right now still showing about a 0.5% loss in the S&P 500. That is driven by the big NASDAQ stocks. NASDAQ down about 1% in the pre-market. The Dow showing a gain of about 50 points. Those results from Microsoft, Alphabet, AMD, bringing out some sellers after those reports last night. That is pressuring the NASDAQ.
Shares of Boeing are moving higher this morning. The aerospace giant posted a smaller than expected loss and revenue above expectations. Boeing is also postponing 2024 guidance in light of the problems surrounding the 737 MAX aircraft. In a note to employees, CEO Dave Calhoun said, now is not the time for the company to update its financial and operational objectives. Joining us now is Noah Papanak, Goldman Sachs U.S. aerospace and defense analyst. Noah, great to see you today. How important is it to you, this pause in guidance?
Yeah, it's important. I think it makes sense. I thought there was a scenario where Boeing would have enough visibility into enough inputs to provide 24 guidance today, but it's not particularly surprising that they're holding off because it's pretty early in the process of bringing in the FAA, other third parties to evaluate their manufacturing process and the quality control. And, Boeing wants to and should respect that regulator's process. And so, today to provide guidance, which would have to assume units by aircraft, including MAX, would just be getting ahead of that.
Sorry, go ahead. Important.
Yeah, they do state that they're at 38 a month on the MAX for the underlying production rate and 5 a month on the 787. So, the market and investors can extrapolate where the units can be based on that. And I think that's relatively in line with the consensus. You can get the earnings and cash flow in line with the consensus based on that. So that's an important piece that's in there. But I do think it makes sense how they've approached it this morning.
How much of that do you think is Calhoun deciding that he's taken a far different approach in this current crisis than his predecessor? How much do you think just withholding talking about financial objectives is because of the way it plays out in public headlines?
Yeah, I think part of it is a lot of what's happening here is unprecedented. It's hard to analyze. It's hard to predict. And so, for Boeing to take the approach as they kind of did early with the MCAS situation on the MAX of estimating the timelines that the FAA would come through with and when they deliver airplanes, you end up moving those targets around, changing things a lot, and it just doesn't show the proper level of respect to the process with the regulator that should be there. That's of the utmost importance right now. So the company has pivoted to that framework and philosophy, as you alluded to, and I think that's right. Boeing needs to get the product quality right. The demand for the product is really strong. The airlines want the product. They really just need to deliver it to specification. And so that's, first and foremost, that's what they need to get right. So, to take that approach today, spend a few months with the FAA, with third parties in the factories, getting things 100% correct, the long term of Boeing can be really great if they can just do that.
Okay, so given that they posted the charge for the fourth quarter, cash flow here of almost $3 billion, that topped analysts' consensus expectations, what did you think of the quarter and what are you expecting for commentary on the call about the future?
Yeah, the quarter itself looks pretty solid. There's $3 billion of free cash in there, gets them to 4.5 for the full year. The guidance had been a range of 3 to 5, and they had said low end of 3 to 5. So $3 billion of free cash in a quarter, it's not perfectly fair to annualize it because there's seasonality. It has some advances timing in there, but Boeing will give you free cash flow quarters even at these very low volumes where if you annualize it, you can see the earnings and cash flow power of the company. There's a cash flow machine in there somewhere if they can just deliver the airplanes to specification. So that number is very encouraging, stating that they're at 38 on the underlying MAX rate, 5 on the 787, which we just visited that facility in Charleston, and that looked clean, optimized, ready to go to higher rates. Those elements of the quarter are encouraging about where the future cash flows can go.
even in the defense business where the margins have been weak, that was a little better sequentially. Their services business is really strong. So plenty of challenges here, a lot they need to improve still, but also some encouraging signs here about where the cash flow can go, especially relative to the current stock price.
All right, well, those Boeing shares up 1.5% in the pre-trade right now. Noah, great to see you. Thank you. Busy morning for you. A reminder, don't miss an exclusive interview with Boeing CEO Dave Calhoun. It's next hour on Squawk on the Street.
All right, coming up, what to watch in the markets on the final day of January. We'll get you up to speed as we move closer to the opening bell. Stay tuned. Squawk Box will be right back.
Asset.com.
A little more than half an hour to the opening bell on Wall Street. The big event for investors today, this afternoon's Fed decision. Joining us now on the markets and the big slate of earnings we've seen this week is Sarat Sethi, the portfolio manager at DCLA, as well as a CNBC contributor. Sarat, thanks so much for joining us. So we had this disconnect last fall between the markets and the Fed. That seemed to narrow quite a bit when Powell gave the market exactly what it wanted to hear, that we had that end-of-year rally. Do you think he'll give the doves and the bulls more of what they want to hear today, or do you think he might back off some of that?
I think the important part is a message, and the message is going to be, hey, are we going to stay here for a while and the next step's going to be lower? Or is it going to be, we think we might have to stay here for longer and raise? If he says the latter, I think the markets will not like that at all. But if he says the former, hey, we're in a glide path, we're looking at the data, and the next step's going to be lower, we just don't know when, I think that's kind of the market discounted at. But the market's also looking for, hey, when are you going to cut? And I don't think he's going to give us that. I think he's just going to wait for the data to come in.
Yeah, and we certainly heard more of that higher for longer talk from the other Fed officials after the Powell press conference. What do you think what do you guess we're gonna hear from him on that this afternoon? Which
I think higher for longer. Yeah, I think higher for longer, Frank, just because if he hints that we're going to cut sooner, then the market's going to say, what are we seeing that the Fed is seeing and we're not? And, i.e. we're seeing job cuts, but we haven't really seen them other than tech go far. So I think to hold where we are, strong economy, inflation coming down, and as soon as kind of the Fed sees the economy slowing down, I think that gives them the ammunition to go forward. But you kind of preempt that, then I think you're going to get bonds and stocks selling off.
Yeah, and we're seeing the markets this morning driven a lot by those tech earnings last night. And Microsoft and Google, they were actually pretty good reports, especially for Microsoft. Microsoft stock was up a little bit right after that report last night. Now they're both under pressure. Why are they being punished for what, at least in the case of Microsoft, was a fairly strong earnings report? And are we seeing that more broadly with earnings this quarter?
Yeah, and I think, Frank, if you look at last year was the year of efficiency, right? I think this year is going to be the year of cash flow. And both Microsoft and Alphabet said we're going to spend more money for AI. Now, if you said that 2 years ago, the stocks would have been rewarded immensely because interest rates were zero. Now where interest rates are, investors are saying, wow, these stocks have run quite a bit in the last year. So what should we do? Let's take some money off the table. Same thing happened to Google in the third quarter of 2023. Stock was down 10% after earnings. I do think they've had such a good run, and if investors are looking at cash flow, they're going to take a break because there are other areas of the market that actually are improving cash flow, and you also have other alternatives, just not kind of the Mag 7 at this point.
Yeah, specifically on those other alternatives, what stocks or sectors do you like for the rest of this year?
So, defensively, I think healthcare has great cash flow and growing earnings going into kind of the election year. Commodities, you look at copper companies, you look at the supply-demand imbalance, I think that's also a great opportunity. Consumer staples, the multiples have come down quite a bit, over 20% in the last 18 months. So you're going to get, with input prices coming down and pricing holding up, I think there's a lot of value there. And then utilities. Utilities are still acting as the rates are going up, and I think the opportunity to grow there. So definitely the market's broadened out in terms of valuation. It's just the cash flow of investors hasn't followed, but I think there are opportunities. And then, Frank, lastly, fixed income has opportunities now too that we haven't had in several years. You can actually ladder out, whether it's corporate bonds or treasuries, munis, 3 to 5 years, getting good kind of returns that are higher than kind of what inflation is expected to be.
I guess that whole case relies on the consumer holding up and the broader economy holding up. Surat, thanks so much for joining us.
Thanks, Frank.
Let's get a final check on the markets. You see the S&P 500 indicated lower by about 0.5%. Most of that driven by those big NASDAQ stocks. A little being skimmed off the top of that big NASDAQ rally. NASDAQ 100 down about 1%, but we're rotating into old economy. Dow up 50. Small caps also. Take a look at treasuries. They've actually rallied. Yields on the downside. Employment cost index coming in below expectations. Also that treasury refunding announcement. Nothing scary in there. The market was okay with it. All right, make sure you join us tomorrow. Squawk on the Street is right now.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer, postman at the New York Stock Exchange. David Faber as the morning off. Final day of January. Fed decision on deck. Some wariness around mega-cap tech earnings, but more signs of wage disinflation. And does that build the case for a March cut to near 401? Our roadmap begins with tech earnings. Alphabet, Microsoft among the names dragging the NASDAQ and S&P lower. CEOs of Boeing and AMD will join us to discuss their respective results. And a Delaware judge strikes down Elon Musk's $56 billion Tesla pay package. Let's begin with Microsoft and Alphabet set to drag down the tech sector despite beating estimates. Light guidance with strong growth from Azure, while Alphabet's ad revenue came in short of expectations. Here's CFO Ruth Porat talking about the parent's outlook on last night's call.
The step up in CapEx in Q4 reflects our outlook for the extraordinary applications of AI to deliver for users, advertisers, developers, cloud enterprise customers, and governments globally, and the long-term growth opportunities that offers. In 2024, we expect investment in CapEx will be notably larger than in 2023.
notably larger than 23 when they did 11 billion. This street was not even at 10.
I hope it's going to be larger. They have a lot to do. There's been a very exciting time, as we heard from Lisa Sue. I think that this is a quarter that suddenly we didn't care about Google Cloud. I mean, I was just praying that Thomas Curry put up good numbers for Google Cloud, puts up great numbers, and then suddenly we're shadow boxing with other things they're doing wrong. They are doing some layoffs. Yes, do I like how much other best loses? No, come on, Ruth, let's do better on that. But no, I mean, look, the stock's down because it went up a lot. I thought it was a very, very good quarter. They don't like to specify how much they made YouTube, which does bother me. I was hoping they'd give us some granularity on the Sunday ticket. They did not, but this is still a tremendous way to reach customers. Google Cloud's doing well. If the stock were, if the stock had not been pushed multiple times by people who said this is the cheapest of the Significant Six or whatever, then this wouldn't have happened. So those who want to sell it now, be aware that there weren't any people on Wall Street that really said, you know what, sell or downgrade. And one of the things that we've learned from the 7 or 6 or whatever you want to call it, is that unless there are downgrades, unless people come in and they just say, listen, we're selling, then what happens is you just look at the propensity of raised versus lowered, and it's 5 raised versus 3 lowered. So therefore it goes up.
I think it's Bernstein this morning calls all of this the burden of high expectations. Do you think that's what we're looking at?
Yeah, I mean, Bernstein actually distinguished himself pretty well in some of these, and I thought that that's exactly what happened here. Those who do not, my chapter zones, we sold, I don't want to say a great deal of it, but it's my least favorite of the significant ones. And that was because it ran so much, and because I don't like their advertising model as much as I like Amazon's and I like Meta's. But that said, I was also worried about Google Cloud not doing well. I'm not going to suddenly abandon the thing that drove it down last time, which is Google Cloud being bad. So Bruce, fine. If you want to sell it, be my guest. It's probably going to be a mistake.
As for Microsoft, Jim, they're really slicing up the cloud revenue, looking at XAI, Azure growth, and wondering whether or not the push to AI is sort of cutting out other cloud consumption.
Well, look, I think that they handled themselves very well. They were very methodical. Once again, I want to use this ratio theory because it's really worked for me over the years. Microsoft had many people who loved it. We did not get a single target lowered. We had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 analyst firms raise price targets. They're going to be right. The sellers are going to be wrong. Amy Hood was as confident as I've heard her in many years, the CFO, who is just money. That's her, like, they should just change the name to money. And she is saying, look, everything's going well. They lowballed how much AI is going to do in their AI, all the different iterations that they're going to do with Copilot. They're doing remarkably well. We'll speak to Lisa Sue, too. They can use every single high-performance GPU chip because they have that much business. It's just a fantastic quarter. Again, go ahead and sell it. I want everyone out of these stocks who doesn't understand what the hell they do. I mean, especially these people who are in these ridiculous ETFs. I mean, if you want to create an ETF, I'll create an ETF that'll be better than all these people because I have genuine hubris.
Well, some of them are going away. We won't get into that part.
Yeah. I would say, look, I mean, you know, I know if you're an ETF, you don't know the difference between Microsoft or Alphabet. These are very different animals. But the one thing that we do know is that if you want to have one complaint, it's that when I was out there, they were talking about how what you use the use case for is summations. And that was 3 months ago, and what did they all admit that they used it for? Summations. Like, I was hoping that they would have some new reason to use it. But what they did say was, look, we're going to hear what the customers use it for, and then we'll talk, we'll populate it that way.
Really quick, this is Bernstein as well. This might be a stretch, they say, but one could argue that non-AI Azure growth slowing down bodes relatively poorly for other cloud consumption companies. Is there a read-through for Amazon?
No. In Oslavsky and Jassy, they're gone. I mean, they're taking no prisoners. The people who think that they're not going to deliver, I think are going to be motivated to say they won't deliver without looking at facts. I would look out for anyone who thinks that Amazon's not ready. Amazon is the one that's most affiliated with NVIDIA. And I think they have genuine use cases. I think that they've always been great at inference. The current H100 is just the king of inference. They have remember, there's a big difference. We're going to speak to Lisa. AMD
does not have the training software that NVIDIA has, but it's turned up much faster than people thought. And Amazon needs everything, every single chip. That's a company that doesn't sound like it's going to miss.
We are going to talk to Lisa Su in a few moments.
Yeah, it'll be great.
Yeah. In the meantime, one of the big non-tech stories today is Boeing and its latest quarter suspending guidance for 24. Our Phil DeVoe is live with the CEO. Morning, Phil.
Morning, Carl. Dave Calhoun, CEO of Boeing. Fourth quarter, smaller than expected loss, but it's the guidance for 2024. You're postponing it. When will you give us guidance for 2024? I say us, investors, guidance for 2024.
Not surprising, I hope, to anybody. Our full attention, our full focus as a company is to make certain that we never have a safety escape again, learn everything we can from the accident, learn everything we can from the FAA's audit, learn everything we can from the stand-down that we had, and all the ideas that were given to us by our own people, and that requires all of our attention, all of our energy. This isn't a vote of confidence and not confidence. It's just not the right time. Nobody needs additional time pressure at this moment.
The NTSB initial conclusions are expected any day, maybe within the next week or so. And the early reports that have leaked out say that the bolts were not in the door plug on the Alaska Airlines plane. If that's true, and we don't know if that's the initial conclusion, but if that's true, how does that happen?
Yeah, so that's a critical question. I am not going to jump the NTSB. They're going to have a conclusive report. I'm looking forward to it. The process we use to determine what may have happened or not, it's a very, very, very good process. They get to take time, they get to look at all of our investigative work and then draw conclusions, and they will publish when they're ready to publish. Every single thing we learn about bolts, every single opportunity for failure that we see by way of all the inspections that are going on every day, our job is to instantly respond to that, which we have been doing at a very steady pace. But I'm not going to call out the conclusions before they get the report out.
Understandable. But you know that people will look at this report if these reports are true. And the basic question is going to be, but this seems like engineering, or not engineering, manufacturing 101. To my original question, how does it happen? How did it happen?
If bolts aren't in place, it's a miss, right? And it may involve 1 or 2 or 3 or 4 players. At the end of the day, we're trying to get everybody to be perfectly forthcoming, understand exactly how that window opened or didn't. And I rely on the NTSB and I rely on our own investigators to know the answer to that, and I believe they will and do. And our job is to close it. That's the easiest part of the process, closing that. Honestly, it's now learning everything from 100% inspection. That's where we get the hard work and we go to work immediately.
Dave, Jim's got a question for you. Jim?
Yeah, Dave, almost 20 years ago, Boeing made a decision, which I think in retrospect was misguided. Save a lot of money, have partners, spin off different companies, actually sell Spirit to private equity. And one of the things that's happened is I think it's been very hard for you to take control of your supply chain. So it's therefore very hard for you to identify what went wrong. Wouldn't it be great to say, listen, our Washington guys didn't put it in the bolts well, and we're going to fix that, and we're going to identify who didn't do it right, and they're not going to work for the company. Instead, we don't know where it's made, what it's made. If you're stuck not being able to tell people when the FAA is going to green light, you can't do that. They're the government. You're also stuck with this idea you have the supply chain. It was really made for Boeing to make more money. That's okay. You're a publicly traded company. What happens if you went to the FAA and say, what do you want? Do you want us to redo the supply chain? Do you want us to take back Spirit? Do you want me to take a different role at the company? I want this thing moving. I want to do what you say. And then maybe we will leave this kind of moment where we just say, I don't know what's going to happen. Give us some choices.
Yeah, there's none of the I don't know, this or that is not going to happen. We have a huge team down at Spirit. Our job is to embrace everybody in Spirit, work constructively to understand where there are quality opportunities. They have 12 stations in their line, I've seen them. Since the time our team has shown up, we've added over 50 inspection points, just in that process alone around just this plug. A lot of learning that will require an enormous investment on our part in terms of people and engineers and interactions. We're going to do it, we're going to learn from it, And yes, the subject of how we interact with all of our suppliers, that will be a subject that we will be working at for quite a long time. I've got experts helping us with this. I am absolutely convinced that we've got this plug completely under control. That is job one. And as I said, we're working closely with them. I will opine that on the subject of vertical integration, and did it go too far? Yeah, probably did. But now it's here and now. And now I've got to deal with it. And we're going to do it with engineers and mechanics working constructively together.
Look, yeah, when my father was in World War II in the Pacific and we were losing, and we were getting shot down, zeros hit my dad's boat, and then suddenly B-29 appears. B-29 made by Boeing. Not necessarily the perfect plane, but it was made by Boeing. Suddenly we see, let's go fast forward, we got an outfit, Spirit. I don't know who the heck they are. I know that they were spun off. They're not you. I want Boeing. I don't want Spirit. I don't want to hear that Spirit was involved. I don't know who the hell they are, Dave. I know Boeing. I know the name of a great American company. I want you to have ownership of this. I don't care what the history says. That's recent history. Why don't we go back in time to when you were king?
Jim, we own it. There's no other answer I can give you. I want everybody on every airplane to know that Boeing owns it. We own our supply chain, we own Spirit, we own the results of our work. We understand that, we really do.
Dave, we talked with Scott Kirby at United Airlines last week. You heard the interview, and he told us this is the straw that broke the camel's back. He's not sure that he will get the MAX 10s that he needs, and he's thinking about shopping around. They are shopping around to see if it's possible to get some Airbus A321. Have you lost the confidence of your customers?
I don't think so. Was this a shot at them? Absolutely. As I say, these moments shake all of us to the bone. Boeing, our people, our customers, everybody. So our job is to just restore confidence at every level. But the reach out on the part of our customers to work constructively with us, and they've been a steady parade coming in here. It's been constructive. They want Boeing to win. They want us to succeed. They're going to learn everything there is to learn about the NTSB report and then some, and they're going to help us every step of the way. And I am going to work my tail off, and our team will, to satisfy Scott Kirby. And I am sorry to put him in a position where he has to talk about Boeing when he had a phenomenal quarter.
You are not giving your long-range guidance. You're not pulling it, but you're not taking it, you're not pulling it, you're not reaffirming it. And it has people questioning this morning, is this maybe Boeing's way of saying, we think we can get past this relatively quickly, and we can still hit 50 MAX per month in the 25-26 time range.
Yeah,
is that what you're saying?
The premise is false. I do not want to get through this quickly. I simply want to learn everything there is here to be learned, and I want to implement it, like all of it. So the notion that we're not giving guidance, it has nothing to do with a decision today other than let's take the pressure off everurybody. And let's not guess when the FAA is going to finish their work or not. That's not what I want to do, and it's not the pressure I want to put on our company. So that's that. Let's talk about guidance. Let's talk about our long-term plans when the time is right.
So real quick follow-up. Why not pull it then? Why not say we're taking it off the table?
There's no reason to pull it. It's there. I've told you what we're doing now. We're going to pause as long as we need to pause. Everyone will adjust. And my
whoever this jackass is needs to be fired. And if he's the CEO of Boeing, I'd get rid of him fast.
Inspectors of some sort?
100 inspection points across all of this, and still developing.
Still developing. Yeah. Guys, we're going to send it back to you.
Yeah. Thank you.
Phil, appreciate
Thank
that.
You,
Phil LeBeau with Dave Calhoun this morning. Jim, page 1 of the LA Times does cite a former Boeing manager by name saying, I would tell my family to avoid the MAX. I would tell everyone, really.
Yeah, that's extraordinary. It's extraordinary because
it's not extraordinary.
You
go woke,
really,
you go broke.
The gold standard, and everything else was really brass. I mean, Phil, when Dave Calhoun says he owns it, he doesn't own it. So how do you say you own it?
Exactly.
I'm not sure if we have Phil at the moment, but yeah.
Okay, I mean, because my problem is this.
I have a huge problem.
There was a great decision made by Boeing. And I remember when the decision was made. I bought a ton of Boeing because from Chapter because I realized that they got rid of all the bad stuff, all the stuff where no one was making any money, and all these union problems, and suddenly they became an assembler instead of manufacturer. And I thought that was great. And then I looked into the great history of Boeing. I went down to the fantastic World War II Museum in New Orleans, really studied Boeing. And what they would never do is let anyone else have part of the process. But when you want...
Exactly. Good morning. Sorry about that sound, YouTubers. It's fixed now. I should be anyway. We'll find out here.
Never do is let anyone else process.
Yeah. All right. Yeah, that CEO. I got in at the tail end of that conversation, but I sound like he's getting a little mad. They went through a period where they weren't making any planes at all. And then all of a sudden everybody wants to buy them, and now they're mass rushing these things out. And it just makes no sense to me, especially an airplane. It's kind of like what's going on in the Middle East. We get hit 160 times, and finally we have some dead soldiers. It's bound to happen. Let's see if we get a 1, 2, 3. We pull back to 188 here on SPY at open. See if that holds. You got a 1, 2, 3 bis. 188. 187.99. 188. Let's see if AMD has a good little bounce. That already has. Google at support also. They're at about the same place on the deviation channel. Mark. This was a good trade yesterday. We probably had the 50% retracement or more. Doo-doo. Man, what a night. $31 here in Missouri. Besides having that one ice day, it's not been that bad of a winter compared to what we usually get. These are the kind of winters I can put up with. I lived in Hawaii for a whole year, and it was nice. Wake up every morning, sunshine. Never had to worry about putting on a jacket. Go to work with shorts on. I'm gonna go get me some tea ready. What time we got? Not 9 minutes, and I'll go over. Earnings kind of not been that hot, except if you're a big daddy. And then still some of them weren't either. But the market doesn't care. Okay.
The process, or maybe the process of Delaware, would say, wait a second, he made a lot of money. So we made a lot of money, and we wish everybody had that. But the fact is that the company did not analyze a particularly crude form of Delaware law, which said there was no give without a get. Well, what did Tesla get after doing the give? And the answer is they got a guy who already had a lot of stock, so he didn't need to have more stock. Now, in retrospect, he went and bought X. Therefore, the economics went down, so suddenly he has far less stock, and then suddenly we get to the discussion out of nowhere, I went 25. Well, in retrospect, it was almost like he was prepping us for recognizing he might lose this lawsuit, because now he doesn't have enough. He can go to Texas, but what he really has to do is go to the shareholders. He doesn't have a package right now.
Right. He's likely to appeal this as well. Do you think...
Good luck. I mean, you know, these are heavyweight. These are heavyweight. Now, it's a 200-page ruling. By the way, if someone wants to learn about how people get
Chart's a little
paid
blurred
or
this
overpaid in
morning.
country, you should read the ruling, because I think there are a lot of people in the country who might just say, this was the most deserving man to ever get this money. I wish that we had other CEOs who were aligned. But that's not the issue. The issue is you voted on a package and you didn't know that the package was so-called corrupt. And I thought it was, given the state of the law, I don't know, maybe Texas just says, hey, listen, here's the disclosure. We looked at it. And it wasn't just, wasn't just you. Elon Musk's divorce lawyer. She uses that. She mentions that a bunch of times. And then the divorce lawyer did. I mean, it is so dripping with cynicism that it is just dynamite. And it's so, Musk, you want cynicism, you want craziness, you want Looney Tunes, and you want rigor. Here it is, 200 pages worth, partner. Enjoy.
Yeah. She calls the process deeply flawed. Are you watching the discussion of whether or not Tesla should worry about his involvement from here on out?
I am, because I think the Neuralink, if I were, you never want to say if you're Musk, because Musk is the greatest inventor of our time, but I mean, there's a car that is a robot on wheels, and then there's saving millions of people's lives by learning how to put a chip in people's head that no one's ever been able to do. I think it's a higher calling than the Model Y.
You will be okay if he leaves to go run Neuralink full time?
No, he spent a lot of time talking about wanting to put a man on Mars, and that's why you need the package. Now, that should not matter. I'm going to put a man on Mars. I mean, I'm going to put a man on Jupiter, man, and I really need a lot of money. But he talks about doing bigger things. And I thought, look, this Neuralink, maybe it's because I did the Brain Foundation in Gale last year. I got to tell, I mean, not that he listens to the show, but that's unbelievable.
Huh.
And it would be great if he saved people's brains as opposed to just made it so we could get from point A to point B.
We're going to talk more about it, especially given the street's reaction to GM yesterday and what that's done to the EV theme. By the way, take a look at Capitol Hill this morning. There's Linda Yaccarino of X, as the social media chiefs are going to testify today on the Hill, including Meta. TikTok's there as well. We're going to take a lot of that live.
Good.
On an important day for
X is
the
going to get a lot of roughness.
In the meantime, a lot more to get to on a busy day for earnings and the Fed on deck. Don't go away.
We have 4 more minutes. So, AMD bounced back, Microsoft bounced back, that was their baby. Google, Starbucks, and Google pulled back to my low support. I had 141 something. Watch IWM out of the gate. Sometimes when I have a real good day like I did yesterday, I want to take a little bit of time today and make sure that I just don't want to go right in there. Hey man, I'm hyped up. I'd had one good day yesterday. Everything just fell together. It might not be the case today. And the day before it wasn't. I got in that last call and I got stuck. I had to work my way out of it. 107 to what, 15? 25, and I loaded at 25. If I didn't have the money to load that 25, I would have probably had a red day. 25 cents.
Tune in 7 days a week on schwabnetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and
I'm going to watch AMD right out of the gate. Now Meta going to court today, so we could get a little. Oh, we are down. Okay, we're open. Oh, I forgot my watch list. Come on, you idiot. Okay. Today's percentage gainers is Para, Plug, big pop on Para. Paramount shares jump after reportedly getting $14 billion acquisition offer from Brian Allen. So that's just money in the bank. That little kid's still pumping AMC. I'd like for it to knife at least $2. Teach him a lesson. I don't like pumpers. Especially if you don't know how to trade. Mark had that good news yesterday. Looks to me like we pulled back to where I called it out at. Support will be the 200 on the 1 minute for Mark. Mark my words. We've got NVIDIA on watch. It had come back and hit my support level. AMD's down 4%. Oh, come on, you stupid. Ah. NVIDIA is number one, so this is when you're down, and I mean it pulled back, you got to keep a good eye on it. Crude oil's down today. Now watch SPX at my 401 number here. We got a hammer at opening. SPX. Oh God, I don't have my platforms up. What the heck? Jim. Damn it. Reprimand. I would have been in that trade already. This is a pretty big knife. Hurry up. Holy shit. Don't go over there. Come on. Hurry up. Damn it. Lotto. Today's the 31st, end of month. Man, I would have jumped on that. That hammer right at open, that was a good idea. So I'm looking at 43.35. Unless I can get this 49.30 down. Yeah. Got support ready here at 4902.83. And I'm going to jump in this call. I got the 49.30 on watch. I'm going to grab one contract. Not yet. We got to wait till it touches my support or gets close to it. In fact, I'll raise it up just a little bit. There we go, right here. 420 time. 420, 410. I got one at 410. Now we wanted this thing to shoot up and break this tweezer top. See, that tweezer top was a bearish sign right there. Now we just went below my support. Get this trade out of the way and off to the beach. Grab one more. One more at 370. Damn, that don't make no sense. I might have to get out of this one. But I'm going to hold on just to see if this holds this double bottom.
Elon's pay package, I should say, for $56 billion should be voided, especially with everything that's been going on with Tesla lately. They said in their opinion, the judge wrote the Tesla board of directors failed, that the compensation plan was fair. The pay package, which was granted back in 2018, was the largest compensation plan in public corporate history, according to the judge. They awarded some 300 million options that could be vested on hitting certain performance milestones. The judge said that Musk had extensive ties with the person tasked with negotiating on Tesla's behalf, and the package's working group included people that were.
I remember that day when the glass
The judge also called the
broke.
Contingent on Tesla hitting several milestones historically unprecedented. The ruling means
NVIDIA's got a symmetrical flag.
Package now that can also appeal the ruling in the Supreme Court of Delaware and eventually the Supreme Court. As for Elon Musk, he tweeted, "Never incorporate your company in the state of Delaware." Also talked about incorporating in Texas. And this is
Microsoft hit the deviation channel and pulled back.
Angling for about 25% of voting control over Tesla, currently only having about 13%. So could have some pressure.
QQQ's down 1.2%. Watch the QQQ at a double bottom. What was that?
There were some numbers there that were really disappointing for investors.
Okay. Yeah.
I'm in SPX.
Delaware has delivered a defeat to Mr. Musk. So, the mighty Elon.
Got a double bottom.
United States of Delaware. Okay. Don't mess with Delaware, I guess. All right, let's go back to earnings here and a few other items. Walmart's doing a stock split. Seems like this is what the people
Walmart's doing a stock split?
Yeah.
You gotta be kidding me.
You know, we're seeing a good reaction here. They announced a 3-for-1 split. They say it's part of their ongoing review, basically to keep the share levels at an appropriate number for associates to feel like they can purchase the shares. This is the first stock split for them since 1999, though.
That's going to be a good deal. You'll want to go long in Walmart.
Each one held. They're expecting that will begin trading on February 26th. Walmart, the number of outstanding shares is going to jump from about.
Not now, but I mean when that day comes.
Company, as I said, last had the big split in March of '99. If you look at the last earnings report, the company there were some question marks in terms of the consumer spending outlook. I don't think that has any bearing here on what we're seeing for the split, but investors are certainly.
So far, I'm looking good on my SPX. I ain't gotten below support yet. If I do, I will get out. Take a small loss.
Walmart liking it, up 1%, maybe bring some people in. You know, it's not the most expensive stock from a price standpoint, just nominally for shares. So I guess they find might bring in some.
SMCI, mentioned that right at opening.
But maybe this will. Starbucks.
Off the 200. Oh, there we go. Shit.
Got some gains. This was kind of a surprise to me. I mean, the market has given them such a short leash. Maybe that's finally changing.
Yeah, it seems like investors are really looking into some of the more positive aspects of this note. But let's look at the earnings per share, which missed at 90 cents versus the 92. Revenue, $9.43 billion versus the $9.55 that was expected. That was up 8% year over year. Same-store sales rose 5%. Analysts were looking for just over 7%. A lot of that was driven by a 3% increase in comp transactions and a 2% increase in average ticket charge, which I think is an area that investors are really focusing on. They did report a 10% increase in same-store sales in China, although below the 16% expectations.
China.
We're seeing more and more tickets in China. Just average spending per order has lowered. Comps in North America were up 5%, 7% internationally. We look at operating margins; those expanded to 15.8%.
Walmart's not. I mean, Walmart. SPX ain't looking too hot.
They saw a record $3.6 billion in holiday season gift card spending. If we look at the outlook side, another disappointment, fiscal 2024, they expect revenue growth of 7 to 10%. That's down from the 10 to 12% prior. 4 to 6% on same-store sales, down from 5 to 7%. And they reiterated their full-year forecast of earnings per share at 15 to 20%. My guess here, and what a lot of analysts are pointing to, is the positive traffic.
Right now, I got 780 in the trade. I'll get 2 more contracts.
Internationally was not too bad. Also, the recent pullback has just maybe given an opportunity for investors to jump in here.
Okay. Hey, nice to see it. You know, Starbucks finally get a little love. I do feel like they've been a bit unfairly punished for their China connections, which, are obviously tied to a more uncertain economy right now. But ultimately, they're going to put those stores up, and they're going to have people buying coffee there over the coming years. So it seems like the market's been really brutal. And then, now rallying on earnings despite a miss, it just seems like was too harsh for a while there in its interpretation of what this meant for the stock's bottom line.
Yeah, absolutely. I mean, the China story in terms of their recovery has certainly been slow. They do have more competition in China, which is certainly an issue. And they have competition in the U.S. as well. And the slowing consumer, the CEO has really pointed to some of the headwinds, including the geopolitical conflicts, some of the slower consumer spending. He's talked a little bit about some misconceptions in terms of their position on the Israel-Hamas war. It seems to think that has been a headwind for them as well. But to your point, the question is whether or not this competition side.
2 more at 320. This is my last chance.
Okay. Thanks, Jeff. Good walk through the earnings this morning, and other movers too. I got a mover myself as well, looking at the regional banks as we see bonds rally big. It was a bit of a head scratcher, but maybe this is part of the reason. Regionals are down 4%. There was a big earnings miss in New York Community Bank. We'll get some more details on that later, but right now, maybe putting a little bit of fear into the market of some of our old worries around the regionals. All right, when we come back, we'll keep focusing on tech though, and get ready for the reports that are coming up next. We'll do some trading inside out, around the corner. Alphabet, what does it mean? And its connection to advertising, something to think about for Meta. And then of course we've got Apple as well.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights.
Not looking good. My average is 350 now. Yeah, I'll definitely go long in Walmart after the split. Not even worry about it. So I got an average of 350 on the SPX calls, the 49.30. Good job on AMD, Carlox. That's a smart move right there, buddy. Let's go to Walmart, pick up my shopping cart, pinball, bird seeds, and all the things you need. Let's go Walmart now.
Definitely the biggest decliner this morning.
I'm even.
Do you think that tells us anything about a few of the reports still left to come?
Well, it's interesting, Oliver, because we had both Microsoft and Alphabet coming in with numbers obviously last night. You were talking about Alphabet coming up short in terms of ad revenues. They were up about 10.5%. YouTube was up about 15.5%. I think GCP was up about 25%. So we roll that number into Meta. The expectations, obviously, for Meta coming into this fourth quarter in terms of ad revenues, they're looking for 20% plus growth. So I think there's a lot of red flags going up that if Alphabet can't hit on ad revenues, will Meta hit on ad revenues? And then if we take a look at Microsoft, they came out last night and said that Azure, which is their data center cloud service, was up 30%. 6 percentage points were due to enhancement of their AI tools. So I'm wondering if that's going to roll into Amazon with AWS. We're only looking for
Bitcoin's down today, the ETFs.
In terms of revenue. Would they also say that, hey, we're getting a boost because of what we're doing with AI? So those are the two things that really stood out to me.
ENSC has some volume.
Numbers into the reports that we're expecting tomorrow evening.
All right. The competition between Microsoft and Alphabet for search, now that Microsoft has got some attention on Bing through its
Got to hold this support here on
integrations,
SPX, or I'm going to get out, take loss.
Well, it's interesting, Oliver, because we hear a lot about that in terms of Microsoft enhancing their search capability through AI, and how does that stack up against Google, and will they steal market share away from their search engine? I still view, Alphabet as a dominant player in that space. I know they're
Listed's up 20 cents.
Enhance the experience and increase the ROI for ad customers in terms of using AI. So I think they're dueling it out. But if you look at market share, at least based on the last numbers I've seen, a couple quarters ago, I mean, Google still really led in the search space. I mean, MSN is.
Paris pulled back to support. I already had this charted for some reason.
I think they've got a lot of work to do, but there's obviously a lot of hope that they'll eventually close that gap.
Okay. So thinking about the transition of this market,
Boeing's at the 200 on the 1 hour.
Hardware to software, does it look like that's going to be?
We got 3 white soldiers.
Take a little bit of time before we start to see the needle really moved on the bottom line for some of these companies and their integration of artificial intelligence.
Well, you're right, Oliver, because at this point, only evidence concrete that we have in terms of AI has been through some of the reports that you and I've talked about. NVIDIA, Broadcom, AMD.
Oh, yeah, NVIDIA.
Marvell Technologies, a lot of the chip companies, we were able to show certain AI chips that they were developing that were, doing extremely well in terms of sales. And like you said, Oliver, it's been very slow coming over to, in regards to what's happening on the software side. I mean, we haven't heard that much. Hopefully, we'll get some more beyond what Microsoft talked about. That was more in the data server space. We'll have Salesforce reporting numbers, Adobe, some of those companies. Maybe they'll give us some sort of indication of, how much AI helped boost their, enterprise sales for the quarter. But It has mostly, like you said, Oliver, been on the hardware side and mostly on the chip space, where we've been able to see pure concrete evidence that AI is impacting, where it's been very slow on the software side.
Okay. Thinking about the difference between, secular growth like the AI implications versus cleaning of balance sheets like in the case of Meta. Thinking about that company in particular, it's been a little bit different because there's not a lot of big breakthrough new hot products. It's more just about kind of shoring up the bottom line.
Zim breaking out, ZIM.
The stock for Meta, does that kind of give it a little bit of its own story?
Well, Meta's interesting, Oliver, because like you said, they have switched
$20
over to AI.
from Jeffries.
They have some AI products. They have a chat box. They're coming out with a silicon NTIA, which is their chip. And of course, they're doing things to kind of enhance
breakout
their experience, like I mentioned with Google, in terms of customers and ROI and so forth. We are looking for ad revenues to increase by 20% in the quarter, so there is a growth component. But you're right, a big part of the Meta story in the past has been about CapEx, cutting costs, driving it down to the bottom line. You look at the stock right now, it's trading about 21 times year 2024 earnings.
So anybody had a good chance to buy this at $3 if they wanted to.
40 times. So the stock appears somewhat unattractive based on a historical basis. But you would hope, Oliver, that going forward, that Meta would turn more into a growth story as it relates to the recovery in ad spending, what they're doing in terms of AI and so forth, opposed to a CapEx, cost reduction, increased margin, lower spending story. So we'll try to get more evidence of that on this fourth quarter when we listen to the conference call.
You got a favorite among the bunch, Dan? Any that you feel the most confident about?
Of the 5 that are reported so far, I would probably say Microsoft is probably in the lead right now. Obviously, with Alphabet missing on ad revenues, that's a little discouraging. We know that Apple, I know you were talking about that earlier in the show, they're having issues in terms of Greater China. That's supposed to be flat this upcoming quarter, and iPhone sales unit volume is probably going to be kind of flat. So you look across the landscape. Meta is a cost-cutting story. Amazon is trying to get their feet in the ground after slowdown in terms of deaccelerating growth, in terms of AWS.
You don't sound very bullish, my friend.
Right now, at least based on
neither do I.
Numbers we have so far, that Microsoft would be kind of carrying the flag, especially in the AI software space.
All right. Always like those thoughts. Thanks for the contribution, Dan Morgan. Good to see you again.
Thank you, Oliver.
All right, let's do some trading here. Tom, looking ahead, why don't we start with Meta, as it's got clear advertising connections to some of the things we've already heard, but they spent so much time really powering up their profits that they're kind of in a world of their own.
Oh,
they are over 3 billion monthly active users, and the monetization of Reels, I think that's been a real tick up for them. During the year of efficiencies that they had last year, up almost 200% in 2023. So you have to take that into consideration. Google came in light with advertising revenue, but did Meta take some of that market share, because it seems like the digital ad spend market's still robust at this point. So that'll be the concerns going into this. You're seeing that pullback here today. Option market's pricing in about a plus or minus 7% move in the shares, about $27 either way. So I looked at something, it's already reacting to some of the other big tech earnings, just off all-time highs of 406 that we hit earlier this week. So I looked at something that takes advantage of higher implied volatility. You've got an IV percentile rate of about 60% at this point. So it's telling you that option.
Okay, we're retesting the double bottom here on SPX.
Right? So you collect
this could be the flush out.
Selling type of strategy. So
this is the last chance. It's got to come back up here, or Jimmy gets out. Oh, no.
Tomorrow after the close. So looked at selling an iron condor, going out to the February 2nd weekly cycle. So just a couple days till expiration. It's really short term.
Stay above that line.
Or theta is going to work in your favor and really ramp up over the next couple days, especially after that earnings report. So selling a put vertical that's out of the money, 365 put, buying the 360 put.
And then NVIDIA pulled back and hit the 200.
Call, that's above that all-time high. Sell the 415 call and buy the 420 strike call. So short $5 wide neutral iron condor here. You're collecting roughly about $2.30 credit on it. That's what you can make. You got $270 in risk, but you got nice wide break evens of about 362.70 on the downside and 417.30 on the upside. So just about that one standard deviation. So if you're expecting maybe a good earnings report, maybe it just consolidates. This is the type of strategy that works for that. And you're doing it with higher implied volatility levels, which allows you to collect more premium.
Okay. So, correct me if I'm wrong, you're buying spreads on both sides.
Selling both.
Selling both.
Yeah.
Okay.
Yeah.
So you want it to stay where it's at.
You want us to stay within those break evens. 90K is going to be in your favor, and then we'll see that vol crush post earnings. So yeah, this is taking advantage of that higher implied volatility.
All right, so you get benefit from a wide range of outcomes.
Yep.
For Apple, you've structured something a little bit more positive, a little bit more bullish.
Yeah, a little bit, but still giving myself some room to the downside. Now we pulled back from those all-time highs. There's concerns about iPhone 15 sales and how much of the services can pick up the slack there if it's a choppy quarter. Now, they guided in line for this first quarter during their last earnings report. That kind of hit the stock initially, but if they beat that basically unchanged line as far as revenue goes, it might be a positive for them. So I looked at something, takes advantage of higher implied volatility also, looked at selling a cash secure put, and this is a strategy if you're comfortable owning the shares. It's not a pure earnings play. I went out to the February monthly cycle, so 2.5 weeks till expiration, and I just sold it out of the money put here, the 182.5 strike put, collecting roughly, I've got a 290 credit on here. It's closer to 350 now because the stock has continued to move down, but the credit that you collect takes your break even. If you collect 290, your break even is going to be 179.60 to the downside. That's about 3% below the current share price. Option market's pricing in about a plus or minus 3.5% move, so you're right there. But this is a type of strategy to where, hey, if the stock goes higher or remains where it is, you're going to make money. And even if it goes lower but remains above that break even, just below 180, you're going to profit on this one. Hey, and if it falls significantly, you only do this type of strategy if you're comfortable owning the shares on this one over the next 2.5 weeks.
All right. More straightforward here. Selling the downside in Apple. Okay. Looking forward to get through that high, ideally, that it's been struggling with. All right. Thanks for the trades, Tom. Coming up in hour 2, we're going to shift our focus over to Qualcomm, back into chips, and a big winner over the last 3 months. In particular, as we start thinking about Apple too, a key player still in their supply chain. We'll trade it.
VIX is rocking higher.
Coming back.
Come on now. It's not been an easy trade right at open.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds.
Ladies and gentlemen, the new chartist artist for Schwab will be James Howard, alias aka Washboardjim. He's charted over 1.5 million charts. He's owned many chat rooms. He even remembers Pia Zadora. That's right. Blanket. My favorite. The Good, Bad, and Ugly. One of my best movies.
Go ahead. Make my day.
That's right. I like to see this thing rock. If it doesn't hold here, I've definitely got to get out and go the opposite. We've squeezed too long. Well, not yet. This can go on for 40 minutes. Microsoft's pulled back to support. We failed the 200, but we're still at support. 1 Tibus, 3 bis, 4 bis, and 5e. And watching the video on the black dot, we're still red, but we're on the 200 here. I had 607.11 yesterday. Went 613 today. No, not looking good. Come on. I don't really have a chart here, except a Darvis box. I mean a pattern.
Crude oil has picked up the pace and is firming over the past couple of weeks. And charts, you're going to be looking at Corvo, also in that Apple supply chain still. We're going to look at Royal, that's got an insane new ship out. And we're going to look at Merck, too, as healthcare is actually doing best today as a sector. I've got Alex Coffey, host of Next Gen Investing, here on the Schwab Network with me in the studio. Kind of hard to know where to begin here, Alex. It's a really interesting session. We spent a lot of time talking tech, but I think my first takeaway is that we've got some pretty big sell-offs. I mean, Alphabet down 6%. Everything's down at least 1% in the category except for Microsoft, and S&Ps are only down 60.
But sir, they're up 100%.
There's still so much on the docket for this week, so I don't think that the jury's necessarily come to the conclusion yet, or investors have really decided. But we're on the edge right now.
I agree.
Yeah, we are.
So I don't know. I'm not talking long term. I'm saying this week.
Yeah.
I don't know how much good news can really come out. It just does it get worse?
Well, it looks to me like I'm going to have to get out of this thing.
I know we don't want to spend a ton of time on tech. The Microsoft earnings were the best of the bunch, and you had the stock up $4 at one point. Now, granted, it's down 1 or 2, or it's down 2 or 3, and even the AMD and Google aren't that bad, but they needed to deliver something that really wasn't deliverable. In AMD's case, I don't know what they could have said. I mean, the stock could, I'm surprised, quite frankly,
They could have said irrational exuberance.
It's a $100 stock off some valuation metrics, and they didn't meet the bar, and the stock's down $10. So you look at some of these situations and how we set things up. We got the Fed now to deal with. The Fed's, you got to look at how this Fed is operated. What has Jerome Powell's Fed operated as? They've kept every door open for as long as possible. Now, they made a big shift in December, but ever since that, they've been very, very careful not to shut all the doors on the way back.
Totally.
So I expect more of the same in that sense. And so while I feel it's going to still be in this dovish lane, isn't going to be as dovish as the market needs.
TME's having a good day.
This is basically saying the Fed's going to start cutting rates. The Fed is
They were talking about NVO this morning.
And even if they want to cut in March, I don't know that they can say anything today that's going to lock them into that. Just because
NVO.
Well, that's where the tech selling gets
begins gradually increasing supply of blockbuster weight loss drug.
I mean, the 2 years dropping
Wegovy
this morning. The 10-year is down to 4.1. Sorry, it's below 4 right now. The 2s are at 4.1. The 10-year just went below 4%. We got a big bond rally. I mean, it started with tech coming off, so you kind of had that traditional buy bonds as safety. Then you've got a regional bank that's down huge.
Man, this, come on, do something.
This morning, to your point, with the 2-year dropping, I mean, it puts even more pressure on the Fed this afternoon.
It no doubt does, and I think you have two of the biggest risks that face the market.
Oh, I'm far out of the money now. That's not bright.
It's valuations. We don't know what's going to happen there. But the other risk is something much greater, and it might be a much lower probability, and it's something we were reminded and warned about in March of April of last year, which is there systemic banking risk? And is it due to communities that are tied to corporate real estate? Is it due to some of these regional banks not being capitalized well enough to handle some of these loan losses? And we're seeing it this morning, a massive move lower in the New York Community Bank Corp, which, if you remind the viewers, and you may remember, this is a company that bought a lot of the Signature Bank stuff. So this is directly tied to that. And
maybe that wasn't such a great idea.
Well, this is a reminder that, hey, this stuff is like kind of like an earthquake. It happens, and then there's aftershocks. There was just a massive delay, and so while the Fed's BTFP was able to put a Band-Aid on a lot of
airlines are all under the 200 on the 1 minute.
Some of the fear, it didn't necessarily solve the issue. The issue is much more than just rates going higher. There's a lot of corporate real estate right now that's just not being used, and there's no demand for it. There's so
Snow.
much breakdowns and things happening behind the scenes, and now there's going to have to be refinancing, and it's corporate real
Down
estate
$5.
leases aren't quite as long.
Yeah.
And the rates are way higher. So there's a lot of kind of economics uncertainty behind the scenes.
Still in the
And that's where
SPX.
this comes in as we set up this situation going into the Fed. This is the yield curve. It's been inverted for we know how long.
You've got 10s to 2s here.
This is 10s to 2s. I don't know what's going to happen with the 10-year. I don't know what's going to happen with the 30-year or the 2-year based off what the Fed's going to say. But I will say if it's not dovish enough, we may see that this starts moving more inverted.
Okay.
And
Inverted.
If you see something delivered dovish, very dovish, interpreted that way, you may see this strengthen a little bit, steepen, work its way towards unchanged. And
which is historically when the recession's hitting.
Or the soft landing. So it's one of the two. There hasn't really been a lot of soft landing.
If it's happening because the Fed is cutting, it's typically because there's recession. If it happens like it did last summer, when GDP is printing 5 and long bonds are just selling off, that's a little bit more encouraging. But this morning, with the 2-year dropping as hard as it is, that is basically, if we start to see
Airbnb at a double bottom.
That would be more kind of in the slowdown camp.
Just for today.
They cite reasons like that. I mean, there's plenty of the regional PMIs that have been alarming, but there's also
Bind is down again. I mean, BYDDF, China.
And I expect the Fed, who's claimed to be data dependent, has been one to leave as many options on the table as possible to talk a mixed picture. Talk about the risks that are there. Talk about inflation not being as big of a risk.
China.
But the fact that largely things are still okay right now.
Anybody in the SPX with Bobo?
Going to bring, but this hasn't been a Fed that acts on tomorrow. It's been a Fed that acts on today, and that I think is going to be their ultimate, kind of. I don't want to say undoing.
It got down to 280.
Strong of a word, but that's going to be their.
I'm too far out of the money for one.
Talk themselves away from in December, saying that this is the mistake every Fed makes: is we wait too long.
Market is really finding conviction. We're up now close to 70% odds of the March cut. That's how big of a bond rally is happening.
Big bond rally.
Last night, we just jumped 20 percentage points in the cut odds. I mean, this is how.
I wonder if it's taking in what we're going to do to Iran if we do anything.
Indeed, this is the banking stuff. This is the uncertainties there. I think it has to be, right? I mean, we saw how quickly it got them to come out and address it when it happened last year. It's coming back now.
I mean, I remember when Biden first took office, or even before that, he thought that Trump would get us into a world war with Iran. And then they went over there and did their little nuke deal, gave them free oil, so they got almost $300 billion richer in 3 years.
We choose truth over facts.
That's right. Still squeezing on Mark. Now what is that, the 1 hour? Let's change this around, see if I got something different. No. Okay, I got to make a business decision here. Our first candle below my support. So if I grab 4 more, that'd be a little bit too much. I don't want to go in that deep. QCOM.
That's going to be a lot higher than what we saw this time last year. Definitely some headwinds that they had to get over. But once again, we are seeing some bearish activity, but also on the call side, we actually have some call activity too, about 5 times the average daily volume here. Now, they mainly have 2 main segments. There's technically 3, but 2 main segments that we're going to focus on. QCT, which is going to be the actual equipment. That's going to be the hardware, the supplies, the circuits that are going to be needed for a lot of the equipment that they assist with. So handsets, 5G networking, things of that nature. And then they have the QTL segment, which is their licensing business. That is not that big of a revenue share if you look at it as a whole. The QCT business is around 83% of revenue. So we are actually expecting that QCT segment to come in at around $8 billion for revenue. The QTL segment to come in at about $1.35 billion. That would be around 11% decrease on a year-over-year basis. So why do I bring this up? Big thing is going to be handsets. We know that they are an Apple supplier. We know that there's a lot of commentary and speculation that Apple iPhones are actually seeing a little bit of a slowing when it comes to demand, especially in China and some of the other markets there. That could be a little bit of a headwind for them. We also know that the automotive market, which they do have a hand in, is also seeing a little bit of a slowdown. So we're going to really get a peek at some of the very significant areas of the economy that we are seeing some anecdotal data as far as slowing. This company here will show us and tell us if that's going to actually be the case here. So that's what we're actually looking for. Handsets, automotive, going to be headwinds. If you're looking at 5G expansion for networking, that's going to be a tailwind, but just not as aggressive of a business at this point in time.
Okay. So Qualcomm here, generally is a pretty good broad consumer kind of macro indication. This is not really going to be hitting in any of our super secular high growth areas.
Right, yeah, you're not going to have the huge AI impact at all, really. This is going to be kind of a boots on the ground type of earnings announcement. What are we looking at from 5G network expansion? We know that CHIPS Act's out there. We know that there's some infrastructure spending that's going to be a tailwind for them. Getting those dollars out to those companies has been slow, to say the least. And then you have the automotive sector, you have the handset sector, all of these key little areas, the analog business, all these key areas. We've already seen earnings announcements from companies in each particular
The old Jimmy would have sold that at a loss.
You're starting to see a little bit of slowing here, and so that could be a headwind for them moving forward. Now, Apple extending their 2-year contract.
Now, if we break this, I think if we break this support, I'm back in business.
Doing a really good job with trying to be
But
very
now
transparent.
becomes a
We're not
resistance.
trying to bank on those future earnings moving forward here. So they will definitely downplay that on the call. I'm sure an analyst will actually have a conversation about it. So maybe a near-term tailwind for the most part, but I don't think it's going to be something that the market's going to really factor in.
Hold that tweezer bottom. That'd be an excellent deal too.
And the Apple ties less than they used to be, but still a decent indicator. If Qualcomm ramps up or blows up, I imagine that kind of gives us a little bit of marginal information.
QCOM.
Yeah, definitely. We have two companies that really are going to give us some insight on
Apple's
that.
got a snake here.
And then we also have Foxconn as
Apple.
well, which is not really publicly traded, something that's talked about a lot, but they do have a huge impact when it comes to supplying Apple. Foxconn's already come out over the last couple of months and said orders have gone down, supplies are building up, if you will. We are seeing a slowdown. We haven't had that confirmed yet when it comes to Apple. When we get those earnings, they're going to be able to tell us here. Qualcomm's going to give us the other piece of that puzzle. Are they seeing the same trends as Foxconn is? And if that is going to be the case, then I would say we probably
keep
have
an eye
some
on my
downward
call.
pressure, maybe some continued downward pressure for Apple, if it's not already priced in. The hardware sales might be slowing down here.
Okay, good stuff. Good report. Thanks, Kevin Green. Qualcomm this afternoon. Shares higher in a down tech market. Scott Bowers with us to trade it.
Shares higher in down tech market.
Fun one this afternoon, Scott, as Qualcomm seems to be resilient despite softness. Yeah.
Yeah, it is.
What do you think?
Well, you look, I think Kevin had alluded to this, you look at the option market, and it's very similar to what we saw at AMD, where the upside call volume far exceeds downside puts. The skew is to the upside calls. Obviously didn't work out for AMD. We'll see what happens with Qualcomm. But when I look technically at this chart, I'm throwing everything else out. There's an area right around 137, 138 that has some pretty decent support. I am willing to own the stock down there if it trades down to that area there. So
I love this guy.
There's a trade that I can make that gives me some downside advantage here, and also lets me get into the stock on a real big blowout to the downside. So what I'm doing, Oliver, is this is a February expiration. I'm buying one of the 140 put. I'm selling two of the 137 puts. I can collect about $1 up front for that. So
you can.
If Qualcomm doesn't go down, it goes up, fine. I keep my $1. End of story. If it does go down, my break even on that is all the way down at 133. So I will make money on that position all the way down to 133. Below that, that's where the losses start to come in. But remember, the 137 or 138 area is an area that I would buy the stock anyway. So I'm giving myself another 2-3% room to the downside there to get the stock just in case it does drop. I really like this setup for Qualcomm.
Yeah, this is because Vol's bid into this makes the most sense.
Exactly. Exactly. So it lets me collect that extra credit there. Sure, I do have risk on the downside.
I got to learn how to trade like these guys.
Because I don't.
They're very safe on how they do it.
If the stock really falls out of bed here, if I was somewhat queasy about that or didn't want to have the stock, I probably wouldn't take
pretty
this position.
world
But this
today.
gives me money up front, the dollar credit up front, gives me all this room down to 133 where I can make even more money. And then if it goes below there, I get stock lower than I wanted it in the first place.
Okay. And Qualcomm down there, I mean, after such a big move and doing it without any real AI implications, it seems like it would be in a pretty good spot as long as the economy is not like rolling over a cliff.
No doubt about it. And listen, if it gets down there and it starts to fade away down there, okay, I'll manage it down there as if I had a long stock position. But, we've seen some big movers, right? We've seen some out-of-the-box movers here. Kevin alluded to about a 4 to 5% move here. This, where we're trading right now, all the way down to 133, you're talking almost 10% move. So I really like that.
All right. What do you think in this market generally, Scott? Give me a quick thought, because we've got a big bond rally today going into the Fed.
I'm really confused at that. And I don't think it's as much what we saw out of earnings from big tech as maybe the employment situation here. ADP came in real light. I don't necessarily look at ADP so much, but I'm thinking the market is expecting a very light number on Friday and maybe getting ahead of that a little bit. This is a massive move in bonds today. And to see, as you guys just talked about, to see that
massive
Fed watch go from 40% possibility in March cut up to 70 in one day, that's almost unprecedented.
Yeah. All right. Thanks for the take. Good stuff. Appreciate it, Scott Bauer.
Thanks.
Sell the downside in Qualcomm, ready to pick it up if it slips. CEO Prosper Trading Academy. All right, let's talk some energy when we come back. WTI has been picking up the pace, and that gives us an interesting situation for that sector's earnings. Haven't talked a whole lot about it, so let's be fair to the rest of the market outside of big tech. Be right back.
China's up some today. Got K-Web, Baidu. Better sell this thing. Another threat. I don't think I had breakfast this morning. No, I did not. No wonder I'm yawning. tempting to get me some more here and really bring his costs down, especially if we hold this here right now. Four times 2.75. That'd be another $1,100. Yeah, let's do it. If I can get I'm going to try to get in 275. There it is. Nailed it. This could be a catastrophe. $313. They got more at 275, 4 more. So I'm definitely over my limit now. There we're almost even. It should be moving up. Let's hope. You got 8 contracts at 313. Man, I'm nippy today. I don't know if that guy should have bought puts yet or not. We're at the 21. Okay. It's not looking too good. We've got 3 higher lows. That could be a good sign. I'll be right back.
For crude, for WTI that is. The context here is that WTI averaged about $78 a barrel in 2023. So historically speaking, that's a pretty good number. And in fact, these companies like the Exxons and the Chevrons of the world have done a really good job at extracting cash flow out of $70 or $80 oil. They're making more money today at those prices than they did a decade ago when oil prices were over 90. So I think that speaks to them getting their cost structures in line. Their balance sheets are extremely clean. So I don't think you need $80, $90 oil to make a decent amount of money. It's probably not going to be as strong.
And Biden had a war on oil. Now look at them; they're making more money than they ever have. He was going to put the end of production under his watch, and the world goes in total chaos because there's war on oil. I don't think they'll ever learn.
Yeah, so different kinds of acquisitions. So it's an interesting question. Exxon's biggest
Same thing happened with
of Pioneer Natural
Obama.
Resources is kind of a short cycle play. They're ramping up their Permian Basin exposure. So I do think you're going to see Exxon bring all of its technology to the fore.
When he left office, we were at a total output, the highest ever.
Permian than Pioneer was able to do. And so I think that that might have an impact on 2024 results for Exxon to the positive. Chevron's planned acquisition of Hess is a very different animal. That is much longer term focused. Chevron already has pretty good short cycle exposure, and by them acquiring Hess, they are buying into the story in Guyana, which is likely to throw off a lot more crude oil through 2027. And so that's a longer term picture. I see less immediate impact to Chevron from the Hess acquisition.
Okay. Very helpful, very informative. Before we let you go, though, because you also covered Boeing too, the airline connection and Boeing's connection, there obviously is a way through there with oil, but just for the moment, looking what we heard from Boeing on earnings, wanted to get your response to that story.
Yeah, so I think Boeing's numbers were not terrible.
That ain't gonna work.
Obviously the company is in damage control mode at the moment following that incident on the MAX 9. I think it's notable that they pulled their forward guidance on the number of planes they expect to deliver. So I think the big takeaway here is they are going to have to get their ducks in a row from a quality perspective. That is, it's a longer term process. The FAA is not going to let them accelerate their production schedule until they're satisfied that quality really has been fixed to the degree that they want. And so their call starts momentarily. I'm going to be interested to see what they have to say about the process and how long the ramp up is going to be before they can get to the kinds of delivery unit schedules that they talked about in the past.
All right. Great stuff. Thanks, Stuart, for your time.
Thank you.
Mr. Whitman's Deputy Research Director and Energy Equity Analyst at CFRA. Some positive commentary there for Chevron and Exxon going into earnings. Different types of deals, but both encouraged by range
that
of
hurt.
oil that was firmed up. Chartmasters taking a look at Corvo and the Apple supply chain next. Merck is healthcare is acting as a safety trade today, and Royal Caribbean.
Royal Caribbean.
Knock knock.
Got a red map going on. Still in this thing. You're going to see here. Uh-oh. AMC's popping. I'm definitely tanking. Damn.
Around this point near 108.50, this was a frequent stopping point for price. You can see it's stopped there a few times.
Okay. So wide range of outcomes. I mean, this thing moves around quite a bit. It's definitely one of the less stable hardware stocks out there in the semiconductor world. So if Qualcomm's an indication, then maybe Qorvo can firm up a little bit, but it's a really interesting one. And if we're looking for weakness in chips, it arguably is one of the weaker ones to keep an eye on here. All right, switching gears a little bit. Today with equities under some pressures, a little bit of buying action, some of the defensive stuff. Healthcare stocks are firm. Merck is doing well, but you got some good stats on Merck and some of the exclusivity of their big drugs.
I did way too much reading this morning on Merck because
No such thing.
You do learn something about your healthcare system, and it's that it does seem like some of these major pharma companies.
We're at the 200 here on the 1 hour
We're not there
on the
yet,
SPY.
but a lot of these major patents for their blockbuster drugs are set to expire by 2030. For Merck's case, that's Keytruda, which is facing this patent expiration of in 2028. I know that seems like a lifetime away. Like to me, I'm like that anything could happen by 2028. However, it is being read actually by a lot of
There's no support on the SPX.
This could be something that's discussed
except
on their
that
upcoming
gap.
earnings call, just because it's a major concern for investors. Mind you, Keytruda
That
makes
could
up
drop
36%
4868.
$20 billion.
Another
So it's a pretty
good drop.
Merck right now, it's sort of their flagship drug. And this has become the 4th largest pharma company by market cap. It's grown its revenues nearly every single year since 2015. And its ability to generate these high operating profit margins has been exceptional. I mean, just to go through over the last 5 years, starting back in 2018, we've seen margins at around 24, 27, 19, 29, and 35%. Target is 43% by 2025, but that's a pretty solid track record, especially in the healthcare space. And if you look at over the last year, we've seen, or excuse me, 3 years, this has been one of the best performers, only second to Eli Lilly and Novo Nordisk, which is actually somewhat read differently because a lot of these companies have these more experimental drugs, like in their pipeline. It's right now we're trading on the idea that these will come to market and gross a lot of money. The good thing about Merck is Keytruda already does. So they have
Lilly's took a hit.
And in terms of the healthcare space, they have been spending, a good deal of money, $50 billion in M&A since 2019. So a company that seems, all things considered, healthy to me. They just have to figure out what they're going to do around this patent expiration. But that is, again, 4 years away.
Well, it's never too early.
Lilly down $25.
Where they've got these flagship drugs. I mean, the chart looks pretty good Rick, going into earnings.
To the 50 SMA on the 1 hour.
Because you can see for a long time, we had this downward sloping trend line in purple. Then we made our way in quick succession above all three.
Irrational Exuberance video came out in time today.
Retested it, then made our way back up in a very steep upward sloping trend line. Look at these gaps up and these large candles here. No specific news. This was just the start of 2024. Seems like maybe there was some rebalancing going on, people getting in on this name here. Since then, the gains have moderated a little bit. Now we have this upward sloping channel here that encompasses most of our price.
I'm down about $750 here on the SPX.
Trend line along the lows, extrapolated it, put it across the highs. We broke out today, but now we're retesting.
I'll be right back. I'm gonna go get something to eat. I haven't had breakfast. I've been up all night.
Even though it made all-time highs here.
I gotta get something in my stomach, get that food off my mind.
Momentum trending down as we
I'm gonna put I don't know.
Could be a kind of difficult situation here, especially if earnings disappoint. So if we do keep moving to the upside, +3 standard deviation channel comes in near 123.50 or so. We've got our old highs here for potential support.
Is that on the weekly?
Then we've also got our +2 channel and our 21-day exponential moving average near about 118 or so.
All right. Well supported chart. Looks like for Merck, even after the epic blast off. So good news for Keytruda generally, and it's
I'm gonna call
with other drugs too.
Lilly at 633.
The last one is in a totally different category. We got Royal Caribbean coming up. Got the
Off the 200 on the 1 hour.
that they just launched, like the biggest cruise ship ever. Thing's insane.
7,600 passengers it has room for, along with around 2,300 crew members. So I mean that is massive. I really hadn't even heard of this because I am not a cruise girl, but I can respect the fact that they've now officially launched that service.
I'll take you on a cruise.
162% in 2023.
You're not going to cruise.
I feel like we give a lot of credit to all the big tech names, but this was one of the best performers in the S&P 500 last year. And it also has a really, really strong track record right now of exceeding what the street is expecting. It's beaten its overall estimates by about 11% consistently over the last year. For this quarter, we're expecting that continued growth as revenue has soared 69% through the first 3 quarters of 2023, their fiscal year. Business is expected to start to slow now as we do see things normalizing as far as comps go. But overall, they continue to boost their guidance, and we also see bookings now ahead of where they were pre-pandemic, with street analysts expecting around a 29% increase in overall bookings in this upcoming report. But I have to say, I know we're up 95% on a year-over-year basis, and I will not steal Rick's thunder, but we are not at all-time highs yet that were made back in 2020, which it takes them. I always just naturally go to like default to the max time frame, and it's like, I understand the fact that these companies were hit more than any other sector pretty much by the pandemic.
It bounced back good though.
Yes, and if you're saying you have bookings that were better than the pandemic, shouldn't your stock price be better? I mean, we're about $5 away, but still, I feel like right now we need to see shares sort of reach that previous peak if we're seeing bookings that are ahead of 2019 levels.
And still beating Norwegian, still beating Carnival, beating the airlines as a post-COVID recovery trade, but I hear it, not quite there just yet. And it does look like the stock took a hit here earlier this month, Rick, that it's trying to recover from.
Yeah, and it was the opposite situation of our previous chart here. No news, just the start of the year, 7% drop to start things off here. So not a very happy new year for this stock, but we have recovered here, testing the post-gap highs that we created near 127 or so. We are right on the money for that point today. Let's see if we can break above it, push in, and perhaps into some new all-time highs here near 135 or so. RSI trending downward here, still bullish, but notably weaned in the recent weeks here, kind of more sideways than anything really. Almost an ascending triangle type shape on price here, not completely meeting the criteria for that, but that's the general shape here. So if we were to keep moving upward, standard deviation channels can help us project some potential resistance near the 140 level. To the downside, we've got the confluence of our trend line and our 21-day EMA near 124.60 or so, then perhaps our linear regression line.
Oh, we got FOMAC today. Fuck, I forgot about that.
So Royal here.
I made a huge mistake.
Cozy above 115 bucks. Tested it, held, and now we've got a big rally behind us going into the report, and we'll see what kind of guidance they give, see what kind of bookings they've got for that icon of the season.
I didn't even put two together.
Look ahead of earnings.
We talked about it all day yesterday.
We'll get you the details on that story on the regional bank.
PMI manufacturing coming out
about, and then we'll get our market meetup
tonight.
And analyze the session so far.
I remember when I first started.
That's where I'm going to make my money today.
And we would experience turbulence.
Turbulence. Is it anything like irrational exuberance? Bounce, baby. I'll be right back. Yeah, this wasn't a good move today. Rivian triple topping.
From this stock right now. I mean, what is it down? More than 30% at the moment, 35%.
Brutal. Okay. All right. Thanks for the
Brutal.
details. Definitely an ugly report. Has the sector in a little bit of a panic mode with the sell-off in regional banks, almost 4%. Kevin Haynes here with me in studio for a couple closing thoughts. I mean, this is not a good situation, Kevin. It's not a big bank, but it still is causing reverberations throughout the regionals and some of the bigger ones too, because it's like we're, repeating the scenario again a little bit.
Well, the question is, where is the risk coming from? The money that they're putting up for the risk clearly shows that there's risk.
Sounds like office.
It sounds like office space. And remember, Oliver, for months we've been whispering about the upcoming storm with office space and what's going to happen. If this is the start of something like that,
It's not good.
Great picture going forward. And you mentioned the bond rally here. The bond rally. Remember last March when the banks failed, the small banks failed. That's when yields crashed and bonds rallied. So you may be seeing a little flight in this number too. But yeah, for their provisions to jump like they did, they're in full defense mode.
Seems like maybe shouldn't have bought all those Signature Bank assets. I mean, they bought like $3 billion of them, 2.7 back in March. Going back into the time machine here, over levered, I guess, which is a little bit discouraging. It kind of makes you wonder, like, if this is not resolvable through scale, then don't forget, JP Morgan bought a bunch of these too, but a company that has got a lot more to balance things out.
And JP Morgan does an incredible job of, adjusting the risk in the portfolio, right? Just like, everyone has had to do with their bonds. It's risk management, Oliver. It's just like everything you do. Some people are better at it than others.
Yeah. They paid $2.7 billion for the deal, but it included $34 billion of remaining deposits at Signature. So it sounds like maybe that was a bad decision. I mean, obviously they bought the assets on a pretty extreme discount, but this is now makes us wonder, okay, well, who's not out of the woods yet?
Sure.
Right?
There's rarely one,
Yeah.
Oliver, right? When you get a story like this, it's rarely just one. Because if those assets were dispersed, you're probably going to hear another story. So watch the regional banks.
Mm-hmm.
Why is it going to affect the stock market? The stock market's got its own problems right now.
Mhm.
The large cap tech, but regional banks could throw a little more volatility into this market.
JP Morgan amazingly up today. So I guess market's not worried that it's going to extend to any of the real kind of central key money center banks.
Well, it may have to do with JP Morgan just may have more distressed assets to purchase at a low level.
Yeah, maybe. All right, so we're going to be going to JP Morgan Bank, all around the country. The overall move, the bond rally here is massive today.
Yeah.
It's a big, big move. I feel like, I literally wrote my newsletter this morning about how the tech earnings were going to be the top story for the week, and I think it's been spoiled because the pressure's on the Fed big now.
That's what happens with commenting on the markets. There's always something new, right? I mean, the shelf life on a news story when talking about the stock market, especially this time of year, is about 90 seconds.
Yeah. All right. Odds of March cut 70% right now, or 63%. That's come down to. That's pretty amazing.
Well,
from 45 this morning when we last spoke at the opening bell.
Exactly. So Jerome Powell's going to have to comment on that. He's going to have to comment on the economic data that we've been getting this week. Some of it quite strong in terms of jolts. So we'll see how this plays out, Oliver. It's going to be a great day.
Yeah.
We can speculate till we're out of breath.
Right.
Let's let Jerome Powell do the talking here.
Well, we're not going to run out of breath, but we are running out of time, so we got to jump. Catch Kevin Hinks on Fast Market, of course, and I will see you this afternoon. I'll be joined by Dennis Lockhart, former Fed official, going to tell us his thoughts about Jerome Powell. So don't miss that at 2 p.m. Central Time. Of course, more earnings after the bell, too. We'll continue to look at chip makers with Qorvo and Qualcomm. Nicole Petalides is up next, 360.
Schwab Bank Investor...
Never eat my pickle? I don't remember one bite. Huh. I guess I ate my pickle. Lily holding up the 50 right now on the hour. The 50 SMA. The video has a 1-2, almost a 1-2-3. It's got a tweezer bottom on the hour. Yeah, I'd say we hit it if you want to count the wick on the video. We'll see if we pull this out of my hat today. I'm doing a little bit of swindling here. I don't like trading like this. Nobody should trade like what I'm doing right now at all. It's all about hope. Got a lot of contracts. My average is at 251. But if it runs, man, I'll be rich. The fudge. Oh, let me see. I just need a little more. Yeah, I'd be down 320 if I get out right here. No, I won't either. What's going on here? It's cheaper than what it says. Dang it. And the video bounced off the 1, 2, 3. Come on, break it. Come on, break it.
But there are some good rate cuts. If inflation really does start to decline faster than the Fed thinks, real interest rates, as we talked about before, are really, really high right now. And the Fed has to get real interest rates down to somewhere in the 3/4 range. Right now, they're at 1 3/4, almost 2%. So there's a lot of room for the Fed to cut. The question is, how fast will they have to cut? And that will have great impact on our portfolios.
Very good man, very smart man.
They're going to be good rate cuts because inflation is coming down, and the prospect of a economy crashing is really quite low.
Right, those big recession fears, the big worries of the hard landing seem to have dissipated. And there's really a feeling from a lot of the folks I speak to, Bill, about that he won't necessarily show his whole hand. For example, he may say higher for longer for some time instead of saying, oh yes, we plan to cut, 4 times, 5 times, 6 times. I mean, why even bother trying to allude to that? It's better to sort of stay on the Fed speak, right?
Absolutely. In fact, I've been very critical of the Fed for doing exactly that. Because Powell has this sense of, I'm going to bob and weave, and I'm going to be a real boxer and not let the markets catch me. That's not the right way for a Fed chairman to behave.
That's right.
Telling us, look, when inflation starts to come down and gets close to 2%, we're going to be cutting. The question is, we need to be convinced that it's near 2% and it's going to stay at 2%. We're not going to get surprised again. That kind of guidance is something that the Fed used to do before with forward guidance. He got burned by that, and I think he says, forget it, I'm going to be bobbing and weaving. Bobbing and weaving means the bond market volatility is up, equity markets are uncertain about what to do, and our audience out there is saying, my God, what is the Fed up to? And all this discussion of what the Fed is up to, he could really calm people down by saying, look, we will be cutting. The question is, are we convinced inflation is going to stay at 2%? And we'll tell you as we come along how convinced we are. They do that, and we're going to solve a lot of problems.
Yeah, you have real long-term interest rates. That's something you're watching closely. Tell me a little bit about that and why that's an important distinction.
The cost of capital is with long-term rates. When firms go out to borrow, it's somewhere in the 5 to 7 year range. The 10-year is always a good benchmark for where these long-term rates are. And if you look at these long-term rates, they've come down quite a lot, but the inflation-adjusted interest rates take away the expected rate of inflation over the next 5 years, and you find that the real interest rate is at 1 3/4. That's very high compared to the historical norm of somewhere around 1/2 to 3/4, maybe 1%. Those are levels that will sustain growth at a moderate level.
Come on.
At a really a good level, a healthy level for the United States. Right now, we're way too high, so the Fed knows that.
I could be smart and get out of here and get out with a lot smaller loss. But I'm
right now. we just got numbers about industrial production. The manufacturing sector is really doing very
We've got
bad.
3 white soldiers here.
Now, if that spreads to the rest of the economy, then we get bad rate cuts.
We broke out and we pulled back.
Very low. Look, GDP now forecast by the Atlanta
They can
Fed
easily
is at
pull back. I
3%
mean, the
for
market's
first
not
quarter.
in
So
good shape
the economy
today.
is chugging along pretty with a pretty good head of steam, and that's what gets the Fed concerned, that because the economy is so strong, inflation may not come down as fast as we hope to get those good rate cuts.
Yeah, on your notes, you talk about some of the geopolitical risks. You talked about the election in Taiwan. You talked about the Red Sea. I mean, of course, there's a lot.
Who is this guy?
Those two stood out to you. Why?
Well, you know, last time I was on with you, I said inside baseball discussion is always about the real rate. And the question is, what could knock the real rate off course? And right now, the domestic economy looks pretty good, but these geopolitical risks.
A picture frame. I used to frame that same molding right there.
Is because our supply chains got disrupted by COVID. What's happening in the Red Sea right now? Well, that disruption is starting to get much more serious, especially since our U.S. troops are starting to get hit. And if we find that supply chains get disrupted again, and more importantly, these regional conflicts become much more widespread. If Ukraine, Gaza, which were really considered by the markets as contained and not having an impact on oil prices and other systemic
really need to make a decision here.
If the Red Sea is a wild card, because that could really put supply chains at risk. The election in Taiwan, people have completely ignored, and they thought that maybe China is okay with that because the Kuomintang has got an authority in the legislature. Remember, our supply chain of semiconductors comes directly out of Taiwan, full stop. That's the main supplier of our advanced semiconductors. We disrupt that, and we get some serious problems with our economy. So these are things I think the markets have not priced in adequately and have really not paid a lot of attention to. It's not a high risk right now, but keep an eye on it, because those are the scenarios that would add to the risk of our domestic scenarios and cause the Fed to pause in its rate cuts.
Billy, always great to have you on the show of the Milken Institute. Thank you so much, and on such a key day today.
Thanks,
I liked our real discussion.
Who is this guy?
Right? Real rates, real discussion, because today is huge. 2 o'clock, we'll have a special show, of course, too. Plenty more to come here on Trading 360. Up next is the big 3. 3 stocks, 3 charts, 3 trades. Rick Ducat will take us through the technicals. Don Kaufman will take us through the trades. For Citigroup, energy sector, which will be the XLE, and Netflix coming up.
My dad was a hard worker. He used to do side jobs installing windows.
I can't stand looking at you. You remind me of that guy in The Good, Bad, and Ugly. The one with the big mustache. Or is that might be at the OK Corral. I think that's the one. Exactly. Break it. I beg you. I think if we break this resistance, we'll come up here and hit this top. Then I'm going to be doing a dance. Almost said the hell with it and sold it there on that dip. Okay, come on. Do it. Fucker ain't moving.
Stock Exchange. Time for the big three. 3 stocks, 3 charts, 3 trades. Rick Ducat will take us through the charts. Here to take us through the trades, Don Kaufman, co-founder of Theo Trade. Great to see you both. Today's Fed Day, Don. You have any thoughts, what we might hear from Jay Powell, how you're feeling about the market
It's too far out of the money for this thing to move good.
Yeah, I would say the biggest implication of the Fed meeting today obviously is not about are they going to move rates today, because that's pretty much off the table. It's going to be about March. I'm still relatively surprised that the Fed fund futures are showing about a 61% chance of a rate cut. I think everybody would be rather shocked if they did in fact cut rates. Like, look, Fed fund futures though, they see
Got three white soldiers
on economically that is simply wrong. It's why the Fed fund futures are there. 26 years in this business, learn to trust the marketplace, and I think you have to in this particular case. But if Powell staves off the idea of cuts, the markets could be incredibly disappointed.
Right? And there is talk that he may just sort of play this...
especially when they priced in 6 rate cuts.
Just to keep the market.
They say. I don't know how they can say it, but they did.
Let's talk about Citigroup today.
Come on, get on up there. Then I can quit talking about this beast.
The financials fall right into the genre. I mean, if you look at Citi over the last...
Nvidia's almost hit the 200 on the double bottom booyah.
Even this week, it has been exploding to the upside. And I think the irony of this is, if you look at the last few trading sessions, interest rates are coming down and the financials are still exploding to the upside. I think this is opportunistic.
And my chicken is still $33 for 6 breasts.
The end of the tech rally, and you're seeing now managers throw money towards financials, Citi specifically. In any regard, this rotation looks like it's coming to an end at this point. I think, again, we have people rotating into the financials and just completely negating risk. As such, in Citi, it's kind of one of the top performers of the big banks, and that's actually why I selected it. Look, I'm bearish on financials overall, but Citi is the top performer in this particular group. I'm going all the way out to the April 19th expiration. So I'm going to put on a nice options put spread. April 19th, I'm going to be buying the 55 puts, selling the 50 puts. So it's a $5 wide put spread. I'm doing it for a $1.20 debit. That put spread kind of keep that risk contained, keep the volatility exposure down, and set us up very nicely between now and April option expiration, if in fact we do see a bit of a down move.
Yeah, we see it at 57.30 today, Rick. Tell us about the charts, please, Rick Ducat.
The most noteworthy things about this chart are that we have this this long slide downward. You can see with our pink trend line here, just taking us lower and lower until we hit these yearly lows near 38.17. Since then, we are up 50% from those lows. So like Don said, an explosive move to the upside here. Just a brief period of consolidation here for about a month, so barely a pause in the grand scheme of things when you look at this upside action. So we're above all 3 of our moving averages. The moving averages are all trending upward. We are making 52-week highs today. Certainly not all-time highs, 52-week highs though. We can look at our RSI as well and see that the RSI is in the overbought area. So in general, according to our trend indicators here, we are more geared toward the upside here. And the move up also took us through some interesting levels here. Here's a good example of why it can be useful to keep track of highs on your chart here. We had a gap downward here. This was our closing high then. We once again hit highs in the same place 2 more times. Then we broke above them with some energy here. Similar
wish they did better on
here.
charting.
Some highs, broke above them with
I mean, the camera wise.
Retested that level. This is why keeping track of these highs can give you a useful gauge of where you could choose option strikes or other ways to plan trades here. So now if we look at our standard deviation channel study, we can see that we have our blue linear regression line, our line of best fit based on closing prices, then +1, +2, +3 standard deviations to the upside is about where we stopped today. So this is a resistance point. +3 standard deviations is a fairly extreme move based on a stock's own price history here. So I can see the thinking behind Don's trade that this might be stretched a little thin here. So
well, I'd say so.
Keep moving to the upside though, +4 channel, comes in near 61.73. That's where you might find some potential resistance. To the downside, these old highs right here, 54.33, so about 55. Then we've got some lows here near 50. So this would be kind of the strikes for Don's trade, roughly speaking here. So that could be some supportive areas to watch going forward.
Right. I mean, you know, the stock has been sitting around, to your point.
Definitely on the pivot point area
This is the name
on City.
that is the one out of the group, Don, that jumps out at you as the one to trade. Why is that?
The explosive move in the financials, I mean, Citi is basically taking the lead in here. So most of the other financials are up about 3% year-to-date basis. Citi's actually exploded up literally over 7% year-to-date basis. So this is more a selection based on
NVIDIA hit the 200 on the 1 minute.
When the pullback comes, and it will come, I think it'll be more extensive inside of Citi. But it's one of the reasons I'm actually giving this trade some ample time. I'm all the way out to the April expiration because, you know, I'm the first one to tell you, you know, trying to time that particular pullback and these cyclical rotations is incredibly difficult. But make no two ways about it. When you're seeing interest rates like, you know, today go down and Citi, you know, exploding higher on it, okay, that, again, it just reeks, if you will, of managers throwing caution to the wind and trying to outperform.
Huh.
Let's get to the XLE, and we look at energy, and there was one article, a hedge against things more out of control in the Middle East and so on. You're watching energy XLE, these energy names, the energy stocks. Tell me a little bit about the XLE today, which is at 84 and change.
Sure. So, you know, Rick can look in a moment at some of the technicals, but, you know, it's obvious there's geopolitical risks. OPEC Plus is continuing to actually cut. There's still significant demand, although the demand, of course, could be called into question because of China's economy. And that's fine. But the XLE, just not a great performance overall in the last year, but is on the bid right now. And it's rare that I actually hop on trend. And this one right now, off the 80 level, is ripping again to the upside. It's, as you said, right around the 84 level. I think it have legs even close to the 90 level, meaning you know, this run from 80 recently, possibly getting all the way up to 90. As such, I've actually built a nice little tight call spread in here. And I say a tight call spread, it's just going to be a $3 wide call spread. Look, I don't care how we profit as long as we can actually profit in a given spread, but it's about minimizing risk. This spreads out to the March 15th expiration. So the March 15th expiration, I'm going to be buying the 85 calls, which are just basically slightly out of the money. I'm going to be selling the 88 calls. Again, a $3 wide spread. This one's done for about $1.15 debit. So again, barring any unforeseen circumstances, the geopolitical risk doesn't look like it's going to abate. OPEC is not exactly going to go out there and do anything, you know, astounding between now and the March 15th expiration, other than possibly cut again. So this is going to be demand driven. I think we have a fairly good opportunity right now for continuation to the upside inside of the energy complex.
All right. Talk about the continuation to the upside. Is that a possibility? Take a look at the charts here, Rick.
Certainly. And we can see that not a lot of net movement during the past 52 weeks. We're down about 6% during that time here. So we've seen some chop.
I really like how they do business here.
We're pretty close to where we started out 52 weeks ago. Notably hitting some highs near 93.69, trending downward from that point here, connecting these highs here, and today we bumped up against that line. It looks like we were not able to make it all the way above that point here. So we've got a lower trend line as well. It may be a little tough to see, but they are converging toward each other, giving us more of a falling wedge type shape rather than a channel where the two lines would be parallel here. Look at our moving averages. Our yellow 21-day, orange 63-day, purple 252-day exponential moving averages. The two longer term ones basically right on top of each other with flat slopes. The 252-day EMA is flat since yesterday. The 21 EMA trending upward here. But, you know, this suggests a lack of trend direction here, kind of a trendlessness, so to speak here. As we've seen some chop up and down here, we can see that our moving averages are not really able to solidify in one particular direction at this point here. RSI, not too much interesting going on here either. We are above the 50 midline though. Couple that with our price action being above our moving averages, and our moving averages, our short-term one at least, is trending upward notably here. So now we have to consider where we might find support and resistance. We are at a resistance point today in the form of our trend line with our volume profile point of control, the area of heaviest trading according to our volume profile study. If we can break above this trend line here and this resistance area, you know, that's right around 85. So that's, I believe that was Don's long strike here. So our next best close was around 86. The best close after that was around 87.50. So 85 to 88 makes sense to me. That seems like some pretty reasonable price action to be on the lookout for. To the downside, we've got our moving average confluence right there near 84. Then we've got our 21-day EMA near 83. So those would be some areas to watch in the shorter term.
All right, and those areas of resistance, you pointed those out. Final thoughts here, and then tell us about Netflix, Don.
Yeah, no, I think it's actually a great assessment on Rick's behalf on there with especially the volume profile. Again, nice bid though. Under that should see some continuation. Netflix. Let's move right on Netflix. So in terms of Netflix, one of the things that you have to look at is, of course, it's been an explosive move to the upside. It's unquestionable. Coming off of the most recent earnings announcement, subscriber beat, it's spectacular news. Nevertheless, Netflix right now is already off that recent high of 580, and it's trading in the 560-ish range. So it's already had a nice pullback. My argument here is quite simply, I think it's going to get caught up in what could turn into a tech slaughterhouse. And you might be seeing some tech slaughterhouse right here, right now.
Jimmy said that.
With that in mind, I am placing a big-time out-of-the-money put spread on it. Now, I love to take these out-of-the-money shots, and I love them because, first of all, they're relatively inexpensive, but they're also lower probability. That's not, you're thinking that's not a great thing. Well, it could be a great thing if we get the big and substantiated move to the downside. With that, again, I'm going all the way out to the April 19th expiration. I can't sugarcoat this. Look, if we're going to come down, it's going to take a little bit of time, but it could be a vicious move. Again, especially if we get caught up in what I call the tech slaughterhouse over there, which is
April
long
19th.
overdue. So, sorry, this is the bear in me coming out. I'm going to go out and I'm going to buy a 535 put. Again, 535 put. I'm going to sell a 525 put.
They ain't cheap.
I said I like to use spreads. This is a $10 wide spread all the way out to the April 19th expiration, done for a $3.15 debit.
What?
Again, I like to be on the other side of trades like this, and we may have seen Netflix top out in just the last few days.
Understood. Okay, so with that, was that it? Was that the top? It did hit 579. Your thoughts, Rick, when you take a look at these charts, please.
Definitely an interesting chart on Netflix here. You can see that, first of all, if we
take it back to the gap,
you can see price topped out numerous times in terms of our closing prices around this green line here near 447. We had a breakout above that point. Guess where the subsequent low point was during the next downswing? Right around that same area here. Another illustration of why it can be good to keep track of these highs and lows here. Since then, ascending triangle type shape of price action here. Horizontal resistance, upward sloping trend line, typically regarded as a more bullish pattern. Interestingly, RSI displayed the opposite pattern, a sign of slowing momentum as price coiled in an increasingly tightening range here. So that makes sense that momentum would slow down as our two lines here converge toward each other, but we did get a nice breakout to the upside on earnings, a big move upward here. RSI, once again in the overbought area, typically regarded as a sign of strength. Look for the cross below that threshold 70 for a bearish signal. Now the thing I'm curious about is, what if we have a bullish pennant type pattern forming here? Typically forms when we have some kind of fundamental change, big gap upward, brief period of consolidation, then another surge to the upside here. And you can see that we've got a little volume node forming here, suggesting some conviction at these elevated levels. At the same time, I can also understand the bearish case for this name here. So let's consider that. The 535 strike makes sense to me because 537 represents our post-gap lows. On, you know, a couple bucks on a 500 and some dollar stock is not really that big of a difference here. So 535 makes sense here. If we keep going further below that, 21-day EMA near 518 or so could be another point to watch. To the upside, +2 channel, standard deviation channel comes in near 613, just below that mark here. Look for potential resistance around that area if things do progress to the upside.
Okay. Final thoughts here on Netflix today, Don Kaufman?
Yeah, no, this is again, in most respects, less about Netflix and much more about technology overall. So
I'll be right back.
You know, you're not necessarily comfortable jumping into like a bearish position, something like Nvidia. A place like Netflix might be the avenue to take. And again, these put spreads, they're out of the money, they're relatively inexpensive. You do have to have a significant move, but if that plays out, they could be nicely profitable trades.
So much. Great for the big three today. We really appreciate it. Don Kaufman and Rick Ducat, great big three. We had Citi, XLE, and Netflix. Coming up, we're going to spotlight the tech sector, the outlook for AI monetization. We'll dive into that space next and find out which stocks we should all be watching. Next here on Trading 360.
I was born on the south side of Chicago. It's been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure that you have all of the
What's your number, buddy?
tools and some.
I'll call you right now. See what you got to say. I'm going to scalp this SPX again. I got to make back $230. If this here holds right here, get closer to the money. They're so freaking high. They're still high. Hi.
growth areas in 2024 is going to be the AI PC, and I think it's truly an inflection point for the category. You're going to start seeing a lot of AI go into vehicles as well, and more edge products. And then, of course, you've got huge growth in the cloud as well. So the big winner there is going to be NVIDIA, or continue to be NVIDIA.
Yeah,
they kind of have the lion's share of the GPU market. But AMD is coming out with some really good GPU alternatives as well, some of which perform better even than NVIDIA's H100. So it's going to be an interesting year to see how AMD manages to edge out NVIDIA a little bit.
So we're seeing this shift, as you noted, the cloud, GPU, CPU, data centers into devices, and maybe that's where the opportunity is, or autos and such. So when we talk about monetization, what does that really mean? Obviously we think about making money, but how will companies, you pick one, and give us an example, how will a company make money using AI?
Right. Well, so a company that's using AI, not as opposed to creating products that
or either
create services.
I don't know.
Okay,
this
so
is your conversation. You tell us. I mean,
right.
where the growth is.
The growth is going to be everywhere. So in the data center, obviously it's GPUs and CPUs, but GPUs especially are going to drive a lot of growth. The data center and the cloud.
She's a tough chick. I like her.
AWS, Microsoft with Azure, and Google are already seeing an uplift. I think it just in the last quarter in Q4 alone, Microsoft's Azure growth was 30% higher because of AI. So we're seeing a demand for those types of services. On the device side and on the edge side, the PC segment has been going through a slump for the last 2 years. It's coming back, but AI PCs are going to shift so many inference workloads onto the PCs and out of the cloud that it's actually going to be more economical for companies to buy AI PCs, and I think that's going to create a lot of drive for the PC comeback. So I think by the end of H2 2024, we're going to see the PC market reinvigorated by the AI.
So people are going to want to buy those PCs that have that implementation of AI embedded in it. And then where does a name like Tesla fit into this story?
Well, Tesla's been an AI company from the start, right?
Yeah.
So on the one hand, they buy a lot of GPUs, they put AI in the cars, but there's also a huge data play that doesn't get talked enough with Tesla, which is basically that all of their vehicles collect data and analyze that data and improve its ADAS solutions. And all that happens mostly in the cloud. And so the inference workloads that are necessary for this are going to be accelerated by this shift. And I think that Tesla kind of has a head start on everybody else on all the ADAS platforms. So I think that you might see Tesla's ADAS systems improve significantly.
Got to regroup.
When people talk about Tesla and what a disappointment it's been, there was a lot of, it got hit hard in the last couple of weeks. But it's not just an auto company, right?
Exactly, baby.
You can't compare it. I know it has competition in the EV space, but is it really something different in your eyes?
Yeah, I think Tesla's always been different. First of all, everybody's trying to catch up to Tesla, so that's still the case, even if Tesla doesn't always perform as well as some investors would like.
Right.
Obviously, they had to slash their prices several times last year to hold on to market share. That's dwindling, but their sales have been super strong, and they've had the biggest quarter, like a record-setting quarter last year in Q4. I don't think that we're going to see that kind of growth this year. I think they fired their magic bullet with the price cuts. There's nowhere else to go. But Tesla can grow in different areas, and one of them is obviously the charger network. They're also selling some of their hardware solutions to competitors to their own network now. Yeah. So Tesla's going to find areas of growth. I just don't know that it's necessarily going to be, the 35 to 38% growth in sales that they saw last quarter.
Right. That was, obviously had been growing so fast, so slower growth. What happened to the metaverse?
I think the metaverse is on hold for a bit, and it's been good to see Mark Zuckerberg sort of put that on the back burner a little bit and focus instead on creating the devices, creating the interface. Right. And I think one of the more interesting things to circle back to this AI play is that the magic interface, I think, for the XR category, which
The video broke to 200.
all the way to VR,
Yeah.
is and includes smart glasses as well, is the voice interface, is the built-in on-device AI. Because you don't necessarily want to be tapping your glasses or doing gestures all the time. Sometimes you just need a very thin client on your face that doesn't weigh a lot, whether it's smart glasses or AR glasses, that you can talk to and you can tell them to do things. And I think that AI and voice interface is going to be key to mass adoption, especially in the lower tiers for the smart glasses.
Oh, looky here.
And the AR glasses as well when they come out.
Have you tried some of them? I mean, can
Yeah.
you tell us about the level of coolness? I mean, your experience?
You know, it's getting there. It's taking longer than I'd like. I think Apple's Vision Pro is a fantastic first shot at
Yeah,
the
and
product.
it had a lot of demand and all those pre-orders.
A lot of demand, a lot of pre-orders. I mean, it's still a niche product. It's extremely expensive. It's not for everybody.
We got 1, 2, 3
It's a product.
on the
Yeah.
SPX.
Pull, so you know that there's going to be a pull. But I think the mass adoption is still going to be with AR and thinner glasses, things that you can wear all day, that don't weigh a ton, that have more battery autonomy, and that allow you to actually do things that are more productive than just the entertainment.
Yeah.
VR is nice, but I'd like to have glasses that help me shop, that help me work, that create more virtual desktops for me at work, and that I can take with me everywhere I go. That utility to my day.
So AI investments, AI implementation, AI growth, it's all so exciting in all the ways that we're seeing these opportunities. On the other side of the coin, there are dangers. And that is something that everyone focuses about. Any thoughts on that in a big picture, sort of broad brush?
Very broad brush. Any new technology comes with a lot of goods and a lot of bads. So on the one hand, I think that, you know, some of the larger companies, tech companies, are in DC today talking about how to keep kids safe online.
Yeah.
Obviously, AI is creating a whole new slew of potential problems with deep fakes and other types of use cases.
Sure.
So that's not necessarily something that has anything to do with the market itself. I think that's more about legislation and about the companies also taking a stance on where they want to.
Oh, I gotta get my water and my coffee.
But I think for safety and security reasons, AI on devices, not being in the cloud, is also going to help the enterprise and users keep a lot of their data secure online while they're using AI applications. And so I'd also look to Qualcomm and its ARM-based AI PCs that are going to be coming out in H2. I think they're going to be they're going to have something interesting to bring to the market.
Oh, that's interesting. Okay, so that was a good teaser for the second half of the year for Qualcomm. Thank you for that, Olivier Blanchard of the Futurum Group. A great conversation. I appreciate it very much. Thank you.
I love
Coming
you.
up next, the Disruptors, and Kevin Green is standing by. He's watching AMD. So he'll break down some of the numbers. He'll give us an example trade as well. That's next here on Trading 360. We'll be
I'm
right
excited. Bring it on.
Young lady who was mid-30s, a couple of kids, recently went through a divorce.
I really don't want to listen to it. It's the same commercial every day. These things are so high, it's hard to believe. They're still high priced. Got one lotto at 690. $4,900 strike. Starbucks has pulled back to a double bottom. Yesterday's low after hours. There's 740. There we go. Now. Give it to me. $770. Now I'm 160 down. Zim did pull back. Oh wow, Zim pulled back good. Was General Flint was talking yesterday about the Erie Canal, Panama Canal. Erie. 70% of our goods go through there. If anything happened to that, that could be a real serious issue. General Flynn, that's who I'm thinking of. Had a little bounce off the 1, 2, 3, and I scalped it for $80.
Max Wasserman is with us, founder, senior portfolio manager at Miramar Capital, and Dan Romanoff, equity analyst at Morningstar. Thank you both for being with us. So Dan, you have a 3-star rating of 420 value. I see a lot of the companies today are raising their price targets. Not surprised, I guess, based on the double beat. What did you think?
Yeah, I mean, it's hard to find a negative with the quarter. So revenues were great, profitability was amazing. So there's certainly lots to point to. In terms of the stock reaction, to me, that's not really surprising. To your point, the shares were up about 67% so far in the last 13 months or so. So it's been a strong run. Maybe there's some profit taking, but it seems to me that the
I got a 510 on here from Wolf.
Their lead in AI is just really impressive
on Microsoft.
So from an overall standpoint, a great quarter, and you know, we still like Microsoft in the long term.
Yeah, understood. Max, what stands out to you about Microsoft? It seems to be the one that just continues to benefit its shareholders year after year. Great dividend, continues to grow, hits new highs, and to Dan's point, it, you know, really has been a leader in AI, and Azure's doing well. Max, your thoughts?
Well, thank you for having me. It's one of our largest positions. We like, if you look under the hood, Azure has actually had
look under the hood.
3,000 customers now, and about a third of that in the last 12 months have signed up for the Azure AI and the Copilot everything. So it's a tremendous addition and penetration they're taking. So we really are impressed with how they're expanding their network and actually how they're putting Copilot throughout the whole company and through all their products. So we think there's tremendous growth there. We're also pretty impressed on the Activision side. If you look on the Activision right now, that it's, you know, they've closed the acquisition there. They have about 200 million monthly active users for gaming, and they expect that to be about a 9 to 10 billion a year addition to the company. So we think when you look closer, it's not just that they're growing, it's they're growing their width, their bandwidth tremendously among customers. So we think AI, we think Azure, we think Microsoft from the Office, from the gaming, has so many different ways to grow the company that we really like it. That being said, you know, we've been in this stock for a while. Again, it's one of our largest holdings, but at 33 times.
There's a nice little snake set
Where
up.
do you think he can go from here? We think there's probably another 10% upside maybe in the next 6 to 7 months. We'd use any weakness to add to that position, but you're not going to get the tremendous growth.
Did you use it today, buddy?
In 12 months. So people have to be realistic. It's a $3 trillion company. It's going to take a while. So people have to be a little patient, but definitely this is the company software.
Here we go again. Snake breakout, pull back to support.
Yeah, and you know, Dan, you talked about you expect the remainder of 2024 to be solid. Tell me about your outlook here.
Well, so management guidance was really impressive in that just a few quarters ago, I think the street was talking about probably in the low to mid 20s Azure growth. And all of a sudden, last quarter it comes in the upper 20s. This quarter it's 30% as reported. So the outlook here has been strong for management in that they're saying stable growth for Azure with the second quarter. So that's, I think, a lot better.
The 9 on the weekly.
Especially when you consider how depressed that was just like a year ago. So that gives us a lot of confidence. They're talking about large deals. They're winning billion-dollar
snake
deals
breakout, pullback, boom.
And, you know, find another company anywhere that's winning billion-dollar deals in, you know, in kind of a subdued environment. So that gives us a lot of confidence too. And just the number of, as Max was saying, the number of clients signing on to Azure AI gives us a lot of confidence, you know, sort of in the short to medium term over the next like year and a half, say. So those reasons, and just the profitability standpoint from Activision, we were originally thinking that margins were going to be pressured, A, from AI investments, and B, from Activision, the inclusion of Activision. And Microsoft was guiding to flat operating margin for this year, and now they're raising that to up 1 to 2 points for the year compared to last year. So the performance of management here is really impressive, and so that gives us confidence to start raising our numbers, and that's why we feel good about the rest of the year too.
Yeah, understood. Understood. And just final thoughts here, Max, because you know, right, we talked a lot about Azure, some gaming, we have Office, LinkedIn, there are a lot of things that are under this umbrella. Is there anything in the group you said you would add more on weakness? You like this one, Max. Anything else in the group that you want to add as far as winners? I mean, I know the competitive space can be tough, but any other winning thoughts here, Max?
I mean, another company that, again, is one of our second probably largest position is Broadcom. You know, that's it. I know we're dividend growing. We invest in dividend growth. There, with the VMware acquisition, they think they're in a great spot. They're growing. Dividend growth is like 15%, and the stock's around $1,200 a share. Again, all these companies have had a tremendous run. So we would look for any pullback for adding to these positions. For new money, I would tell everybody, these are great companies. You're not going to be able to time it. Look for weakness as an opportunity to start a position and add to it as it goes along. But again, we're long-term investors, so we don't mind. We've been buying Microsoft and Broadcom for a long time, and we're holding them because when they're in the right space, they're growing, and they are in a competitive field. So they're constantly coming up with new products, and we think that's really the growth opportunity.
Yeah, it's great to see you both, and obviously a hot topic today with Microsoft, but a lot of love on the street today. Max Wasserman of Miramar Capital, Dan Romanoff of Morningstar. Thank you both very much. Thanks, friends, for being with me here on Trading 360. I'm Nicole Petalides. I'll see you for a special edition today at 2 p.m. Eastern Time of the Watch List. It's Fed Day.
Go, baby.
Join me then.
I'm getting my revenge out on this SPX today.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with no monthly service fees or account minimums. Unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds.
I'm done with you. For some reason, these SPX ain't cheap like they usually are. Usually you can get them for like $2 or $3. These things are $7, $8. And it don't make no sense to me. Plug's the only one that I recognize that had an upgrade today. So this is a snake with a symmetrical flag. Some would call it a pennant. Inverted pennant, inverse pennant. Oh my, what just happened here? Oh no. Microsoft set that 63 on the 1 minute. Oh man, 8:20 now. See, that what upsets me. Oh well. Ouch. This sucker went to 840. I'll be about even now. Well, I would be even, I think. Exactly. Good idea, Mike. Can you imagine it? No, I'm okay. Yeah? 49.30 on them. So I'd still be hurting. 49.20.
The super high, if not impossible bar that had been set forth, because these numbers were staggeringly strong. I mean, we saw net income rise 33% to just shy of 22 billion, the strongest quarterly expansion since we saw actually the quarter ending September 2021. So
staggering strong.
over 10 years, basically, they did see their Azure cloud business grow around 30%, which beat expectations, calling for estimates around 27% growth and one of their most, if not the most lucrative part of their overall business. But they did say 6 percentage points of that growth came from AI demand. That doubled the amount that AI contributed to Azure in the previous quarter. Said revenue for the second quarter was around $62 billion, like you said, Tom, up 18% on a year-over-year basis, beating expectations. And they did also incorporate, of course, results from Activision Blizzard this quarter, which was completed during the quarter. That did lift overall revenue by about 4 percentage points. Now, their AI products are what some analysts are saying significantly well ahead of some of the overall expectation or what's available right now in this market. But overall, what this really does, I think, signals the fact that we were in a really frothy market. We did see the fact that overall, perhaps some signs of overextension after this recent rally. The stock was up around 70% over the last 12 months as of Tuesday's close. So I think that's really what the key part of this today's selling is. And also the fact that we are seeing some weakness in the major tech names. But all things considered, I had to really dig through these numbers to find some aspect of weakness. It was very difficult. I would say perhaps the one thing is that we did expect their revenue and their intelligent cloud to be between around 26 to 26.3 billion in the quarter. The upper end of that quarter-over-quarter growth is just around 1.5%. Compared to the quarterly growth rate of around 6.6%, they notched in their last set of results. So that is perhaps the momentum we're seeing slowing. So I feel like right now the headline news on Microsoft.
That would have been a good double bottom catch on that.
Earnings really were, and the selling today obviously doesn't help. But now
I did catch it, but I didn't take it all the way up there.
40, I mean, this stock.
Oh no, I know.
High. I'm just not sure these numbers could have really been able to meet what was such a high bar.
Yeah, Jen. Names like this show you why trading options is so, and understanding overbought and oversold and valuations. The valuation, the good news is for Microsoft.
Well, they're really talking about Microsoft today. But look here. 710 to 910, I'd be in the green now. Just on one contract. And I sold it at $70. I like these guys a lot better.
So why we go through these example trades and options. I also think that's the value of being, say, like a long-term investor for a different approach, because you'd be holding on to this name, looking at the fundamental story, saying, hey, nothing changed. If anything, it's just as strong as perhaps you thought it was prior to these numbers. But I think that's the also value of holding on for more of the long-term ride in Microsoft, because the growth prospects are still objectively very, very strong. I mean, if it took me better part of an hour to find maybe a few lagging metrics of growth, I think they're in pretty good shape.
Yeah, I'd say so. And the analyst community today just pouring in with price target hikes to the upside on this
But
one.
remember, they're in 3 of the 4 indices. So if the overall market's going down, they can't hide from that, right? Number one, they'll be part of it. Right. And number two, it's pressure on the stock from the indices, from that other part of the economy that can put pressure on a stock. So just like Apple, just like these names that are in 3 indices, if the market goes down, it's hard for them to escape that.
Yep, you can't hide from it. All right, great stuff. Thanks to Jenny Horn, market correspondent here, breaking down Microsoft post earnings. But now let's bring in Kevin Green, senior markets correspondent here. Kev, I wanted to get your take here because we had some data today. ADP came in below expectations, probably what the Fed wants to see. But then we saw, bonds spike, the dollar fell a little bit, yields came off of their highs.
Zuckerberg's up in court today in front of the Senate, and he's got some charges, I guess, or they're investigating him for human trafficking. Facebook. Have you ever been on Twitter lately? God. I don't know who puts out some of them ads on Twitter. X. The violence on there, I'm not getting off on that. The fights. I was in Green Bay, Wisconsin, at a seminar competing in competition for entrepreneurship event when I was going to college. So I decided to go out and walk around, and I got downtown, and 3 guys come up to me. I'm not going to name their race, you could probably guess. And this guy come walking right up to me and punched me right between the eyes and broke my glasses. So I had to tape them together. I ended up fighting all 3 of them. And then I went into the presentation the next day, and I had a big old black eye, and my glasses were broke. And one of the judges says, "What happened to you?" I said, "Well, I went downtown to have a beer and got jumped by 3 strangers just walking down the street." I had a cowboy hat on. Maybe they didn't like that. So don't go wearing no cowboy hat down in Green Bay. Are you still talking about Microsoft? FOMAC. Let's see what they got to say about it.
Hopefully our show brings value to pointing this out, that this can happen. It's not an automatic
Empty your mind.
oversold. We use
Be
the tools on the
formless,
platform to
shapeless,
bring out
like
the things
water.
that overbought.
Now you put water into a cup,
Valuations and
it becomes the cup. You put water into a bottle, it becomes the bottle. You put it in a teapot, it becomes the teapot. Now water can flow, or it can crash. Be water, my friend.
Water. I can walk on water.
Expectations from Fed Chair Powell. I hosted a future show this morning. A couple of my guests were saying, "Oh yeah, he's going to be as dovish as he was in December," and I was like, "I don't know if I can imagine that," but they said they could easily see him being dovish.
Yeah, I think he gets a little bit dovish, especially when he starts taking questions. I think the prepared remarks are definitely going to have a nice little balance, or even a little bit of a bearish tilt to it. But once the questions get there, and he starts to answer a fair amount, and he's taking 30 minutes, 45 minutes in, that's when he starts to put his guard down here a little bit. So here's the key points. I don't think anybody's going to really be surprised, right? So
if you watched Jimmy's video this morning, he said keep an eye on the 9. And Microsoft is at the 9, number 9, number 9, number 9. Can you tell me what album that come off of? I bet you can't. Anybody in the room? Number 9. Number 9. That's right. The Beatles. And it sounded almost just like him. Okay, we got a little pullback here. My SPX again. This will be my last trade to get even. Did anybody get stuck in that SPX with me? In the room? Oh shit. How are you doing now? That's better than what I did. Sorry about that. I just didn't. I forgot all about FOMAC, or I would have probably traded it different. I would have traded it different. I don't know why I didn't think about FOMC. Talked about it all day yesterday. Feel like an idiot. And then I did that irrational exuberance. Ricky, did you watch that video this morning? Like, I need to pay more attention to what I'm saying on these videos. I'm gonna go turn my heater off here. Now that I got this bathrobe on, I'm a little bit warmer. So today, if Pow Pow is going to be a little bearish in his speech, one thing I like listening to these guys a lot more than I do CNBC. 'Cause when these guys talk about an entity or a stock or something, they're going mostly pull up a chart. Then they got a second opinion, which one guy talks about it, and then another guy comes in and does the charting, and that's really, I like that. And they're not as bullish as CNBC is. Did you follow some of my trades yesterday, Ricky? I agree 100%. That's why I said if anybody's going to be prosecuted for human trafficking, let's go down the list of Epstein and see how many senators made it to that island. Or let's bring them down to the border. And pawn shop's son died of fentanyl. And I can name, I know a bunch. The only time I ever took a pill was if I had a bad tooth. Then I'd beg the doctor, give me some, give me some. I went in there one Sunday to pull a tooth and he gave me some. That's the only time I ever took pills. Well, besides my epilepsy. That's a nice call in the video today. Still trying to figure out this black dot TTM Squeeze Pro. Super Squeeze Pro 2. I got other charts that I could use besides that one with a squeeze. Got the John Carter 10X. That would be a good idea. Put the RSI on that one. Let's stick with this for a second. No. And then Microsoft looks sexy here. Do 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 do. Got a falling wedge set up for Microsoft. Got the snake. I can imagine what Zuckerberg's saying. I'm not a kid anymore. I'm a billionaire. Hearing entitled The Big Tech and the Online Child Sexual Exploitation Crisis. The committee is in a short recess. Do 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 do. Do 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 do. Did I put the chart in the room? Microsoft squeegee. Today, franchise gets an award. This only goes out to the best traders in the room. You want to see what your award is? It's called the Spank Award. Damn, you still passing that award out, Jim? In case you don't know what the award is, it's called the Spank Award. I used to give that to Vegas all the time. Anytime she got out of line. Oh, here comes that ugly guy again.
Change here on this one, up 22%. RCL is up about 16%. When you look at those numbers, have you guys seen any data on a Likefolio that's saying, hey, the consumer is getting stretched here? Maybe they're not going to book that cruise because, a lot of the CEOs over the past couple of quarters continue to say that the consumer remains robust at this point, and they're not pulling back on experiences and travel.
Yeah, I tend to agree. I would actually put the cruise industry in general in kind of that winner category. Something that we've talked about with you guys on the show several times is, the economy for the high end is doing very well, and cruises certainly fit into that equation. There's only a certain segment of the population that's ever available to afford a cruise, especially a Royal Caribbean cruise. I think that, what we're seeing at Likefolio is that segment of the population, which would normally be their customer, is doing quite well. And they aren't really going to be very concerned about the segment of the population that is outside of their normal consumer base. So that's the way we look at it. We see that specific consumer as staying very strong and have every reason to think that this company will have a positive outlook for 2024.
All right, paying down debt, that's going to be at the top of maybe that conference call. All right, great stuff, great data as always, Andy, appreciate it.
Thank you.
Now go home and take a shower.
Likefolio. Kevin, when you look at
expectations for bookings up 29%.
Right, and their bookings are like 101, 102% because they get some cancellations and such like that.
Just like airlines, right? They overbook things.
But if you look at Carnival Cruise Lines, and you guys mentioned that, after their earnings, the stock popped on that, and it's been down since.
Yeah.
And Royal Caribbean, as you mentioned, just below the recent highs on the stock. So the expectations into this one, optimistic to say the least here, Kevin. What do we got here? Plus or minus nearly $8 move in the shares for this one. How do you want to look at it from example?
Like I said, that 5-year high from a couple years ago was about 135 and change, Tom. I kept it real simple. If you're looking for something to look at, I did the 2-week. I gave myself a little duration time, so I went Feb 16 to Feb 2. I did the 134, just $1 short of that high.
Oh God!
I did the 134 call calendar. Now,
Come
it's
on.
trading about $1, trading a little over $1.05 now, but anything right around $1 going into the earnings, you do have some. You're talking about 107 vol in the Feb 2nd, and you're talking about 53 vol in the Feb 16th. So big dispersion there between those two. So I'm looking for an inexpensive way to maybe play some upside here. If you're bearish, you can clearly do that on the downside with an $8. It looks like setting up pretty close to the 120, 121 level.
Yep, yeah. Let's take a look at this one. 2-week wide call calendar to the upside, just slightly above the current share price, about $6 above the current share price here. Going out to the February 16th monthly cycle, so 16 days to expiration. Buy that 134 call and then sell that same 134 call in the February 2nd weekly options that expire in just 2 days on this one. We've got a $1.05 debit on this one. That's your risk, $105 per spread. But look at your break evens, Kev, maybe about 124 on the downside, maybe 147 on the upside. Maybe that's a little bit tighter, maybe 125 to 145. But you still have a nice wide range here. You talked about the dispersion, and we talk about the price on this. It's $1.05. It's 2 weeks wide.
The 1 week is about 50 cents, by the way.
50
if you want to
cents.
do the 1 week trade.
Right, but this is a range-bound trade where you can be profitable within a specific range. Apex profitability is a strike you pick. But this is one of the, like we always talk about, this is a flexible strategy. If you're more bearish and you want to do the 120 strike put, that's where you put it, right? If you think this thing's going to maybe fall after earnings, right?
Bullish call calendar, bearish put calendar. Not sure, both. You could do the double calendar, right? And so the utility of the calendar spread, why we talk about it in a low volatility environment is because of how useful it is. Now, we love
gosh, 3 cents
between the 2 months, right? That makes it cheaper. Does not guarantee you're going to be profitable, but it makes it less expensive. So you're playing it the right way if that's what you're looking for. Does not guarantee anything, but this is a way to do something for less debit, overall debit. About $1 on the 2 week, about 50 cents on the 1 week.
I think that's a good point to bring up for our viewers is we talk about that divergence between implied volatility. That makes the calendar spreads less expensive, right? Because of that near-term implied volatility due to the event risk is a lot higher. So you have a lot of extrinsic value in those options or option premium. So that's, the consideration that you have to take in these type of strategies is, hey, the options that you're buying, implied volatility will most likely fall there too, but does it outweigh it based on the move that you get at or near your strike is what you want on that. But a flexible calendar there. Remember, you've got some assignment risk on that short option going into expiration over the next couple of days also on that one. But a good look, taking advantage of the different levels of implied volatility on aggregate between the option series. All right, let's take a quick break. When we come back, we're going to talk another Dow Industrials product here, and that's Honeywell. They report earnings tomorrow morning also. The industrial company is expectations pretty high on this one, but if you're going by some of the competitors, they've disappointed on earnings. That's coming up right here on the Schwab Network next.
Microsoft. Swing for next week. What's today? Wednesday. 410 strike. February 9th. February 2nd. RCL's up 5 cents already on a vertical call. Okay, we broke out of the channel on Microsoft. That didn't last. Oh gosh. I'm gonna go get some more coffee. It's not as pretty day as it was yesterday. A little harder today.
Has been underperforming its respective industrial peers.
Honeywell.
Companies like Emerson, Rockwell Automation. You can also throw in perhaps General Electric. And I think what's going on with Honeywell is it's still sort of looked upon as an industrial conglomerate. And they've been resegmenting the company. In fact, they're resegmenting the entire business into 4 primary units, which includes aerospace, industrial automation, and also building automation, which includes things like materials and safety, and of course HVAC systems and productivity solutions for buildings. But the other thing is they're also an energy company. They provide alternative energy technologies and materials that go into, for instance, solar control modules and solar panels as well. And I think one of the things is just my observation is that one unit, their building automation unit, of which they added Carrier Global Solutions, about $4.6 billion in the last year. That segment, I think, has been relatively weak, and that's probably been dragging on performance. But I think going forward, there's something rather compelling here. If you consider looking at the earnings estimates at $2.59, it's actually quite low compared to last year, only growing about 2.8%. Revenue is actually expected to come in around 5.4% higher at $9.69 billion for the quarter. But I think if you look at the relative estimates for 2022, they generate around $8.76 a share. The estimates for 23, which will have the full year numbers when they report earnings at $9.16. But the interesting thing is, if you look at 2024, the estimates at the midpoint are almost $10. So that tells me they're generating about 6% earnings growth on a forward basis, which is actually more than double last year's. So I think this is going to be a pivotal quarter, perhaps, for Honeywell as they're reporting earnings. I'm sure they're going to talk about more resegmentation.
Always clean as Jim.
If you look at, like I said, the estimates on a forward basis, they look a lot better than the comparisons from 23 versus 2022. Yeah. And at the margin, you could also make the case, looking at the chart, has really been stuck in a trading range, somewhere between 220 and 160. So effectively, it's sitting right in the middle of that longer-term weekly trading range.
I didn't write it in. Oh, I didn't write it in, did I?
This is a company that pays about $4.50
Hold on a second.
a dividend. So, over 40% of its earnings.
I got to mute you. I'm on live here for a second. Get on my... Bobo's back. So taxes are so complicated anymore. I have to hire an accountant to do all my work for me, especially when I turned it into an LLC.
I would also call it kind of range bound because you're inside the expected move, so it's bearish to range bound in terms of the trade here, where this is probably going to be profitable if it just stays right in this area, frankly.
Right, and we've talked about that dispersion between implied volatility levels. You're selling about a 50% implied volatility in the near-term Fed second options, buying about a 25% on the February 16th. So that creates that lower price entry point, which lowers the risk. You do have some assignment risk on that short option going into expiration, but this just calls for about a 4% downside.
We got earnings on Honeywell coming out.
2%, but as we mentioned, you got a nice range. Now, same type of setup, Kevin, where maybe if you think it's going to fall post earnings or stay neutral, let's look at another strategy in here. And this is going out to the same February 16th monthly cycle, but we're going to look at selling a call vertical here, Kev. And this is going to, we're going to sell the 207.5 strike call, buy the 210 strike call. So basically $2.50 wide short neutral to bearish call vertical. Now, it's the same directionally type bias trade, but you're collecting a credit of about 90 cents on this one, Kev, and that takes your risk if you're collecting 90 cents to $1.60, 160 bucks per spread. That's above 210.
Two different trades, both short deltas, but not crazy short deltas. And they're, it's 207.5 is your short. The 200 strike is the calendar short. So you see where either one of those do well, I think in the range here or lower, slightly lower. So yeah, the two different ways, one collecting premium, one paying slight premium, two ways to look at the same posture or attitude.
Yeah, and I think that's the setup I kind of wanted to bring to our viewers was like, hey, if you're not comfortable buying and paying a debit for that put calendar, what gives yourself a range, well, this one you profit in 3 out of 4 scenarios where if it goes down, you profit, stays where it is, or goes higher, but remains below that break even at 208.40 to the upside. And Kevin, with that,
well, they beat. Ooh, that was a good month.
Probability of success, right?
Yeah, exactly. Because if nothing happens and the stock doesn't move, the short call vertical is profitable. The put calendar may need the stock to go down. It's pretty close.
I bet you it goes down.
You may need the stock to go down. So, but the stock could go up, and you could still be profitable on the call calendar, as long as it doesn't violate that break even. But anything upside on the put calendar would probably not be profitable.
Right. Okay. Good. Good discussion there on two different types of trades. Same type of setup though. All right, that's going to do it for Kevin and I today here on Fast Market. Stick around though, right here on the Schwab Network. Next Gen Investing is coming up.
We could hit a triple top. Ted squeezed already on the 9 on the weekly.
Here for the #1 hit maker.
Thanks for swinging by, Carl.
No problem.
Honeywell. I was going to say magnificent answer. Intel didn't have too good of earnings. And we definitely pulled back to my support level. Well, I got 2 windows here. What the heck? Can't have that. It pulled back to the support level. Let me show you. Got 1, 2, 3 breakout, then it pulled back, and then pulled back again. So we're at the yin yang of support. If that doesn't hold, then it's going to be under 40 on Intel. AMD's first quarter revenue guidance. AMD first quarter revenue guidance slightly worse than consensus. Now, when they say consensus or the street, I pay no attention to that because I have no clue who they're talking about. AMD. Well, today's not been my best day, that's for sure. Got to get focused for the big trade. Come FOMAC. Cantor Fitzgerald reiterates overweight on advanced micro devices, maintains a $190 price target. UBS adjusts AMD price target to $205 from $220, maintains a buy rating. I didn't even look at Tesla today. Still holding support. Oh yeah, that would have been a good trade. Oh God. Okay, SPX is at a resistance. Now, if we get a good FOMAC, a happy pow pow, and we did break out of the quad. 1, 2, 3. If you can count to 3 with me, and if you can count to 4, you'll get more. Let's check it out. This is radio station KSCP. Come on, man, what are you doing? Do. These suckers are at $9. Does anybody want to pay my taxes for me? I'll give you a cheeseburger. You know, I didn't get a refund for almost 25 years. I had to pay taxes. When you own your own business, there's no refund. I heard they got a new tax bill out for if you have kids, more tax credits. They were debating this morning if it would cause people not to work anymore because they were so much. I personally don't think I should have to pay for other people's kids. They ought to give a tax credit for people that didn't have kids. Or I could have been one of them that had 6 or 7 of them. Maybe 8. That's one thing about being single, never been married, and don't have no kids. You're punished for being, I made a choice, right? Because I didn't think I was responsible enough to have kids when I was younger. Though every woman I was with said, man, you'd make a wonderful father. Here we go. SPX. Nailed it. I'm still in them. I'm not, that's exactly what I'm saying. Do you have them, studio? You're assuming 5,000? Never assume. You'll only make an ass of yourself. I only have a couple left. Exactly. That's right. He's got that right. Take back. People are wondering if they should work part-time now instead of full-time because of the new tax bill. I'm so glad that I did go sole proprietor, though. I mean, I would constantly worry about being laid off or getting into it with somebody that I work with, or at a very young age, I decided to go sole proprietorship. Imagine being in business for yourself for over 30 years. Studio, are you listening? Okay, this is what we're looking at. 4,900, yeah, I think we can get back up there. Definitely hit 48.9632. 10-4. Get that opening price right there. 48.9614. That's my number. $48. $896.14. Oops. How dare you? That's very unprofessional. With support at 4887. Doon doon da doon doon. I beat you to it. You see why that support's there, right? Because that's the resistance that we broke. See, what was resistance now becomes support. And they always pull back to that. Not always. 99% of the time they will. Unless you have a pure parabolic run. And we're not going to have that until Pow Pow speaks. Zuckerberg. Child sexual exploitation crisis. This administration supports human trafficking. I'm going to go step in the kitchen, grab a shot of vodka and a Valium, and warm my coffee up.
Tesla. Stock was $400 and some not that long ago.
I was just looking at you.
And its industry's only grown
Oh, God.
since then. Yet the stock now trades sub 200. Is something like this in store? Maybe to a lesser extent, but within the same.
You know what some guy said on CNBC this morning about Tesla? Says, I'm not too highly, and I don't think that we're going to have a breakout. We might pull back to 160. And if 160 doesn't hold, we could see $100. The only reason I would agree with him is because of the guidance. But I swear, most people that got an EV car right now have got their car, and we are going to see some slump in sales. That's the only reason I would be bearish. Not. Okay, come on, baby. I think if we get to 4896.14, we will be at $1,100 to $1,200 in the $4,900 strike, and we're only 2 notches from in the money. I got stuck in this sucker this morning. I thought I'd never get out of it. Mike, could I get a yabba dabba doo? He's not here. I can't use this chart here. That won't work. What's the other one? I bet it's that one there. Damn it. Where's it at? There it is. There it is. Oh my God, what happened here? Halt status update. News pending. Announces, 1 for 15 split. I don't like that. Plug's having a good day. It got an upgrade. Maintains a buy rating. We're in the SPX, and we're trying to break $1,000 here on the $4,900 strike for a lotto. Come on, 1,000. We're at 990.
It leveled here near 384. That was where we eventually broke to the upside here. And we can see that we snapped through that downward sloping trend line on RSI as well. A little brief foray a couple times into the bearish side of the camp here, but we righted the ship and recovered. Now today, though, we're getting another bearish signal. The break below that 70 threshold, coupled with a break below our trend line, is bearish there. So that is something, once again, to be aware of. Not necessarily head for the hills, everything's falling apart here, but we're...
Shut up for a second. You did not point out the wedge like I did. Do you see the wedge? What happened? What happened? Snake breakout. Pull back into a wedge with an inverse head and shoulders. Boom! Back to 405.39 by the end of the day. I rest my case. And the call. Where are you? Old. Damn, not much. The 410 strike is up some, yeah. 30 cents. I really like this standard deviation. It's pretty simple to use. Do. You see that franchise? Snake wedge. Snake wedge. For you people on YouTube, this is what I'm talking about right here. When I was charting that earlier and I posted that wedge on Microsoft, look at it now. That's called a wedge out of the snake, and it run up and hit the 200. So that could be an exit idea. But I'm going to see if I can get it up here to the next resistance, would be a double, triple top, webus, tubus, and actually, it's lower than that. Let's do it right. If we're going to do it, we're going to do it right. Take and draw your trend line on that body. This is a 1 minute time frame, and run it up to that next body right there. And that'll be your resistance right here. 404.82. So I'm going to change that. 404.82. And if we get even close to it, we get out of the trade. This is inverse head and shoulders. Left shoulder, right shoulder, boom. Okay. We have less than 40 minutes now. 40 minutes. They're not going to give us an interest rate, I don't think. He's just going to speak. And I think the market will have a good reaction. Because I really don't think the market cares what he says. So he came back and hit support, just like Jimmy said. What was resistance becomes support.
The expectations for AI have gotten so far ahead of themselves without considering some of these major costs that will be associated with building it out naturally. And I do think that right now, all in all, their AI graphics processing unit this year came in well above management's guide, and I mean, like, sizably beat expectations. So I do think that in that case, that's still objectively very strong. The company's report did bring a number of items that could be viewed as somewhat disappointing, especially given its 80% rally over really when they saw their posted the September results and then or September quarterly results and then posted for the December period. I mean, we have seen shares take off in such a short period for AMD. But besides their AI chip outlook, their overall first quarter forecast did trail consensus. The guide overall is not completely out of line with something, say, what we would have seen from like an Intel last week, for example, but it does suggest that the numbers this year might need to come down once again. So that was the more bearish take I read about this report. All things considered, I think that the critical question is now, how big are your earnings and are they big enough? Because this was still objectively a pretty high bar that they were able to at least meet. They saw some weakness in some of their various revenue segments. I mean, we saw gaming was one that was pretty lackluster, but comparing it with Intel, just because we've already gotten Intel's numbers, Intel reported that its data center business fell about 10% year over year. This company reported, I mean, 38, almost 40% growth in terms of their data center and AI. So completely different trend, I think, signaling the fact that it's not like AI is shrinking or data center growth is shrinking as far as revenue. That was objectively really strong. I just think a lot of times with these companies right now, we're seeing a bit of a frothy market that's somewhat resetting itself.
Yeah, but its overall revenue grew by 10% year over year, and this is coming off a quarter where it grew 4%, which came off a quarter where it declined by 18%. If you look at the entire annual picture for calendar year 2023, revenue in AMD was down 4%. Earnings were down 24%.
Ouch.
Its stock rallied a monstrous over 100% move in its price. And so I was talking with Oliver briefly about this morning. If you were to look at something like a blended, kind of forward PE of just different earnings estimates and compare it to where it typically would be.
See, they all think exactly what I do on this channel. You don't hear that from CNBC. I mean, irrational exuberance. Like I said, I've watched this market for a long time. $72 all the way up to 184 is just, I know we had a bad year, but that was 2 years ago, a year and a half ago. I mean, this is irrational exuberance too. But this was a lot easier to call because we had ups and downs. I mean, here you just got one down all year long. It just doesn't. It just not. It's not cool, man. It's just not cool, man. And there used to be a recession every 4 years, and that don't happen anymore because we print so much frickin' money since Obama took office, and Bush really started it. That's because we had 911. When we had 911, people got dispersed checks. I got 3 of them. Because we had the country shut down there for a little bit. The stock market crashed. And the country united. I think it's the first time I've ever seen this country actually really unite. Now I can't stand it. This is what I was doing when 911 happened. I was getting ready to have a performance. If I got my picture. This was back when 911 happened. I was at a bluegrass festival. We played live at this bar. This guy back here was the founder of GWAR, Steve Douglas. He's the founder of GWAR. This guy here played with the drive-by truckers. And this is called the Shiners. And that's me with my washboard. You ever heard of GWAR? Out of Richmond, Virginia. Okay, got a little pullback here again. We got a 1, 2, 3 coming up here. We'd have a symmetrical flag. I still think that needs to hold. 19 more minutes before pow pow. YouTube, anybody ever played FOMAC before? I like to be set up with a put and an option. Might bring us back down here. Be a little cheaper.
Peloton is actively looking for more partnerships. That's why it has the partnership with TikTok now and Lululemon. And we can't forget the partnership with Dick's Sporting Goods. One of the things that Dick's Sporting Goods carried was the Tread Plus, which had to be recalled not too long ago, but they're bringing it back into rotation. So that's expected to help as well.
Yeah, and I think Renita, such good points, and the partnerships are great, but they have to stand on their own 2 feet at this point. I mean, goodness, it's been a challenging ride watching shares just sort of churn lower. So
yeah, lower.
We will be watching
What's
those
this?
numbers when they come out tomorrow morning very
Why
closely.
you put effects in audio? It's horrible. I do?
For the network, now coming up next, it's time to look at Novo Nordisk earnings. The shares are up almost 6%, new all-time highs today on profits that surged 62%.
Come on
Young
now.
lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot.
This morning it didn't sound good, but now. Anybody else having trouble with the sound in here? YouTubers? Oh, this thing's acting funny for some reason. Hello? Oh, this thing's acting funny for some reason. Sounds good to me.
this thing's acting funny for some reason.
Sounds good to me. You there? No good? I mean, good. Go good. Sorry about that. That was a slip.
Man that's in the marketplace, their biggest issue right now is trying to get over the supply chain hurdles, trying to source the ingredients in a manner that's not going to cause bottlenecks in the system. And actually, we did see that late last year, where they actually had to reduce the starter doses here in the United States because demand in Europe was just so great. So I think right now you are continuing to see this trend just starting to develop. This could be a multi-billion-dollar industry by the end of this decade. And right now we are seeing Novo Nordisk really take the lead, to say the least. Now, what's also kind of interesting, Alex, you're not really seeing that much of a reaction when it comes to Eli Lilly, which also has a competing drug within the space. I'm not sure why that's the case. Maybe we have to wait till earnings. But what I can say is that the next hurdle is going to be trying to get health insurance on board for this drug to try to cover it, because the cost is still very expensive, still around $1,200 here in the United States in order to get treatment.
So Kevin, not to be a total pessimist, because I know we're at all-time highs, it's up 6% today, but is there any risk that some of these weight loss specific use drugs, I mean, I know they're all like for the diabetes umbrella, but those patients that are using these drugs for non-diabetes purposes, that this is a bit of a trend right now? Because it feels like every commercial I see now is for one of these various drugs. It's all over like Weight Watchers, it's all of these various like you'd say like traditional places that are advertising these drugs. Is there any risk that we could see some of this sort of fall off? I guess not based on their guidance, right?
Well, yeah, I mean, there's always going to be a risk of a potential bubble, even in the healthcare space here. And when you have shortages, the demand also kind of goes up. Everybody then wants it. And then that's going to be kind of the headwind or potential risk in the future if Novo Nordisk is really ramping up their production for this particular drug. But we do see a drop off over the next year or year and a half. They might have ample supply and then not enough demand, which could also cause them to have to lower prices and actually lose on the margins. I'm not sure if we are there quite yet. I do believe that it is kind of interesting that this fad is really kind of taking place, and we haven't actually seen the long-term impacts of this drug. That's also another risk that we could see down the road. But right now, they're going full steam ahead, and they believe that this is going to be a very big, promising drug, and it's going to be a cornerstone of their business for decades to come.
Yeah, and I know that those that use these various drugs love them, but I'm a total skeptic when it comes to all things the Ozempic trade, just all things under that umbrella. But I guess, hey, at least we saw these really strong demand reflected in their quarterly earnings, which is always encouraging. But we will leave it there. Appreciate the breakdown on all things Novo Nordisk, which is definitely a tongue twister. Now, coming up next, it's time for Powell. We get comments in about 12 minutes from now, so discuss more what we can expect from the Fed with George Tillis coming up next.
12 minutes. Boom, baby. Let's get a big spike on the 4900s. Target, we got to break 489614. Support. I'm gonna say this is gonna be your first, and then we're gonna have the quad bottom down here. for the last. And this could break out huge to the upside. I think he's going to be a little dovish, but we'll see. He always pats himself on the shoulder. Where they've always been behind. Buy call if we get down here to the bottom. Get out of them when we get up here. And I'm in one right now. Oh, there it is, $1,000. We got to break 1,000. Think I got enough time to get me a coffee, and I'll be right back. Let me see here. That's what I'm going to look at. Pull back, break out, and pull back down, and then up to the top. That'll be your final resistance. We're getting ready to squeeze.
capital in line with the cost of production, which again, mathematically makes sense, but it depends on the market's interpretation of fear versus not.
George, we got to run. Appreciate the setup. Fed decision, imminent press conference 30 minutes later. We got a special coverage coming up on the watch list, and Nicole Petalidi is coming up next.
It's going to be fun. So if we go down, I get the call. I'm in the call right now, but I'll get more if we go down. We got 1 minute. Here we go. Go down and then back up. Damn it. There goes the put. Now, get out of the put and get in the call. It's right where it's supposed to stop, right here, and then move back up. Damn it. No, don't do that. Okay, that's a better price. We got the quad bottom. I'm at 560. Get back up. Not working. Now we got to go back up. Dang, if I was still in them puts. Must have been pretty dovish. 440. Average is 5. Well, I want to go higher. We got a hammer and a hammer and a hammer.
But the question is whether or not it rears its head once again. In the meantime, we've seen the bank stocks selling off. New York Community Bank struggling. It has many banks underneath it, more regional type banks.
Not much action. Boom, doo, 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 doo. Then I'll go back up. $7.70. Now we did come to some resistance here. Take some profit off or do something there. If we can break these two trend lines, we'll move on up to the top up here and have a triple breakout. What the? Oh. Well, that didn't last long. Not a good reaction. Not like I was thinking. So we had our dip and our pull up, but I wanted it to go a little higher. As you can see in my diagram. So far we've held support.
Three cuts will begin, and that's what they had in the dot plot was 3 cuts.
Right.
Did you ever fall into the camp of the 4, 5, 6, 7 cuts?
I don't think so, because I think, look, they raised rates for a reason. They raised it maybe a little bit too much. At the same time, inflation is coming down, and you usually don't realize inflation came down till after it's stabilized. You know, and as we know, historically, the equity markets have outperformed the economy and have outperformed inflation by 6 to 9 months.
Not doing much. I was up a couple hundred there. 400 at one time. I'm going to still hold on to them here. See if we can hold this 487636. Don't want to go lower than that or I'll get out. 4876.36. The candles look bullish to me. Almost every one of them. All of them. All of them do. We got a harmony here, which caused the reversal. We got a hammer, 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 spinning top, hammer. Market's red. Thank you, Rick. Let's see if we can break this resistance, then we're going to go to Fifth City. That's a real solid. If we break that squeeze, boom, baby. Well, he must not be doing too good, Pow Pow. Okay, we got our 1, 2, 3. Now there's no room but to go up from here. We've got a higher low if that holds. And then you'll have a 1, 2, 3 as you go up. And that brings you right into the middle of that. You know, right to that 4884. We don't want it to go back down anymore. Oh, I got something in the car I gotta get. Sure do. I don't want to leave. I hope I got it. stay. We definitely touched that time. That didn't do it. Randy. Right back. Oh. Well, looks like I didn't do it. Broke support. Slow. Volume's real slow. Still got $5. I ain't giving up yet. $4,900s. We definitely broke support. Only down 100. Now they've had time to digest it, but we should have had a lot better reaction.
vague commitment, obviously, to get the easing started. But to me, that wasn't make or break. A March cut was not make or break for the stock market. The S&P 500 is less than 1.5% off of all-time highs. We haven't had a 3% pullback since late October. Things are not really in a stressed position right here. I think the only hazard, I mean, if
now they're making excuses. CNBC.
Go back and emphasize that they think the economy has to be run below potential for an extended period of time to get the job done on inflation. That was the stale rhetoric of last year when they really felt like they were chasing inflation. So short of that, I feel as if it's like, look, guys, you're going to have to stay in suspense until March, maybe beyond that, May or June. And, you know, you could probably live with that if we have a resilient economy, as it so far seems to be the case. A lot can change, though, as people have been saying, with the jobs number on Friday and subsequent inflation numbers.
I was going to say, I mean, does this up the stakes even more on the data between now and then? Data is always important, right? But maybe now we're looking more at the labor market to look for any signs of cracks to then see if June's on the table.
Yeah, I do think that, Courtney, they're going to want to try to seal the case and say that things look pretty unequivocal.
Just admit you priced in 6 price hikes or cuts and quit making up excuses. That's what you all been saying.
Simplifies the picture a little bit. We'll see what happens over the next several weeks. As I say, the stock market probably could be due for a pullback, even no matter what
now
the statement
pullback,
says,
huh?
no matter what the press conference
Jimmy got it right.
But we'll see if that's what we get as we go through really the rest of earnings season. There's still plenty to chew over the rest of this week.
All right, Mike, we're still waiting on Fed Chair Jerome Powell right now with regard to coming in for the press conference. So if I cut you off, it's only for a good reason. A final question-ish, depending on when Jay Powell comes in. The market reaction, you mentioned pullback. How significant could it really be, given that financial conditions are as relatively easy as they've been for a while now?
Yeah, unless something changes on that front, the credit front, or if rates really take flight from here or something, I don't think that the stock market is set up for something nasty. Therefore, usual 3 to 5% random pullbacks happen at any time, so you shouldn't be surprised at that. I think if the S&P stays above 4,800, that's where it kind of broke out from just a few weeks ago. You know, you're talking really about very routine profit taking around the edge.
Okay, Mike Santoli, thank you very much. Here comes Fed Chair Jerome Powell.
Good afternoon.
Good afternoon. You suck.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news.
Go green, baby.
But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2
that ain't
years,
gonna
we
be
have
happy.
significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing
Break
the
it.
effects.
This is the 63. You got to break that.
As labor market tightness has eased and progress on inflation has continued,
Any
the
spike
risks
from
to
here, I'll
achieving
get
our
out.
Employment and inflation goals are moving into better balance.
And if we can break the
We'll have more to say
200
about monetary policy about
and double top,
monetary policy after briefly reviewing economic developments.
triple top.
Recent indicators suggest that economic activity has been expanding at a solid pace.
Now, if you got in with me right here, this is a 1, 2, 3 bus.
Of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined.
I hope he ain't talking about illegal immigrants, because he's a liar.
Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people.
Okay, get ready.
My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher
That was
costs of
resistance
essentials
right there.
like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate.
Man, can you imagine this?
As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%.
Bullshit.
At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target...
They have no clue what they're doing. I'm getting so many mixed messages here from this guy.
The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%.
We got to bounce right here.
We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
I got a question for you. When's the last time that you ever thought about working for the middle class and the poor instead of the filthy rich?
What do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing.
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay, so what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and has been increasing, but we want to get greater confidence.
Damn it.
What do we want to see? We want to see
now
more
770.
good data. It's not that we're looking for better data. It's we're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6 month data isn't low enough. It is. It's just a question of, can we take that confidence that we're moving sustainably down to 2%? That's what we're thinking about. In terms of growth, we've had strong growth. If you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we
10-20. Can you imagine that?
Growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry if I could just follow up very quickly. When you say that you want to make sure that it's a
got
true
100%
signal,
trade
is there
there.
anything
About
that
to
you see
held
in the
it.
data that makes you doubt that it's a true signal at this stage?
No, I think it's. I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, and we haven't yet. And so, I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sector have to contribute more. So, in other words, what we care about is the aggregate number, not so much the composition. But we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing, and that tells us that we are on, gives us confidence that we're on a path to a sustainable path down to 2% inflation.
Nick Timmeros of the Wall Street Journal. Chair Powell, it seems to me you raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these two tail risks, and that you've judged here today current policy is well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3 months from now that you have avoided those two risks?
So what we're trying to do is identify a place where we're really confident about inflation getting back down to 2%, so that we can then begin.
I really
dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year.
Look at them suckers go, man.
I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or its variants. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules.
This guy's an idiot.
We consult them regularly. They're in our teal book, and they're in all the materials that we look at. But, you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is, implicitly, is so in theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all, because for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around to see the economy turn down, because that would be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
Hi, thanks, Chair Bell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%.
Okay, we're about to my resistance level.
Some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated. What's the step down from there?
Yeah, I don't know that we worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, and it's still well above core is 2.9%, for example, 12-month.
I'm gonna buy a put once we hit this target.
Very positive development, very fast decline, and the case is likely that it will continue to come down. So that's where it is. But we're wanting to see more data.
So if I could follow up on
4880s
allows that you want greater confidence on
4880 put
before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates?
Yes. So let me say that we're not looking for that. That's not something we're looking for. But yes, if you think about, in the base case, the economy is performing well. The labor market remains strong. If we saw an unexpected weakening certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or those sorts of things, would argue for moving later. In the base case,
go ahead and grab one.
The economy is healthy, and we have ongoing growth, solid growth. We have a strong labor market, inflation coming down. That's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Claire Jones, Financial Times. Just to circle back to the greater confidence aspect of the statement, there's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached. Thank you.
We're not really at that stage.
You're not at that stage?
There was no proposal to cut rates. Some people did, talk about their view of the rate path. I would point you to the SEP as good evidence of where people are, although it is one cycle later. So, we're not at a place of really working out those kinds of details, because we weren't actively considering, moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements, in the minutes, and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. To me, that's a well-functioning public institution.
You're an idiot. Who has the final
Hi,
say?
Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper
Okay, I'm gonna
understanding
take
of
profit.
where the economy was, like open table data or office
We're coming
attendance.
close to the
We've talked about
21.
vacancies in the past. And I'm wondering at the start of this year,
This is the
what might
EMA.
be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including?
Rent costs.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rent, so of course we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation, so the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming, and we know it's coming. It's just a question of when and how big it'll be. So, but that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the
Go
effort,
ahead.
and probably that
Run,
declines over
run,
time,
run.
but it may well have some more time
6:30.
to run. The supply chains are not
There we go
perfectly
again,
back to where they
7:30.
were. In addition,
That's
it takes
left
time
$300
for
on the
the
table.
healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our
Core inflation hasn't gone down at all. Can you believe this? I'm really liking these new moving averages I have on here. I got out at the 21, but it went down and it hit the 63. Now these are the EMAs. I just started using these two this week, along with my 200 and my 9. The 200 SMA, which is right here. Unbelievable. I mean, that was a beautiful call. I just should have held on to it. So you had a spinning top and a hammer up here. Now they're at 860. 950. Oh. Good job, Ricky. Now this is an inverse. This is to the upside. Got a hammer below the 200, so you got to break the 200. But I'm not trading it anymore. I'm done with it for now. That really pissed me off. I've left at least 1,500 on the table. But there's your reversal. One thing to learn that could help you out is we know we can count to 3. You can trade with me. If you can count to 4, you can get more. But if you count to 5, you might stay alive. So you got the 5 candle. 1, 2, 3, 4, 5. Same as the 5-day rule with a hammer. If you can count to 6, you can pick up sticks. Magnificent. May I have a grade, please?
And you pointed to one or more of them. So I think, job openings are not quite back to where they were. Wage increases rather are not quite back
A plus.
to where they need to be in the longer run. I would look at it this way, though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that...
He keeps talking about the labor market. And if he did study the labor market, he would know that most of these jobs created are government jobs. We've had over, all these layoffs here in the last 2 weeks. 10,000 here, 12,000 here, 5,000 here. Private sector jobs. Part-time jobs. Then we got, 10 million illegal criminals that jumped across the border. So the real unemployment rate's not being counted. If he counted that in, they never count the real unemployment rate. It was like 17% when Obama was in office. Then Trump got it down to about 10 to 11. Now Biden's jacked it all up because of the 12 million illegal criminals.
A good labor market for wages and for finding a job, but it's getting back into balance, and that's what we want to see. And one great way to look at that is what's happening with wage increases, and you see it now across the major things that we track. It isn't every quarter, but overall there's a clear trend, still at high levels, but back down to where would be consistent with where we were before the pandemic and with 2% inflation.
Hi.
If I'm hearing everything wrong, CNBC's been totally wrong about everything.
It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk. The risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here, and why we're not rushing. So I think both of those are risks, but I think the more likely.
No. Now, I did an irrational exuberance video this morning. I've been talking about it for a month. I've also said that CNBC says the market had counted in 6 rate cuts. And I said that ain't going to happen. That's not going to happen. Now, the way he's talking, the rich are going to get richer and the poor are going to get poorer. They've got to stop this insanity. They're I don't know. I live in a different part of the country. I live in the hills. Missouri. Crack heaven of the country. It's probably everywhere. I know a lot of it come from Chicago, Kansas City, and St. Louis. A lot of people moved down here from Chicago to get away from the crime that was up there and just brought it down here. And I had know too many people that are suffering. Because of these high interest rates. Like I said, I went and bought chicken I didn't even buy it. I went in there and it was $33 for 6 chicken breast halves, 6 of them. Then I went in there a couple of days ago and they had it down to 22. And I'll go back in there again and they'll have it at 44. It's just, this store up here fluctuates so much with their meat. I have to go somewhere else to get it. I used to be able to buy the same stuff for about $12 before he started this interest rate hike. I'm not going to be satisfied until I see my prices of my food go down. And that'll take years. That'll probably never happen. But I probably measure it in the wrong way.
Inflation is above target and getting down closer.
Just
to
makes
target.
me
It's not
want to go out and
guaranteed,
grow
but
marijuana
reducing
and get away from
to
it
be
all.
Getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
But it's going to be very
Could
fun.
you get inflation that is
For a couple
below
months
target,
now.
end up with
Earnings
inflation
sucked.
below target, and you have to do something about that?
Earnings were real bad this quarter. That's another reason why I think this market's irrational exuberance. They price in 6 rate cuts. That's what they say. I don't believe it. I think it's just irrational exuberance at the extreme levels. And
If
I'm
we
going to
do
play it
face
like
those
that.
circumstances, then we'll have to deal with that. I think as of now, the question which we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward Lawrence from Fox
I'm ready
Business.
to buy
Thank you,
puts
Mr. Chairman, for taking this.
and just walk away
So
for a
as
month.
As I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
There's a good question.
So
who is that?
I'll point to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context.
These guys they're so far behind the curve. He wants people to lose jobs and suffer so the rich can get richer.
I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that, but that's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case. Then your second question is
Is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data. The whole thing is this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to, or if they happened, that would cause us to go faster and sooner, and that would be a
Golly,
labor
the
market.
4880 puts.
Very, very persuasive lower inflation.
Woo!
Those are the kinds of things. So we're just going to be reacting to the data. That's
Oh
really the only way we
no,
can do this.
$2,300 a piece.
Hi, Victoria Guido with.
Did you hear me? Jimmy left him on. I was happy for a couple $100. Damn it. Oh, $2,300. There are going to be a lot of this going on. Some big megaphone patterns. What? You're still in them? You dog. Ugh. Jeez.
Machine's getting fixed.
Right, so would that be
26.8,
behind why we've seen
27.70.
such strong growth, but we've also seen inflation
2,800.
fall, that maybe there's just a higher level of productivity
That's
right
one
now?
way to look at it, yeah.
I think everybody's stunned in there.
Hi, Chair Powell, Nancy.
This is not what they wanted to hear. I really want to listen to CNBC. I was right from the very beginning. They were wrong.
You know, our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those
The
things.
cost
Those
of
are very
food or
important
nothing, you
things
son
for
of a
people's
bitch.
lives. But they're not, you know, those are not the things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems with the availability of housing. You know, we have a built up set of cities and you know, people are moving further and further out. So there hasn't been enough housing built. And these are not.
People are moving out because of the crime issue. You dingbat.
Work is inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate or even being flat, and that will show up in inflation.
Oh God, I can't take him anymore. I just want to take him by the neck. Can you believe he's a Republican?
Members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that our job, the job Congress has given us, is price stability and maximum employment.
And I'd fire your ass on the spot.
For people's lives, most importantly, not most importantly, mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation,
Do you like my commentary today?
make adjustments to the balance sheet runoff in tandem?
Man, they were so
Yes,
wrong.
We see those as independent tools, and so they don't. For example, if you're normalizing policy, you might be reducing rates but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening and one with tightening. So that could happen. It's not something we're planning or thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet runoff to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Thanks.
Simon Urbanovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March, the implication is that 8 good months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
I'm not in a position to put a number on it. I'm just going to say, it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction, and we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public, because ultimately we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it. In terms of when that'll be, that'll all come out of our communications, and we won't keep that a secret.
I can't wait to hear the CNBC's excuses.
Hi, Chair Powell. Evan Reiser with M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to 0, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to 0. I mean, if it were to stabilize at a different level, but that's not a decision that we've made. That's what we'll be talking about at the March meeting. A whole range of issues will be briefed up, and the committee will get into all of the issues that will be arising over the course of the next, let's say, year or so.
Thanks, Craig Croft from Market Watch. Chair Powell, I want to change gears a little bit. In the presidential primary campaign that's been going on for the last 9 months or so, your name has come up often. Many Republican candidates have said that they probably wouldn't want to give you a 3rd term. So I wanted to give you a chance to talk about that. Do you want another term?
Fuck no.
On the Fed, what?
This guy's had it wrong from the very beginning, and he still does.
This year is going to be a highly consequential year for the Fed and for monetary policy, and we're all of us very buckled down, focused on doing our jobs.
Smelling Yellen probably even voted for a rate cut.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you mentioned, core PCE has been running at 1.9% over the past 6 months. And you guys are actually expecting core inflation higher this year at 2.4% compared to that 6-month measure. Given that forecast and that the median is for 3 rate cuts this year, what happens if inflation
You said 6.
stays where it's been over the last 6 months for the next 6 months?
So we'll update our inflation forecasts at the next meeting. You referred to the December meeting. That's 3 months old, so it might be lower now given the data we've gotten. So look, as I mentioned, we're going to be reacting to the data. If we get very strong inflation data and it kicks back up, then we'll go slower or later or both. If we got really good inflation data soon, that would matter for both that would tell us that we could go sooner and perhaps go faster. So we're just going to be but of course we'll weigh that with all the other factors. We're setting policy based on the totality of the data.
But just to follow, if inflation stays where it is currently, that would probably mean that the real interest rate becomes more restrictive. Would that mean you'd have to trim more, perhaps, than you already have factored in?
Well, I think if we came to the view that that the 6-month inflation numbers, which are very close to 2, were in PCE world, if we came to if we thought that is really where we're going to be, then yes, our policy would be in a different place. It would. But that's the whole point, is we're trying to get comfortable and gain confidence that inflation is on a sustainable path down to 2% or toward 2%.
Hi, Chair Powell. Daniel Davis, Agence France Presse. I just wondered if I could get your comment on the recent consumer confidence data. It seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent months? And do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years. But nonetheless, that's been the case. And we've asked ourselves why that is, and one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years, and people are going to the store. And they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part of why people are unhappy, and they're right to be unhappy. This is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this. In terms of you're right. In recent surveys, you've seen a couple of significant increases in,
That's good to know.
Consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But you're right, it is a fact that we have seen a meaningful increase. I think levels of confidence are still maybe not as high as they've been at various times, but they certainly have come up.
Everybody's silent, man. They don't know what to say.
Thank you for taking our questions. Brian Menace.
This is not what they wanted.
Committee members have said they'd like to meet with business leaders and stakeholders in person to learn more about the economy in real time, given that
yes, the great question.
Revisions, the issue of seasonal adjustments being thrown
Screw
off
your
balance,
third term, you
and many
bastard.
readings of the economy being quarterly. So did any members say they've learned anything not reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes. I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy, and
they get paid for it. Smell and Yellen has made millions on meeting groups. I mean, $250,000 check here, $500,000 there. She's made a ton of money just speaking.
In addition, as you know, the 12 reserve banks have really...
And I don't want to listen to her.
...of anyone. That in all their districts, they're talking to, not just the business community.
I won't listen to her.
Medical, all nonprofit community. They have arms into all of that. And so when they come back, that's what goes into the beige book. But they come back, and what each reserve bank president does is, during the Outlook go-around, they'll say, in my district, and they'll talk about 100 conversations. They won't talk up. They will give you input based on 100 conversations that they've had with people of all different walks, and I personally find it very helpful in understanding
right there from
what's going on.
280.
Also, I think you hear things before they show up in the data sometimes.
$2,900.
Did any of them notice slowing economy based on what they've heard from their district?
Yes, I mean if you look back the last.
I can't believe I got out of them.
The one before, it was there was a lot of slower activity. I think that what you're hearing now is things are picking up a bit.
10 grand.
Not in every district, and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what comes through.
Thank you, sir. Jeff Cox from CNBC.com. Just kind of looking to put it all together. You talked about basically the economy looking strong. We had 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position, in other words, to keep rates elevated as long as the economy stays strong, and you're more tilted towards that. And then also, perhaps, are you worried at all that the economy is maybe a little too strong right now, and that inflation could come back at some point?
I'm not so worried about that. It's again, we've had inflation come down without a slow economy and without important increases in it.
They don't get it. They printed $6 trillion in 3 years. $6 trillion. That's where the problem lies from our government spending. If they just would say it, but they don't have the balls to say it. That's why, all these government jobs have been created. $6 trillion. 88. Oh, gosh, don't get me started.
Well, I'm Scott Wapner here, Post 9 here at the New York Stock Exchange. The first Fed meeting of the year officially in the books, along with the first news conference.
Now I want to listen to these guys' excuses.
Going in, when will the first rate cut come? Clearly, the chair was non-committal on that. He did say in his comments a few moments ago that it will likely be appropriate to begin reducing rates sometime this year, that the hiking cycle most likely...
Sometime? But not today, you idiot. What about the 6 times you said?
Said, quote, probably not the most likely case. Well, stocks didn't like that at all. They sold off pretty quickly. That's pretty much where they sit now. You can see we've got 1% plus declines for the S&P, the NASDAQ.
That's why I quit listening to these guys. I couldn't take it anymore. They're so irrational with what's going on. And I did a video this morning about irrational exuberance. I've been here every day for 20 years watching these guys. And they've never acted so foolish than they have in the last 3 to 4 months.
Base case. And I've
never seen the market run like this on just speculation. They said the market tells them that we had 6 rate cuts. The market doesn't tell you shit. The charts do. When you're up 200 or 300% on a ticker within a year, that's just not normal. It's not normal. It's never happened.
It's going to come soon. It's going to be quickly. That's not going to happen. So I think risk assets got to a very high level of enthusiasm, not just stocks, but things like junk bonds, bank loans, very, very high prices
Stocks
relative
too,
to where
you idiot.
we've been on average over the past couple, 3 years. In fact, a lot of these markets are kind of back to where we were at the beginning part of 2022. And so I think that Jay Powell did a really good job of being candid, I would say. There was a lot of less hand-waving, I guess, and more statements. And the one on March was obviously the big one that tanked the stock market and got the bond market a little bit less enthusiastic, although the short end is still down significantly in yield. So on we go to the next meeting, and we'll see what happens. But the baseline here is the market can't expect a rate cut in the next 2 or 3 months.
Does March really matter when it comes down to it, as long as even the Fed chair admits they're likely to cut at some point this year? It's the trend that matters more than a date. Isn't that correct?
That is correct. But the market really, not very long ago, was pricing in March pretty heavily. And that led to very high valuations on a lot of risk markets. And the longer that the Fed stays at what is going to be about a 200 or 300 basis point real interest rate on Fed funds, there's risk to economic growth that's going to build.
I don't want to see this guy. I want to see the ones that have predicted all this big cuts. This guy's new. I mean, bring the ones that appear it's been preaching for the last 3 months.
Wrong. And there's also data that never gets reported to the extent it should be, which is unemployment data that's reported on a state level. The states do this too. And they have 51 states. I think they have DC in there as if it's its own state. And something like 85 or more % of those 51 state reports have rising unemployment over the last 6 months. So there's a strange mathematical inconsistency that the unemployment rate stays at 3.7 on the National House Establishment Survey, but over 85% of states report that unemployment is rising over the past 6 months. It almost doesn't seem possible. Now, the states that are not reporting rising unemployment are Wyoming, North Dakota, yes, Texas, I think Pennsylvania, but not California, not Illinois, not Florida, not New York. So I don't know, is unemployment really as low as we think? With continuing claims are rising, that's a leading indicator. Temporary employment is falling, that's a leading indicator. And the quits rate is now in every sector about the same as it was pre-pandemic. So this narrative of there's nobody quitting is just false. It's all the way back to where we were pre-pandemic. So I just think higher for longer is going to weaken the economy, and that's what you hear when March is. We have to see a big data change, which one should not expect. There's 2 data reports before March, but our inflation model isn't looking for further relaxation in some of the key inflation measures. I just want to say one more thing about inflation, and that is one reason to be optimistic past the next few months on inflation is that the PPI remains negative year over year. That's a leading indicator. And import and export prices, which are my favorite inflation measures because they're not adjusted in any way, those have been negative for a while now and remain negative year over year. So I think cuts are coming, but we're on a delay now, and I think that puts the market in a less euphoric position.
I mean, if you look at the most important metrics on inflation, certainly to what we believe the Fed thinks is most important, employment cost index is falling, expectations are falling, PCE is going.
And I want you to listen to these guys' voices. They sound totally different. They sound sorry, kind of a little whiny, like, oh, please forgive me, I was wrong.
Having in the last half hour or so is there's risk that has been inserted into the marketplace relative to the Fed, because we were looking for 6 rate cuts based upon the pricing in the Treasury market.
I could even tell when Becky was in here yesterday yakking off, she was getting onto that one dude. And will she come back on today and apologize to him? No.
I don't know. I'll just take a guess that the baseline right now is June on cutting rates. And do you really want to get aggressively cutting in the, the 5 months or 4 months leading up to the election, the presidential election? I don't know. I'm skeptical that the Fed is as political as many people assume that they are. A lot of people have been talking about that. The Fed's always political. I think it's somewhere in the mix, but I believe Jay Powell is not terribly political, and he's been doing a really good job over the past
He's done a horrible
year
job
now of communicating. It's the dual mandate, and now he's saying it's in balance and so forth, but he was crystal clear that the inflation rate has to stay at a level that resembles 2% or get near 2% and not go higher. And if that happens, there could be some real disappointments. The good news is I don't think it's going to go terribly much higher. And another reason I feel that way is the Bloomberg Commodity Index just remains in a protracted downtrend. The 200-day moving average just keeps dropping, and it's below its 200-day moving average. So that would not be a catalyst for inflation. The last thing I want to say about commodity prices is with all of these tensions going on and saber rattling now with Iran and retaliation and already wars in Ukraine and Israel, it's interesting that the price of oil doesn't really go up. That would be indicative of a weak-ish global economy. We know that Europe is acting like it's in recession. We know that China hasn't been doing well lately. So it looks like the demand for commodities and oil is waning, and it's overwhelming even some very significant geopolitical tensions.
Are you still calling for a recession? Because I thought it was notable where Powell, a few moments ago, rather matter-of-factly said this is a good economy. And yesterday we had Ken Griffin on this network as well. He talked about Goldilocks, the potential of a soft or either no landing, and said The economy is, quote, pretty damn good right now. Are you calling for a recession still like you have been?
Yes, I am in 2024. Yes, I am. And I want to talk about experience in markets. And I've got a lot of it, like being at this for over 40 years. And when I hear the word Goldilocks, I get nervous. Because when you hear people saying Goldilocks and everybody in the room nods their head in a north-south direction.
Exactly.
And everyone says, yeah, it's Goldilocks. That means everything is priced to something resembling perfection, the Goldilocks outcome. When you're in Goldilocks, the problem is, I remember once...
it's called irrational exuberance at the extreme level.
There was somebody that I worked with that was very aggressive in NASDAQ type of stocks, and he called the environment at the turn of 1999 and 2000 nirvana, investment nirvana, and I got a chill went down my spine. I said to myself, if this is nirvana, it means it can only get worse. It's like a AAA rated bond. They can only go in one direction. If you have nothing but AAA rated bonds and they're not guaranteed in any way, well, they can only get downgraded, they can't get upgraded. I feel that we're sort of priced for perfection when I hear Goldilocks language being bandied about. And today, Jay Powell took Goldilocks away, I think.
He just sure did.
You said a little bit ago that risk assets are pretty extended, and you didn't limit that to equities. You mentioned parts of credit. So what would you do? And I should also preface that by saying that I got a text a few moments ago from somebody who's on my invest.
I really can't stand this channel anymore. They've got so political. They're backers of the Obama-Biden administration. And when what that guy was saying is true, when you're at extreme greed, where everybody thinks everything's just going to be hunky-dory and we're having 6 rate cuts and all in speculation, that you just got to sit back and shake your head and look at and be the devil's advocate. Because when people are the greediest of greed, that's the time where you got to be at all-time highs. Nothing's got better, just more government jobs, people working part-time. Got 2 big wars going on, maybe 3 coming up. We got a president that can't hardly speak and tell you exactly what's going on. He's more or less a puppet. All that stuff's being ignored. And then you got these people on CNBC say, oh, last December, 6 rate cuts are priced in. Yeah, man, let's get it. We're all happy. And break the double top all-time high when things really ain't that great. I mean, the price of cars, I've had to buy me a car here, and it's a total big difference than the one I bought 3 years ago. I bought me a nice car for $13,000 3 years ago. That same car today, you're looking at $21,000. The same car, same year, same everything, with the same miles. The same exact car. I saw it. I was priced it. And I said, I ain't paying that kind of money for this car. If it got 80,000 miles on it. Yeah, it looks nice. It smells nice, but I ain't doing that. Now I might be able to. Just go in there and I don't care. Because I'm getting ready to buy so many puts in this market. This AI thing is a huge bubble. The way they've run these stocks up from $80 to $400 in a short period of time is just crazy. It's just not, it's not priced. If they're pricing it in on speculation again. But this guy's got it right. I mean, you got to be the devil's advocate of everybody. When everybody's all hunky-dory and gibberish, and you got to lay back and not be as aggressive.
To roll it every 3 months, but on the shorter end, you're still getting 5 1/4 on the 6-month bill, and that's probably fairly attractive. But I would want to have a little bit longer maturity just in case the rates start to fall and you have to reinvest at a lower level. But this is, for me, I'm in a defensive mode. When we talked in the November Fed meeting, I think it was November 1st, I talked about how I was pretty enthusiastic about things, but that has totally repriced since then. And so I'm sort of, the pendulum's on the other side for me at this moment.
It's been a different market. Bear with me if you would, Jeffrey, for a moment. Let me just update our viewers as well. We are almost at the lows of the session, just slightly off. Dow's down about 280. The S&P 500's trading at 48.53. Remember, it was just a day ago where we got the first ever close above 4,900 as we headed into those mega cap earnings. We've given that up, obviously, with this move lower. S&P's down about 72 points. Back to Jeffrey Gundlach in just a second. Steve Leisman's come out of the room where the chair was giving his news conference. Steve, you know, it's just so interesting because the March commentary from the Fed chair clearly upset the market. You know, it almost feels like a Fed chair who's 9/10 of the way there of wanting to cut rates. He just needs one more jolt of inflation confidence to truly get there. And maybe March is just simply too soon.
Yeah, I mean, Scott, very dramatic moves around stocks, around bonds, around Fed fund futures. I'll just show you one example of how things have been moving. You've been following the stock market. Look at the outlook, the probability for a March rate cut. It's come down 36%. We had been, I don't know, between the meetings as high as 80%. So hopes dashed around the world for that early Fed rate cut. But Scott, I had to tell you, I was somewhat amused because I didn't think Powell was going to answer that question as detailed or as specifically as he did. Because the story is this. I thought like he said, he didn't say this, but I thought he could have said, if you haven't listened to everything...
He's a Russian. Remember that.
We said in the statement, and if you didn't listen to what else has been going on, we're not cutting in March. Let's hear the sound from what Powell said, dashing hopes for that March rate cut.
Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time.
That means he will cut it in March because he'll get pressure big time.
When you ask me about in the near term, I'm hearing that as March. I would say I don't think it's probably not.
Magnificent. Jot that down on paper. Jimmy says we will get a rate cut in March.
Consistent with things that the Fed chair has been saying, and the market has been listening to some extent, but not nearly as much as perhaps it should have been.
He was, though, as you said, you know, more explicit. Let's say that. He was more explicit than perhaps some expected him to be today, and that's one of the reasons why you've got it down by more than 300. Steve, thanks as always.
Let me just add, Scott, I think that one of the things he said in response to the Nutri-Weight question was the idea that he does expect weakening in the economy. He says the strength we've had so far is supply and demand coming back into better balance. He expects weakening, and that is the weakening, I think, Scott, that's going to precipitate the rate cuts.
Yeah, that's a good point, as the many that you've made. Steve, thank you. That's our senior economics reporter, Steve Leisman. I'll go back to Jeffrey Gundlach. You know, Jeff, I thought it was also somewhat profound today and kind of underscored the shift in psyche, if you will, of where Powell and the Fed seem to be, because it appeared to, I think, everybody throughout the beginning to middle stages of, let's say, this hiking regime that they've been on, that they needed to crack the labor market to get demand down and then ultimately to bring inflation down, to where now Powell underscored a number of times today, we want to keep the labor market strong. That is a change of focus clearly for the Fed. Now they don't think that they need to unravel the labor market clearly to get inflation to target, because I read you where the ECI is going, the cost index, of course, and where the PCE and expectations seem to be heading.
He also said, Scott, that the labor market is largely healed back to where it was pre-pandemic. Not all the way there, but largely there. And I think he's right about that on a lot of the data. And so it would be nice if the labor market didn't weaken, inflation would stay down at 2%. But like I said, 85+% of states say unemployment is up over the past 6 months. I just wonder about all of this. Are these numbers real? I don't know. But you know, the JOLTS numbers used to get a lot of attention, the jobs openings. And people are starting to realize that that survey doesn't mean anything anymore, because the response rate to the JOLTS survey used to be 75%, and now it's something like 35%. So is it really comparable to where it was a while ago? Are people dropping out of the survey for I don't know, reasons? What reasons would they be? I don't know. But it's not incomparable. So today we got the ADP number, and I think this is what got the bond rally going today, and what hurt the stock market initially, was the ADP data was not great. Now, ADP data is notoriously non-correlated with the establishment survey that's coming out later this week, but it did seem to move the market because it was a noticeably weaker number. So we'll have to watch what happens there. I expect the unemployment rate is going to go up. I think the unemployment rate is going to end this year higher than the Fed's dot plot as of December. That's what I think is going to happen, and that's going to necessitate lower interest rates. And since we don't have those lower interest rates, even though the 2-year Treasury was down, at 4% with the Fed funds rate at 5 3/8, that's a pretty negative yield curve there from the Fed funds to the 2-year. It's not meaningless. This is going to have an impact, and the Fed staying higher for longer. I've talked about this for several months now. Staying higher for longer is going to be bad for the banking system. And I noticed that we did have a little banking problem today, although I think it's isolated.
I do want to talk about that, and I'm glad you brought it up because it's exactly where I wanted to go. The level of concern that you would have today around the regional banking system relative to commercial real estate. A couple of bad loans at New York Community Bank, and that stock is having one of its worst days, if not the worst day it's ever had, down more than 37%. This could obviously put pressure on the Fed potentially to move sooner rather than later. How do you see that?
I see it that way.
It might.
It will.
There's plenty of anecdotal evidence.
He will cut it.
Particularly the urban office market in commercial real estate is a real debacle. I mean, there was loans underwritten on post-pandemic assumptions to evaluation on one building of $330 million, and it went into foreclosure and got sold out at $130 million. So that's a big haircut. And these things take time. In investing in the economy, everything, so I try to mentor the young people, everything takes longer than you expect. You can see that there's problems in commercial real estate, but it will take time for those things to go from a theoretical loss to a realized loss, and those things are going to be happening. So there's consequences to money printing, there's consequences to higher interest rates. They just happen in slow motion relative to what people have patience for. But that I think is going to be the story of 2024.
Speaking of money printing, I noticed many posts from you of late on social media about the deficit. Do you think markets are too complacent about that today? There was a moment a handful of months ago where it was sort of front and center. Rates had been moving higher on these concerns about funding the deficit and whether all of the supply was going to be able to be absorbed. And we sort of moved past that. As we said, we've hit new highs on the S&P heading into today. So what about that issue? Should it be of greater concern today than perhaps it is?
Yes, it should be, but like everything, it'll take forever. I don't think that the 2024 election will be about the deficit. I do think the 2028 presidential election will be about nothing but the deficit, because the interest expense is going straight up. We've added about $400–500 billion of interest expense per year already, and we have tons of bonds, like 17 trillion of treasury bonds, rolling off in the next 36 months. And if we're higher for longer, every day we roll these things over, the interest expense is going up, and we're getting to the point where we can't deny it any longer. Medicare admits that it'll be broke in 2030. Using CBO assumptions, Social Security admits it'll be broke in 2032 using CBO assumptions, but those assumptions are overly optimistic. They assume no recession ever. They assume real GDP growth that resembles where we are right now. It assumes interest rates lower than what Treasury rates are today, and it assumes a deficit that's smaller than it is already today, even though we aren't in a recession officially. And so if you tweak those assumptions, it's more likely that Social Security and Medicare go bankrupt in the 2020s than in the 2030s. And the last time I checked, we're midway through nearly 2020s. So this is going to be a really big issue. And higher for longer just brings it forward more quickly. And I think this is going to be the defining issue of the next 6 years.
You know, Powell has had
It's
the
not
benefit
good.
of having, you know, unanimous votes inside that room. There haven't been any food fights, so to speak, about.
And I definitely put this on Barack Obama and Biden's attack on America by printing $6 trillion in 3 years.
I'm certain. And I think you will get dissent. I think you'll get dissent certainly by the May meeting if rates are where they are at that time and left unchanged. I think we'll start to see dissent. I noticed that there were some letters sent by a bunch of Congress people to the Federal Reserve people saying, you know, you need to cut rates now. I'm not sure what that's all about. Maybe they want to get reelected. I'm not sure, but I'm not sure what that's all about if everyone's crowing about this Goldilocks economy.
Exactly.
And lastly, before I let you
and
go,
it's not a Goldilocks.
because it's another, you know, asset class, if you will, that you've spoken about with me on numerous occasions.
This guy's smart.
What was a weak dollar you had expected to
Very
ultimately
smart.
strengthen, which of course it did quite substantially. So how does that play work now relative to what your view is vis-a-vis what the Fed chair said today and what you think they may do?
It should sustain a relatively stable or stronger dollar because the market was looking for rate cuts and they're not coming, at least not in a couple of months. So I do think when the recession comes, the dollar is going to be very different than it's been in past recessions. In past recessions, it will always get stronger. This time I think it's going to get weaker because of the policy response to the recession. One thing I want to say, I've for a long time recommended India as an equity asset. The Indian economy is the strongest economy in the world. Their services PMI is over 60. Their manufacturing PMI is basically the most robust in the world. I think that investors should be using weakness if recession materializes and starts doubling up on the INDA, the Indian Equity ETF. I don't have a stake in it because I don't like to recommend things that would be in my funds, but I think INDA is a good investment for people looking to get equity exposure on weakness. It's my #1 recommendation for 2024.
All right. Well, that's a good way and a good place to leave this. Your insights are valuable. We count on them every Fed day. I really appreciate your time. We look forward to the next one, Jeffrey. Thank you.
All right, Scott. Good luck.
Yep, you as well. That's Double Line's Jeffrey Gundlach joining us exclusively as he does every Fed meeting. Right when the Fed chair finishes that news conference, you see Jeffrey Gundlach, and you will continue to do that. Joining me now, Post 9, Ritholtz Wealth Management's Josh Brown. We'll get a quick comment from you before we broaden it out after a break. All right, what do we do?
Well, look, I think Jeff came on in November and he was enthusiastic. And the only thing that's really changed from then until now is we had one of the best 3-month periods in the history of the stock market. We did plus 19%.
Because you're a greedy little bastard, that's why. Josh, you got it wrong, man.
16 of those 17 occasions, not only did you not have...
He just said it. The best ever when things were not all that beautiful.
To hear the case for why this time
total greed.
would be different. If you think we had this $5 trillion rally in the stock market over the course of 90 days over absolutely nothing, that's a really interesting story because that says to me everyone's wrong.
Exactly. You've been wrong 3 years in a row.
They might be, but there's very little evidence. Everyone is working.
Oh, God, I don't want to listen to him. I'm going to sit here and argue with this guy forever. See, I wouldn't last long on CNBC at all. I'd be going nuts.
The first cut moving from March to May, to me, it's a very big, no big deal.
Yeah, obviously a bit of a knee-jerk reaction in the market. You stay with me. I lied. We're not going to take a break. We're going to get right to the market zone. And joining us as well, SoFi's Liz Young and CNBC senior market commentator Mike Santoli. Liz, I turn to you. I'll ask you the same question that I asked Jeffrey. Does March really matter as long as we know cuts are coming?
Well, it matters today to the market because everybody seemed pretty sure that that's what was coming.
To the angry algos, maybe. But
Right. Well, I think the other thing about it is that the idea of a cut in March, it was pretty quick, and it gave people this sense that we were sort of invincible because now cuts were on the table. They were going to start. They were going to back.
Lady who was mid-30s, a couple of kids.
SPX set an alert at 4,800. 4,800 for your first support on the SPX. That's on the 1 hour time frame. We're definitely going there. There's no doubt in my mind. Now Josh got up here and wishy-washy. I said it from a month, 2 months ago. I said these guys are completely wrong. This market's just running up for no reason. They don't on speculation. You got to realize what speculation is. Not knowing the facts. It's not factual. It's okay, I think, a rumor or it's something that's not come to provision yet or to, it's speculation, you know. It's like me going into the grocery store thinking I'm going to go buy that chicken for $12 instead of going in there and looking at it at 33, where it was a couple years ago. I'm speculating that meat's going to be back down to $12, or that steak, instead of paying $45 for a good T-bone, it's going to cost, you know, where I used to pay $12. I'm going to go in there and speculate, thinking it's going to be back to $12. It's no facts behind it. You don't, and same thing, someone said something in the room the other day when earnings came out, and this person, she is a very smart person when it comes to trading, because you don't know, you're speculating that the earnings are going, the reaction is going to be good to earnings or bad. It's usually, you don't know, 50-50 either way, and it's usually down and then up. You can't, it's tough to take calls or puts in between into earnings. You got to wait for the reaction. You're speculating that you're going to get a good reaction off earnings, and you could have good earnings but still get a bad reaction. So it's the risk is a lot higher if you try to enter a trade right before earnings. After earnings, you kind of get some kind of format, okay? That's why I created the 3-day rule when it comes to trading stocks. If earnings sounded bad, I'd wait 3 days. We had a good pop on Tesla. I mean, and if the earnings were good, and I read them as good, and we dip, I'm going to go ahead and maybe start trading that stock that same day.
Forecast, many of them have yet to do so, but the point is that the market is betting much more downside here, and that's in the face of additional conflict.
These guys on Schwab had it right.
Oil's down today, but it's been up.
They back up their stuff with charts.
There are a number of inflation pressures here that would suggest that maybe inflation would not be receding even more rapidly than maybe had been expected weeks ago, but in fact maybe a little bit more stable. So it's a real bet here on the direction of inflation over the next couple of prints, and I don't know who's going to win here, the market or the central bankers.
Okay. You know, to hear him say in response to the question, March is not likely, I can't really remember a time he was that explicit, Cooper, because he was intimating throughout the entire Q&A that they weren't ready in March, and it was kind of like he broke and was just like, look, leave me alone, guys. We're not going in March.
They will.
You know, I definitely agree with that one. I think that was really kind of the big question on everybody's mind coming in: is March live? Is it not?
I think his goal is to scare everybody, and then come in and raise the rate or cut the rate in March. It's only 2 months
Jeff's
away,
Mad
though.
Lib, if you were to pick out a verb, I mean, you could pick out slammed, shut, any of the above, because he explicitly came out and said that, in his opinion, it doesn't seem like March is likely. I think he left the door slightly open, but I would say very, very slightly. So maybe it bounced back a little bit after he slammed it shut. So I thought that was kind of the big key takeaway of this meeting.
What in credit, Cooper, should we be watching to know if we're going to be okay? Because there was a little bit of a credit scare in the financial and bank space today.
Yeah, a little bit of a scare in the banking sector today. It kind of shows that maybe we're not necessarily through the worst of it. Maybe there are going to be other things that'll pop up.
Don't let the market do that to you.
This situation, as of now, it appears to be a relatively isolated event. We're still maintaining a preference, or I shouldn't necessarily say a preference, but we still think that investment-grade corporate bonds are an attractive opportunity. We see an upward sloping yield curve, so we often hear from some of our clients they don't want to be stepping out into an inverted sloping yield curve. That's not necessarily the case for the investment-grade corporate bond market. However, I would say that spreads are relatively tight. That's both for IG and high yield. So it does lend towards a preference of maybe treasuries if you're a little bit more of a conservative investor.
Okay. Jeff, as we look forward to the rest of this week, we've also got the ECB, or Bank of England rather. What are you looking for from them?
Well, they'll likely hold rates steady and push the market, try to push the market towards a summer start date for the start of rate cuts. But you could see one member dissent. There might be one or two dovish dissents from a consensus around keeping rates stable, which would lean in the direction of maybe an internal shift towards rate cuts. This is a bigger deal at the Bank of England. Inflation in England has been higher than the rest of the world. It's been slower to come down, and just probably not on path towards 2% within the next 6 months or so. So that is probably more realistically a start of rate cuts is somewhere in the summer months. But the market's still pressing in the start to Q2. So we'll see if again their central bankers try to push the markets back on that start of rate cuts, giving themselves a little bit more flexibility over the months to come.
All right, let's end with the fundamentals. We got jobless claims tomorrow. We got employment on Friday. Cooper Powell seemed to be generally happy. He said the state of the labor market is still pretty strong, even though it's weakened. So what range should we be rooting for here to keep things on the right track?
So the market's expecting a gain of 185,000 jobs. Unemployment rate's supposed to stay at about 3.8%. So that should look as a relatively strong labor market or a continued strong labor market. Now, the 185,000 job ads, that tends to be a little bit lower than where we've seen recently. So it does show that maybe it's slowing a little bit, but overall, the labor market still continues to be relatively strong. I think it's interesting that this Fed, they do have a dual mandate, but it seems like they've been singularly focused on just looking at what's inflation coming out at. So I think for the market, that's probably a little bit more of an important factor. But yes, the jobs report on Friday is also going to be potential for some volatility there.
All right. Great stuff, guys. Nice analysis of today's information. Good preview for the rest of this week. Jeff Kleintop, Cooper Howard playing a little Mad Libs with us. Fun. When we come up to the closing bell, we'll be ready for earnings. Be right back. Don't miss it. We've got a couple key chip makers in the Apple supply chain, Qualcomm and Qorvo, coming up.
I was born on the south side of Chicago. It has been a long road, but now I'm working for Schwab. I love to help people understand the world.
I'm going to be working for him soon.
Invest accordingly. You can call.
I'll be with you, brother. We'll work together. Well, well, well. It was a beautiful day today. Beautiful day today. FOMAC, good to wait around for that FOMAC meeting. I want to see how much more we're going to drop. And there's a lot of people stuck in the market right now, I think. A lot of people that are just over bullish when they shouldn't be on speculation. That's why when you look at news and read news, you got to determine, is it speculation or is it the real thing? You know, is it good news? Is it worthy news? When trading stocks, you got to go to the news. And a lot of it's speculation, like, you know, phase 2, phase 3, but when you get that FDA approval, then you know it's a fact. Sometimes people will sell into that fact, but I don't trade it unless we have facts. Got to have, you know, decent news. I don't want to be yabba dabba do, but I feel like I was 100% right on all this. Market being way overpriced for where we are, how much debt we have, how many wars we have going on. Just the circumstances, the real news that's not being brought into these greedy little selfish pigs in here on Wall Street. That's why I had to find a new way to trade. I got rid of my scanner. I didn't listen to CNBC for years. I didn't need them anymore. Then when I got to listening to CNBC, it just reminded me of how they're totally different than what they were 10, 15 years ago. They're not the same crowd anymore. They don't have any conservatives on here but Joe. That's about it. They don't bring any, I mean, all the CEOs are progressive liberals. Almost all of them. It used to not be like that. It was a mix. It was a 50-50 mix, and you could judge the channel, and they were a lot more honest. But they've got so political. Like they brought in politics. And it's just, you know, I just can't stand it. So I had to figure out how in the heck, you know, I can't stand listening to these guys. They make me mad every day. So when I turned on Schwab, I said, man, it's like a total fresh breath air. They actually got charts, backing their thesis with charts. And they're not irrational. They were talking about the bubble. Everything's a bubble. You know, things are too high, man. I don't know if I'd want to take it here at these extreme levels. And I've been a study of that map for almost 15 years. I've traded off this map. You know, I made it a weekly thing. You know, 5 days down, we start to turn up. A lot of people look at this and they say, well, that only matters every 10, 15 years. No, not in my book. This could go on every day. And 1 minute you could be at extreme greed, and then all of a sudden you get nuked and you're down here in fear. Or we get a new president and everything just changes. So I define every one of these words. When we were down at the bottom, the fear, the way that people talk, the nervousness, we're going to keep, and I was the first one to come out and say they're not going to raise rates anymore. And 3 weeks later, they stopped raising rates. So I was on this map at capitulation while they were still talking about fear. And then we had that beautiful run in 2023 with just one correction. A small one. And we're way up. We're not here. We're up in here. I mean, we're flying with extreme speculation and greed. And these guys they've made 100, 200, 300% on their trades in a year. They don't do that. That doesn't happen. That's not, they're lucky to get 15 to 20%. They're lucky to get that. And when they're getting 100, 200, 300%, they just don't want to stop that momentum. And Josh got on here and started saying the market was right, and I'm going, no, you're running it up on speculation, the momentum. So he got complacent. You don't want to get complacent. You've got to always be the devil's advocate. You got to look at the chart and say, yeah, we're at an all-time double top high here. We're at a shoulder line here, or I got to be a little bit more defensive in how I trade. So I'm going to get out of here. I got pretty excited today. I mean, I was stuck in the stock for a while, but I was able to get out of it with a small loss and then make it back fivefold. It's going to be hard for me to walk away from this. I'm going to have me a real good woman. It's the only way I can think of it. The only way I think I can walk away. So I'm going to get out of here and do another video, but watch them videos. You'll learn something in every one of them. And I want to thank everybody in the room for being a team. We'll catch you all later. Time to relax, take a Valium and a shot of vodka.